Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. With me is Mahima Vachajani, and we will take you through the next 1 hour of trade. If you're looking at the market for the first time today, then I'm pretty sure that you're going to have a very big grin on your face because it's green across the board, and you have a steady line with gains of about 2% for the benchmark Nifty 50. 23,300 is being held at this juncture. And in fact, actually speaking, what we discussed on the open show as well is the range for the Nifty 50 is actually pretty wide. So bear in mind that though the volatility has come off quite dramatically, you could be in for a bumpy ride. So don't take things for granted at this point. Of course, the VIX there is down as much as 17%, which means that for now, the bulls are in the driver's seat. The broader market's also looking quite good. In fact, gains of about 2% for the mid-cap index, and the small-cap index, which by the way on Friday was up 3%, is up another 2.4%. So as a result of which, because you're seeing broad-based gains, the market breadth is very firmly tilted in favor of the advances, and the bulls very clearly in charge. Very few number of stocks that are losing ground. And really the texture and the mood of the market seems to be that any positive news is getting rewarded very well, whereas the negative news is not really getting too badly affected the stocks. But a few stocks that you should watch out for. Let's pull up the Nifty 50 heat map. At the start, of course, you had no losers, and I'm pretty sure that that will mostly be the case. Okay, you have Nestle and HUL from the FMCG pack that are losing a little bit of ground, but I mean, take a look at that screen, right? IndusInd Bank, of course, making a bit of a comeback, but Tata Motors on the back of a pause in auto tariffs that was announced. Larsen & Toubro making a comeback. Mahindra & Mahindra from the automotive pack up and about. Adani Ports also making a comeback, up about 4%. But HDFC Bank, that big mover, 3.5% up, and really pulling the benchmark up quite dramatically. Reliance Industries also gaining over 1.5%, close to 2%. And so those two stocks, along with the rest of the banking pack gaining the way that it is, with the Nifty Bank up about 2.4% or so, bodes well for the market, at least in the near term.
Absolutely. Some other counters, from the broader end of spectrum that are buzzing in trade today, something like a Quest Corp. It's buzzing on the back of its demerger happening. There's Garvey High Tech, there's Samvardhana. It's buzzing in trade because of the exemption of tariff on smartphone components as well as computer components. Though China has 20% right now, India may have 10% of base tariff, which means that the supply chain will move from China to India. On the back of that, Samvardhana is buzzing because it provides displays for these particular computers and smartphones. There's Gokuldas Exports, Mazagon Dock buzzing in trade today. Macrotech on the back of the Lodha brothers solving the dispute between them amicably. There's KSA International Intellect Design 361 WAM also doing well in trade today. Some just a few counters that are not doing very well. There's Kesoram Industries still under pressure. DOMS Industries, GSPL, Max Health, some counters which are under pressure. But with that, let's also welcome in our guest for the day, Swati Hotkar, AVP Technical Research, Nirmal Bang, joining us. With that, Astha Jain, Senior Research Analyst at Hen Securities, also joining us now. Welcome to both of you, ladies. A very good morning to both of you. I'll take up the first query for the day. That's from Lakshmi, who's writing in from Hyderabad. She's bought Reliance 40 shares at 1318 a piece, and she wants to know whether she should hold, sell, or add, considering the current add-on dip. Swati, I'll take this up with you. What are the charts indicating for Reliance now?
First of all, good morning, all of you. Definitely, my view is positive, even though we have witnessed some sort of a corrections. But I believe the stock managed to take a very strong support of 1100 rupees, and we have seen a turnaround from there onwards. At the current market price, I will suggest to buy 20-30%, not more than that. If you're getting any dips towards to 1150, one can definitely add on. Yes, upside a rally can be continued towards to 1300. It will be the initial target. Beyond that, 1370 are the likely levels we are likely to be seeing. So the overall setup is definitely positive. One should hold this Reliance counter into their portfolio. If the markets does very well, then in the future you will get a very good kind of a returns. So definitely one should hold their long positions, and even one can accumulate at the current market price as well.
Okay, all right, so that's the view on Reliance Industries. You can accumulate at the current market price is the view. On gold loan companies, incidentally, we do have a conversation lined up with Muthoot Finance to help you understand the implications of the new gold loan norms by the Reserve Bank of India. That stock recovering somewhat. It was down 5% in trade on Friday, up 0.9% right now. But John from Dubai wants to know about the prospects from Morpen Finance. He's bought this at levels of 233 and he's asking for a short-term view. Asta, I know that it's a short-term view, but I'm still coming to you because there are a lot of developments in the space. Would you hold on to Morpen given what you know right now?
Hi, good morning to all of you. So yes, if I talk about this counter, I would like to recommend hold on this counter. The reason being what we are thinking about this space is, first of all, yes, we know that some sort of MFI pain that will going to persist in the coming future also. But I think this company is well poised to face certain kind of challenges. So this is what we are expecting out from this counter. And one more thing which we are very much positive about it is their gold loan portfolio, which we are expecting it to rise with a growth of around 15% or so levels. So I think the gold loan portfolio is well poised to show some strong growth figures from here. So all these points are suggesting right now just a holding of this counter rather than exiting. So my idea here is to stay invested in this counter. Initial price target can be set at around 270 odd levels.
All right, so that's the view with regards to where Morpen Finance is concerned. We've got our first caller for the day. Dheeraj is calling in from Hyderabad. Dheeraj, a very good morning to you. How can we help you?
Good morning, ma'am. Ma'am, my query is regarding Home First Finance.
Okay.
I'm holding 310 shares of Home First Finance at 1107 rupees a piece.
Okay.
So it is trading at around 1137.
Okay.
Could I hold the shares for another 1 month or should I exit from this? And one more query is, can I add Mahindra and Mahindra at current level?
Okay, I'll take up your Home First Finance query with Swati since it's a shorter term query. Swati, I'll come to you. You know, considering the entire QIP news going on, the stock is, making significant gains today. But with respect to where 1 month charts are concerned, what's the view like?
My view is definitely positive on the Home First. Why so? Because if you look towards the monthly chart or the weekly chart, the stock has given the breakout of a downward sloping trend line, which was having a strong resistance from the last 7 months. Now the breakout was really doing very well along with the price, the momentum. There is a volume also is increasing slowly and steadily. I believe yes, within a span of a one or 2 months, you are likely to witness a target of 1250 levels on the higher side. So you should definitely hold on your long positions. Please keep a strict stop loss of 1,030 rupees on the downsides. If it breaks that level, then we are likely to witness some sort of a profit booking. But overall view is definitely positive on the Home Finance. Home First.
Okay, yeah. And by the way, it just completed its fundraise. It's reacting to that. We couldn't take your second question, Dheeraj, because we only keep it to one question per viewer. I'd invite you to call us tomorrow and we'll attempt to take your question. Apar Industries is the next company that we're talking about, and we got Vivek Pratap, who's writing in from Delhi. He's bought at levels of 535. The stock is currently... Okay. 535 is what he says he acquired it at. So he's looking for the very long term. He's sitting on sizable gains. I had to check twice. I hope he doesn't mean 5350. But I'll come to you, Asta, on this one. He's looking to hold for the next 5 to 10 years. What's the view?
So view is quite positive on this counter, and definitely we are recommending a hold. Looking after the results, number were mostly average. They were not very much attractive, but what we believe that we can see some sort of a margin expansion going out from here. And Q4 FY25 can be a better quarter for this company, and hence we maintain our stance of holding this counter. Initial price target which we would like to attribute to this counter is at around 5,300 to 5,400 odd levels.
Okay, so that's the view with regards to where Apar Industries is concerned. The next question is from Mr. Mehta, who's writing in to know whether this is a good time to buy ABB India. He's looking for a slightly longish term, that is 15 months. But with regards to where charts are concerned, Swati, what's the view like? ABB Global is set to announce its earnings on Thursday, and the stock might see some movement on the back of the commentary coming in. But where charts are concerned, what's the view like?
Yeah, purely on the technical front, from the last 1 year, we are witnessing a very strong correction from almost 8,000 levels to now 4700 levels. Now, on the weekly chart, we are witnessing a positive divergence, which is a very bullish sign on the technical front. RSI showing a very positive crossover. So, we have seen that the stock has formed a very cluster supports nearby 4800 to 4600 levels. And from there onwards, we are witnessing a positive momentum. So, the overall technical setup is really positive. If you want to go for a long position, 20-30% can be accumulated at the current market price. Depending upon the results outcome, we are likely to witness further trend into this particular stocks. But as of now, the chart looks very promising. You can definitely go for a long positions, 20-30%. I'm looking for a target of at least minimum 5600, and beyond that 6000 levels can be tested. So my view is positive. You can take a long position.
Okay, all right. So the next question is on Anant Raj. And Mohan has asked this question. He's bought, or he's asking whether he can buy at this current price range and he can hold for a period of 1 year. A quick view, Swati, on the charts.
Anandraj, you should hold on for some more time. Buy on deep strategy can be implemented. If you're getting any deeps towards to 420 odd levels, then you can take a long positions, but not at the current market price, because the stock is witnessing a very strong resistance of 20 days moving average. So I believe, even though we have witnessed a 2 to 3 days uptick on the rally, but that might be a short-lived, because there is no major reversals we are witnessing on the chart. So stay away from this particular stock. If you're getting any dips towards to 420, 410, at that level you can buy this particular counter by keeping a downside stop loss of a 380, and upside we can see a positive momentum towards to 500 and 520 rupees.
Okay, so the stock is up and about today, up as much as 6.4%. Keep that on your radar. Now, we were talking about gold loan companies. In fact, we took a view from Asta as well on Manappuram. Now, the reason why these stocks have been in focus of late is because of regulations that came through last week. During the Monetary Policy Committee announcement, the Reserve Bank of India governor spoke about uniform laws or uniform regulations for gold loan companies, and among them, in the draft regulations that were announced and issued on the 9th of April, there was a mention of loan to value, which is essentially how much of a loan can you give with the collateral that is given. So, for example, if you give gold as a collateral worth 1,000 rupees, you can give 750 rupees worth of a loan. So that, as well as certain other issues, were announced. I spoke with Mr. Muthoot of Muthoot Finance to try and understand what he thinks about the implications of these latest regulations, and here's what he had to say.
And finally, you said the gold loan, the new guidelines, draft guidelines have come for the gold loan sector. I think it is warranted, because today the gold loan sector is growing very well, and new players are also coming into the field. There are new NBFCs and new banks which are again coming into the field. So there was a necessity for some harmonized regulations which everybody should comply with. See, companies like Muthoot, we are there for the last several decades, and over the years, we have actually fine-tuned our processes. Gold loan is a very process-oriented, process-challenging business, processly challenging business. So we have been able to fine-tune this, whether it is at the time of how we take the gold, how the branches are opened, how the gold is secured, how the gold is released, how the gold is auctioned. All these are processes which we have fine-tuned over the several years, and the regulators, they're quite aware of that. So I think these regulations were kept in many different instructions, which are now brought into one single guideline. So it actually, this guideline now actually supersedes all the other instructions which have been earlier, so that any new entrant which is coming, so that is the base of this, are able to understand this. And the base of this regulation, of this guideline, is, I think, two things. One, how to have a harmonious, equal processes for banks, for NBFCs, and for the new players, whether it is banks or NBFCs. So that's the first one. Second is to ensure that the customer's interests are always protected. I think the regulator, it is always there. And the third is, I think, should be whether the sector, the gold loan business as a whole, will impact something happens to the sector, whether it will impact the financial sector. I think these were the three points on which I feel is what the regulations have come. And I think they have been addressed to some extent.
Yeah.
But your question about the loan to value, the loan to value is always given at 75% of the gold price. See, today the gold price is actually fluctuating so fast, so it is going up every day. It is coming. Some days it is coming down, but generally it is going up. But the LTV, the loan to value, is fixed not on today's gold price. It is based on the last 30 days average gold price. So there is some smoothening of that to some extent because the daily fluctuations are not reflected in the loan to value. So all NBFCs give their loans only up to 75% based on the requirement of the customer. Today, the gold price has gone up. The gold which is with us, the value has gone up. Today, to answer your question, if you look at what is the loan to value today at the gold which you have given, it is only 56% or 58%. So it is only less than 60% is what, because the gold price has gone up so high and we had given only much lower amount earlier. So today, that is the answer to your question. It is less than 60%.
Okay, understood. I understood, and thank you for laying out what the implications are as well of the changes in regulations. I'm just wondering, to close out that bit, for you per se, considering that you're an established player, and I guess that consultations have happened with established players over the course of the last several months and years, perhaps also between the regulator and you, to fine-tune these processes as you pointed out. Will they lead to any slowing of gold loan issuance for the entire sector? Do you think that that will take place? Do you anticipate that consolidation maybe could also be in the offing for gold loans?
Yeah, yes, as you said, there have been consultations, but of course, we would certainly need some more clarifications from the RBI regarding a few points. That as we go forward, the AJLOC, that is the Association of Gold Loan Companies, will do some more dialogue with the RBI to fine-tune and also make them understand, and to make our points also to make them understand, to fine-tune some of the clarifications which we require on these regulations. But yes, the banks, etc., the banks are there, the NBFCs are there, they had dialogues with us, they would have done dialogues with the others also. But finally, all this will only strengthen the sector. Well, I just forgot what was the main thrust of your question.
Mr. Muthoot, okay, so you had a statement that you made that I'm more interested in, which is that there are a few points that you want to clarify. What specifically are you referring to?
I think maybe some of the nothing very much. What should I say? Very material though. But on the processes, we would like to get some clarification. Very minor clarifications.
Okay. Do you anticipate that the updation of the processes, if at all required, and I'm guessing that to a large extent you're already compliant, will that increase cost for gold loan companies like yourselves?
Yeah, talking about ourselves, we are an upper layer NBFC and we are the only upper layer gold loan NBFC. So most of our processes, most of our compliances are almost the same as banks. We have almost all the compliances, etc., which banks have. So for us personally, it may not be a compliance cost may not go up considerably, but for small players, but for new entrants, I think the compliance cost will be quite high. I think so.
Okay, so as an individual and as a company that has functioned in the gold loan space for so long, Mr. Muthoot feels that a new entrance to the space will have more to bear in terms of compliance cost. And there has been this regulation, as we pointed out, that came into effect last week, and a lot of interest from the banking space in particular for gold loans, with a lot of banks beefing up their gold loan portfolios. So this is something that should be taken into account if you're watching some of these companies. We've got our next caller. Shankar is calling us from Bengaluru. Hi Shankar, thanks so much for waiting by. How can we help you today?
Very good morning, Mr. Alex. You are doing a fantastic job and we really appreciate your good work.
Thank you so much, sir.
And your smiling face is a most encouraging thing for especially asking views about the stocks.
I'm glad. I'll keep smiling then. So please tell me your question.
Sir, my question is on Sagility. I'm holding 550 shares at 45.32. I saw the financials, everything is good. And their business model, I like it. Normally, that screener.in is giving a very good picture about every stock and about the company also. I go through that.
Okay, I understand. So, and you bought this from the perspective of holding it for the long term, is it, Mr. Shankar?
Yeah, sure, sir. All my investments are long term. I am from State Bank of India. I am a retired agent.
Okay, it's great to hear. So, let me get your question answered by Asta, and the stock, by the way, is doing quite well in trade today, up as much as 5%. Asta, what's the view on Sagility India? Shankar obviously is bought at 45 levels for the long term.
Yes, so the IPO came in November at a price band of 50 rupees on the higher side. And we have seen this company performing very strongly on the courses. Now, talking about their business fundamentals, we all know that they provide services to the US healthcare industries, and all of their clients are the US based. So there is some sort of that risk which we can see. But looking after the strong fundamentals of the company, in fact, the results which they have posted were very, very strong. We are not very much worried about other risks. So my idea here is to stay invested in this counter, but please keep a strong eye on all the news related to the global economy, which is coming, especially related to the US, because that can have impact on this counter because of their exposure to the US healthcare industry. Otherwise, I think financial performance is very strong. So stay invested. Definitely the cost price will come, which is of rupees 45. So there is no harm to stay invested at least till those levels.
All right, so that's the view with regards to Sagility India. Next query is from Rohan, who's writing in from Bangkok. His query is on Hindustan Copper. He's already holding 3,000 odd shares at 323 a piece, and he wants to know whether he can add more at the current market price. Swati, I'll come to you on this one. He's sitting on a loss of around 3.5 lakh rupees right now, considering his holdings. Do you think averaging out is the right strategy to adopt right now for him and add more at the current levels?
Frankly speaking, I will not suggest to add on at the current market price, because there is we are not witnessing any kind of a major reversals on the technical chart, whether it's a monthly or the weekly and such. It's still behaving in the pattern of a low top, slow bottom formations. On the low side, I will suggest to add on if you're getting any dips towards between 180 to 170 levels. Up to that level, I'm looking forward dips. So if you're getting any dips towards to 180, you can think about add on, but not at the current market price. Definitely, we are likely to witness a small uptick rally on the higher side, which may be a short-lived between 230 to 220 levels, and again we are likely to witness a correction in this phase. So just hold on for some more period of time. If you're getting any dips, you can definitely add on.
Okay. Anil has got a question from Jalandhar. Anil, हमारे साथ बने रहिए. ब्रेक के बाद आपका सवाल ले लेंगे. Swati, Asta, do stay with us. We'll be back on the other side to take more questions with you. Do stay tuned.
That's huge. That is a biggie. It's out of it.
Gold Plus Clear Glass. Far हो या near, सब कुछ दिखे clear.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back. You're watching Ask Profit. Now, one stock that is in focus today is Symphony. The company is set to explore stake sale in its Mexico as well as Australian unit and invest in USA. Now, the management has given a couple of reasons as to why they're doing the stake sale. It's because both the Australia as well as Mexico are high capital intensive in nature, and the resource intensity is diluting ROC at the consolidated level for Symphony. Also, they want to focus on more profitable segments of India as well as exports, and US markets are providing great opportunities right now. Now, to take this conversation further and to discuss as to what the plans are exactly with respect to how the stake sale will happen, we are joined by Nrupesh Shah, MD of Corporate Affairs Symphony, joining us now. Welcome to the show, Mr. Shah. A very good morning to you. First off, before I move on to the details of the entire stake sale, just wanted to know as to what is the plan exactly, what is the board approved, and how will the stake sale take place, and what are the reasons exactly behind doing this entire stake sale?
Thanks. So, as conveyed and announced, board has decided to explore the possibility of divestment and monetization of Symphony stake in Climate Technology Australia and IMCO Mexico. Both are 100% Symphony subsidiary companies. That's number one. Number two, in climate technology, as of 31st December, the total funds deployed, including equity capital invested by company, loans granted, plus borrowings, all in all is in excess of 350 crore, while at a EBITDA level, it is negative. Coming to IMCO Mexico, its capital employed is 87 crore. Company is doing decently well, and at EBITDA level, as on 31st December, trailing 12 months, EBITDA was close to 24 crore, which we expect as on 31st March, higher than that. Now, the point is, in climate technology, we have taken the series of initiatives, and on account of that, we expect that in next 2 years' time, in line with GSK China and IMCO Mexico, gradually it should be a decent turnaround story. However, considering the capital employed, it doesn't make sense for us as it overall drags down the capital efficacy. As far as IMCO Mexico is concerned, in last 3 years, we have launched series of products. They have received well. Company has grown very well. And we believe that this is the right time to monetize the stake at a decent valuation. That is part one. Part two, both the companies take decent amount of time as well as management bandwidth, which we wish to redeploy on much higher growth-oriented and profitable opportunities as available in India, as well as direct exports from Symphony to international market, including taking advantage of current geopolitical situation, whereby in international market we can do extremely well as our main competitors are otherwise from China. And thirdly, we are exiting from these two companies, not necessary from these two markets, because even for new buyer, it may make lot of economic sense and viability if they continue buying the products from Symphony India. And secondly, in some of the products, they are sold under Symphony brand, and there is a possibility whereby we enter into Symphony brand licensing also. But of course, when this process takes place, it will attain the finality in various respects.
Right. Mr. Shah, you mentioned, that we are better placed than China right now where tariffs are concerned overall. I want to understand that in terms of supply chain efficiency as well as the kind of, orders coming in from China to India, what is the kind of percentage expectation that you have that you think that these orders will shift towards India? And then what kind of revenue growth are you penciling in from the US? Because you have mentioned that US markets, according to you, are attractive right now.
So currently in US or other international markets, our main competitors are Chinese players. So currently also, as it is where it is, we really give them a fair competition and doing decently well. However, if tariff continues as currently it is 145% or whatever it comes to, they won't have any scope in terms of the pricing. And that opens up huge avenues in US in particular, which is a large market.
And in terms of the capital efficiency enhancement and the ROC enhancement, correct me if I'm wrong here. You in your filings you did mention that if if Australia and Mexico subsidies were not there, trailing 12 months as of December 24, revenue growth would have been 36% and PAT growth would have been 20%. Correct. So this is with regards to where these financials have already been taken care of. But going forward, once you decide to do the stake sale, how do you think that revenue growth will take place, let's say FY26 down the line, end of FY26 down the line?
So as I said, from various initiatives which we have undertaken in last 2-3 years in India, say we have entered into adjacent category like tabletop cooling appliances, kitchen cooling appliances, water heater. We have penetrated decently well in rural and semi-urban market, also on digital channels and also large space ventilated cooling. So as far as domestic market is concerned, we expect them to deliver very well, as it has been proven in last 5 quarters, of course, coupled with quite conducive summer. On top of it, as I mentioned, huge opportunity for export, including our Brazil model, whereby it's merely a trading subsidiary for a local base. So that's what we intend to do.
With regards to the overall sale of technology as well as the intellectual property rights from GSK to the Mexican subsidiary, because they have a debt to be repaid to Symphony India. Give us a picture as to what amount of debt that is exactly, and will this sale of IPR be sufficient enough to pay that debt for Symphony India?
So GSK China in last couple of years had developed the technology and know-how meant specifically for IMCO Mexico market and its products, and also had certain IPRs, in all 9 IPRs. So that technology and IPRs are meant for sale, and mutually between GSK and IMCO Mexico, the arrangement has been worked out. at rupees 43 crore in INR at 5.1 million USD. That entire proceeds is proposed to be paid by IMCO Mexico out of its internal accruals. And GSK China doesn't need those funds for its growth or even for working capital because it is completely self-sufficient. And about a year before, the loan granted by Symphony India to GSK was close to 60 crore. In last 12 months, GSK repaid about 13.5 crore out of its own internal accruals. As of now, the outstanding, including interest accrued, is close to 49 crore. And from this sale transaction, we expect GSK to repay 38 to 40 crore net of expenses and taxes. So we leave balance 8 to 10 crore, which also we expect GSK China to repay entirely in ensuing quarters purely out of its internal accruals. So post this sale transaction, the loan will come down to close to 10 crore, and in next 12 months or so, it should be zero. So GSK China business model, in terms of the capital efficacy, we foresee almost in line with Symphony India.
All right, Mr. Shah. Well, thank you so much for answering all those questions very candidly, and thank you so much for taking our time and speaking with us at NDTV Profit. We look forward to speaking with you once quarter four numbers are out.
Thank you.
All right, moving on with the Ask Profit show. Our next query is from Manoj, who's writing in from Mumbai. He's bought Gensol, 200 shares at 400 a piece, and he wants to know as to what's the future looking like for something like a Gensol Engineering. Asta, I'll come to you on this one. He's not mentioned whether he's a short-term investor or long-term investor, but what's the view like?
The kind of news flow which we have seen in this stock definitely made the stock vulnerable at that moment of time. But right now, since the losses will be high, if I ask him to exit, then I think it is not the right thing to do at this point of time. So let's wait for some more clarity to come, or maybe results to come. Idea here is to stay invested in this counter till the results come at least.
All right, stay invested in the counter till the results come at least is the view coming in on let me check. Okay, our next query is on NMDC. The viewer is writing in from Jalandhar, and Anil is asking, he's already holding 20,000 odd shares from a shorter term perspective of NMDC, and he wants to know as to what should he do overall from a dividend angle. But since he's saying that he wants to hold this from a shorter term perspective, I take this up with you, Swati, first. What are the charts indicating for something like an NMDC, and then I'll come to Astha as well with respect to where dividends are concerned.
On the technical front, from the 2025 onwards, we have witnessed that the stock has stuck within the range of 50 to 60 levels. Within that 10 points, the stock is hovering around. Any breakout on either side will decide the clear trend of this particular stock, Mahima. But at the current level, looking towards the short-term view, I believe that the rally is likely to be extended towards to 70 rupees on the higher side. Means 6 points momentum we can witness for a shorter period of time. Downside, it has a very crucial support formed at around 60 levels. So as long as it's maintained the 60 levels on the closing basis, the uptick rally is likely to be continued. For longer term duration, the view is positive, but for the short to medium term, my view is a little bit cautious. So stay invested if you're looking for a long term horizon as such.
Astha, with respect to where dividends are concerned, should he continue to hold from a shorter term perspective or no?
Yes, I think he should hold. I think the first interim dividend they have announced for 24-25 year was ₹2.30. So I think it's better to hold this counter from the dividend perspective.
Okay, all right. Let's take the next question, and this one's on IEX. And Soumya is writing in asking about this. Soumya wants to know, she's bought at levels of 150, I believe, and so she's in the green. The stock is currently trading well above that, about 15-20% above that. So what's the view on the current prices front? Swati, on the charts, would you hold or would you book at this point?
Alex, my view is definitely positive on the technical front. Even though the client has bought at very attractive levels, definitely she should hold on the long positions. I'm looking for a target of at least the short-term target will be 200 and beyond at level 240 levels can be seen by. So on the monthly chart, the stock has given the breakout of a symmetrical triangle formations if you look on the line chart. And the volumes are slowly and steadily are increasing. So the overall setup is definitely positive. Hold your long-term positions for a 240 target. If you want any kind of a stop losses, try to keep a profit stop loss of 170 and hold your long position.
So with regards to IEX, the next question is from Dr. C.S. Reddy. Not sure, Astha, if you have a view on this one. Embassy Park REIT, he's bought 800 REIT shares, holding since 2019 and at an average price of 366. He wants to know what are the prospects with respect to this counter, if at all you have a view on this, Astha.
He should stay invested in this counter, looking after the kind of interest rate scenario which we all are witnessing. So now it is showing some sort of downside, and definitely these interest rate fall in the interest rate is also now banks have started passing it to the customers or consumers. So I think that will really positively impact all the real estate corner or real estate stocks as well. So I think looking after just the industry perspective, I recommend to remain invested in this company.
Okay. Mahima was just telling me that none of y'all are calling, and she's wondering why. She's reminding me to tell you that the number on your screen at the bottom is where you can call and speak to either one of us. The next question is coming in all the way from New Jersey, and I'm taking it first because Anuja is up late. Anuja, it is past 1 o'clock, 1:30 in New Jersey right now, so I'm taking your question first. You want to know about Bombay Burma and whether or not it looks attractive on the valuation multiples compared with peers right now, and is this the right time to enter? Astha, on the fundamentals, the stock is currently trading up about 3%, so it's doing well. Would you buy right now?
And from the valuation perspective, I think it is quoting the PE multiple of 11. While if I talk about the industry, the P multiple is quite high. So yes, from the valuation perspective, it is looking attractive because still it is quoting at a P multiple of 11 or 12. So yes, this counter is looking attractive from the valuation perspective.
All right, so that's the view with regards to where Bombay Burma trading is concerned. Our next question is from Lakshmi, who is writing in from Hyderabad. She's holding 40 shares of Axis Bank at 1183 a piece, and she wants to know whether she should hold, sell, or add at the current dip. Swati, I'll come to you on this one. What are the charts indicating for Axis Bank?
The chart is really looking attractive on the weekly and the monthly as well on daily chart. On every degree, the chart looks very positive. From the last few weeks, we are witnessing that the stock is trading in the upward rising channel. Also, the interesting fact that it's well placed above the important moving averages. So, and the Bank Nifty is likely to show very strong performance in the coming few trading sessions. And ICICI Bank, HDFC Bank, SBI, those will be the limelight counters which we are likely to be seen in the near-term futures. Upside target for a short-term period of time, 1180 and beyond that levels 1240 can be tested on the high side. So you should definitely hold on your long position on Axis Bank.
A lot of people have spoken about the prospects in the hospitality space, and really that's a space to look at very closely considering the kind of consumption boom that you're seeing. And Divash from Darjeeling in West Bengal is writing and asking about Samhi Hotels, which he's bought at levels of 153. So it's very close to the current market price, but he's wondering whether to hold for the next 1 to 2 years and what the prospects are. Astha, is this the best play in the hospitality space? Would you suggest holding on to this?
Not the best play, but yes, one can definitely stay invested in this counter because we are really liking Indian hotels at this point of the time. So we believe that if anyone wants to bet on the best counter, then Indian hotel is the right choice. But still, talking about Samhi Hotels, I think there is no issue and remain invested in this counter as well. So we are positive on this counter, recommending a hold with a price target of 185 to 1.
Yes, so hold is the view coming in on Samhi Hotels. The next counter that we're talking about is Natco Pharma. Santosh is holding 75 shares at 945 a piece, and he's bought it at elevated levels, so he might be sitting on a loss of a significant loss. Considering his holding is very less, he's sitting on a loss of around 11,000 odd rupees. But what are the charts indicating, Swati, according to you?
My chart is, as of now, we have seen a very strong correction from 1400 to 700 levels. Almost correction we have witnessed whatever the rally we have seen in 2024. Now, I believe the stock is under the consolidation phase. We have seen the price correction. Now it is the time correction phase is going on in this particular. We are likely to witness a consolidation phase for at least few more weeks. And upside, it has a very strong breakout of 840. If it manages to clear that breakout level resistance zone, then very soon we will see the counter entering into the 4 digits. So I'm quoting a target of 1000 will be the initial targets, and beyond that level 1100 levels can be seen. But hold your long positions for some more time will take to counter to achieve the target of thousands, and so for a longer term horizon, definitely you can hold on this particular counter.
Right, so that's the view with regards to Natco Pharma. We have our next caller. Shweta is calling in from Hyderabad. Shweta, very good morning to you. How can we help you?
Hi, Mahima. Good morning. Just now, Alex said there are very few callers today. I thought I should call and say hi to you.
So sweet of you. Thanks so much, Shweta.
Yeah. Go ahead with the query, Shweta.
Yeah, my question is regarding whether is it the right time to buy Trent at current levels?
Okay.
I would like to know for long term.
Okay. Shweta, got your query. I'll take this up with Astha. Astha, valuations were never cheap and are not getting cheap for Trent, going ahead as well, as compared to, they're slightly cheaper as compared to how they were a year before, but still not cheap as compared to the peers as well. But the growth prospect also is slowing as compared to how it used to perform in the past few quarters. So what's the view like? Should she enter right now, considering the kind of growth it has shown in the past 2 quarters, or she should wait for some more downside?
So one of the edge which this company is having over its peers is that the continuous store opening which this company is doing. So they are expanding their footprints. That is the major thing which we have seen. But yes, valuations are high. And right now we are in an environment there is little bit uncertainty. So my idea here is don't invest the whole lump sum amount. Just invest 30% of whatever amount you want to attribute towards this buying, and don't invest the whole amount at one juncture. This is what I want to suggest at this point of a time. Trend is looking good from the longer term perspective, but we don't know about the market's volatility. So better to invest just 20 or 30% of the amount which you have decided to invest for this.
Okay, very quick view on Vadilal Industries. This is Satyan's question. He's bought at levels of 2,200. He's asking whether a book profit, and if so, at what price? Swati, on the charts, what would you say?
I will suggest to hold on this particular counter because it's really doing very well from the last 2 months. I'm looking for a target of at least 6,000 Alex, and beyond that level 6,200. If you want to keep a profit stop loss, 5,400 is acting as a very strong supports level. So by maintaining that as your stop loss, you can definitely hold on to your long positions.
Okay, all right. So we've got our next caller, Anand from Andhra Pradesh. Hi, Anand. Thanks so much for calling. How can we help you today?
Yeah, hi Alex. How are you?
Very well. What about you?
I'm happy to. Yeah, I'm also doing good. Thank you for asking. And I'm pretty happy to connect this call. And I just want to know the share like EPAC Durable. I have bought these 40 shares around 430 price. Okay, so I'm in a loss of around 10%.
Yeah.
So just want to know like whether I need to hold or I need to exit, or do I need to add any some other quantity? Do I need to add?
I got your question. Anand, can you help me with the time frame that you had in mind when you bought it?
Definitely. Yes, definitely. So from like 6 months back, I have purchased. So I can able to hold up to next 6 months also. I can be able to hold.
Okay. So you've got a relatively short-term view on the stock. The stock is, by the way, up and about. So you must be a little happy today. The stock is at upper circuit today. So it's making a strong recovery. Swati, on the charts, what is the upside potential for EPAC Durable at this level?
Yeah, as of now, we are witnessing a consolidation phase in this particular stock, Alex, within the range of 350 to 400 levels. Within 100 points, 50 points, we are witnessing but I believe that very soon you are likely to we are likely to get a breakout in this particular stocks. There is no need to average it out because at the current market because price will not come down very drastically on a downside, since you have a buying price at around 430. If you average it out at the current market price, the average price will come down to 415. So there will no major impact as such. So just try to hold on your long positions. Very soon you will see the targets of 460 to 480 levels. At that point of time, you can book your profits. But at the current market price, I will suggest to hold on this particular stock.
Hold is the view coming in on EPAC Durables. Our next caller, Madhu, is calling in from Bengaluru. Madhu, a very good morning to you. How can we help you? Hi, Madhu. Have we lost her? Do we have you, Madhu? Okay, I think we've lost her, but we have her query. She's holding 85 shares of Polycab bought at 3,600 a piece, and she wants a view with regards to where the fundamentals are concerned. Astha, I'll come to you on this one. What's the view like for something like a Polycab?
I just want to know the cost price.
It's 3,600.
So I think first of all, the cost price is at the lower level. So that is really a relief for this counter. So my idea here is to book partial profit in this counter, because although this counter is one of the leading, manufacturer in cable and wire industry, but the kind of news flow which we are witnessing in this counter definitely making it vulnerable. So right now, it's better to book partial profit and just see how the things pan out to be. And maybe we'll get the lower level again to enter into this counter after seeing the results.
So I know that it's going to be challenging, but Astha, this is a quick question that you need to answer. 4 to 5 stocks that you would buy right now that have corrected quite substantially, that have potential upside. Kusuma wants to know, what are your top stock recommendations given the correction from September to now?
So I would really like to go with the A category stock as of now. And in that, in the banking space, although they have not corrected a lot, but still, Axis Bank and Bank of Baroda, these two counters are looking good to me at this point of the time. So these two are in the banking space, and in the power space, again, Power Grid and NTPC, they are, and Coal India as well. So these are few of the counters which I would really like to go right now, looking after the current market conditions.
All right, it's time now for the rapid fire segment, and this is where, ladies, we throw as many questions at you over the course of 2 minutes to answer as quickly as you possibly can. The first question is from Dinesh, asking about ITC hotels for a period of 6 months. What are the prospects? I don't know if you have enough data. Swati, would you buy at this current juncture?
Yes, definitely. This is the very strong counter we are looking for. I'm looking for a target of 230 to 240 level. So you can buy on deeps towards to 190 level, but not at the current market price.
All right. Praj Industries is the next counter. Naman from Kolkata is writing, and he wants to know from a longer term perspective, what's the outlook like? Astha, your view?
Longer term perspective is looking strong to us. Stay invested in this counter if one has a holding with a price target of 540 to 550.
Okay, Indocount Industries is the name of the counter. Shiva wants to know, holding 100 shares at 288. Short-term view is being sought. Should he book right now? Swati?
Short-term view is a little bit cautious if you want to book the profits. Sell on rise towards to 260 levels, but not at the current market price. You can hold on the long position.
Okay, Muthoot Microfinance. Rajesh Patel has bought 300 odd shares at 240 a piece, and he's a long-term investor. What's the view like, Astha?
Maybe short term can be a little bit painful, but in the longer term, one can remain invested.
Will Bank of India touch 150 plus levels? Is it good to hold, and for how long? Swati, what's the view?
Yes, my view is positive for a shorter term duration or longer term duration. I'm looking for target of 120 to 130 levels. You can maintain the profit stop loss of 100 rupees on the downside, and you can hold the long position.
Okay, Nidhi from Ambala has 1,000 shares of Yes Bank at 22 a piece, and she has a horizon of 12 months. What are the charts indicating? Should she buy more at the current levels, or should she hold?
I'm not much bullish on the Yes Bank at the current market price. I will suggest to hold your long positions, but keep a strict stop loss of 16 rupees on a downside. If you're getting any rise towards to 20 and so, try to exit out positions and try to switch on the positions into the SBI, Axis Bank or HDFC Bank.
Swati, NHPC, very quick, bought at levels of 85.5. Rishu wants to know, hold for a year?
Yes, you can hold on with a stop loss of 80 rupees upside. We can look towards to 95 to 98 rupees on the high side.
On that note, Swati, Astha, thanks so much for joining in, as always, and taking all the questions you did. Pleasure having you. And that brings us to the end of this edition of Ask Profit from Mahim and myself and the team that put the show together. Thank you so much for watching. Up next is Know Your Company, so do stay tuned. This is NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to KYC, Know Your Company. Today we're going to focus in on Morpen Laboratories. Interesting play. It's an interplay between pharma as well as medical devices, has good revenue distribution across the world. But let's quickly zoom in as to what the company does. Morepen Labs, it manufactures, produces, develops and markets a whole host of products. Let's talk about them. One is APIs, which is active pharmaceutical ingredients. We'll talk a little bit about what APIs are. Branded and generic formulations is the other piece that they do, and home health products is the third piece they do. So if we were to categorize into two baskets, one is pharma, one is medical devices, but otherwise these are the three different streams that they deal in. Let's talk about active pharmaceutical ingredients first. What's an API? It's a substance within a drug formulation that produces the desired physiological effect. So for crocin, it helps you alleviate fever. Basically, the drug which allows you to do that is an API. It allows for pain relief, for reducing inflammation, or targets a specific pathogen in order to repair whatever is the concern in your body. In terms of quality and potency, that really determines how good the medication therefore is. So API is critical in the drug to ensure that the cure that you are looking for is actually being found. That is what an API is. So Morepen manufactures API. It's a leader, especially in anti-asthmatic, anti-allergy and cholesterol related APIs. These three APIs it's a leader in terms of supplying. Now let's talk about the branded generic formulation. This is where better margins start to come into play. This is actually developed after the patent for the original drug expires. So once the original drug's patent expires, you will have all sorts of generics which will enter the market. Within that, branded generics will always command a slight bit of premium. So you might have, for fever, you might have a Dolo, you might have a Crocin. Both of them are branded generic drugs. That's what Morepen has also ventured into. And they brand it to ensure recall, of course, and therefore customer preference. The last piece is home healthcare products. So, okay, branded generics, Bernol is one of them. The other one is Lemolate, which takes care of cough and cold. So these are couple of products within the branded generic space
that Morepen does. Now, last one is with regard to home health products. These are medical devices which the company sells. It manufactures and sells several devices, and some of them on your screen. It includes thermometers, pulse oximeters, blood pressure monitors, and the like. So a whole host of products is what they do, including glucometers. These are just some indicative of the various other products that the company does. Now, in terms of business split, it does 70% pharma currently, 30% medical devices. That's how the business is split up. Where do they sell? Let's pull out the geographies as well, and that's how they are split up. 30% India, 70% rest of the world. Asia plus India is roughly 56%. Europe contributes 21%. USA is just about 16%. That might be impacted by tariffs as well. And the rest of the world is just about 7%. A higher share here will ensure better margins as well. So something to keep in mind. It manufactures and operates 2 manufacturing units out of Himachal Pradesh. That's where all of their manufacturing happens. But so we'll try and break this down. Of course, we'll break this down metric wise as we always do, and let's quickly talk about those metrics. We'll first talk about the income statement, the balance sheet. We'll also talk about cash flow, return ratios, shareholding, street cred. We'll talk about valuations, and last off, we'll speak about the outlook and what the guidance is. And joining me today to help me break this down is Hiral Dadia. Of course, Varsha Chandani generally covers pharma but is absent, and therefore I'm in the esteemed presence of Hiral. Hiral, let me allow you to start off with income statement.
Thanks, Harsh. I mean, it's an interesting company to watch out for. Reason being is, from medical devices, they've moved to APIs and other pharma products, and now all of that accounts for nearly 70% of the top line, as Harsh was mentioning. But let's quickly look at the financial matrix overall. Now, if you see in terms of the revenue, from 1,547 crores in FY22, it's moved to around 1,690. So in terms of the revenue growth, it's around 19.5% in FY24. No major, I mean, in fact, it's taken a downtick if you have to compare to a FY22 number. But let's be precise that yes, their foray in terms of the medical pharma business is what probably is leading to these kind of numbers. In terms of the margins as well, I mean, the trajectory from a 9%, it took a drop to around 6% in FY23, bounced back again to 9%. So if you have to compare the last 3 years, pretty flat, no major changes that have happened on that front. And the profitability, interestingly, is still lower as compared to FY22 at around 97 crores, a marginal 4 crore difference, 4 to 5 crore difference. But I mean, compared to FY23, yes, it's an upbeat number. So overall, the 3-year revenue CAGR, if you have to compare, it's at 12%, flat in terms of the profit number. So that's something which is on a neutral basis. And if you have to compare the 9-month FY25 performance, let's look at that one. Revenue 1,346 crores, EBITDA of around 132 crores, and the net profit number is at around 98 crores. So you might see a marginal uptick probably this time around, and if not, if they have to follow the same CAGR trajectory, Harsh, I mean, it will be a flattish number once again. So I mean, it's a neutral number coming in so far if you have to look at the 9 months period as well.
Yeah, I mean, fails to enthuse enough, Hiral, especially on a small base for a 3,000 crore market cap company. You'd want a faster clip. That's what
faster clip on that front. And second aspect is with the trajectory they have in terms of the next 5 years. With these kind of numbers, how are they going to be able to achieve that? Guidance is going to be key to check with the management if you have to talk about the top line, bottom line and the margin front.
Yeah, absolutely. And we'll talk about that in the outlook as well, and we'll quiz management. Let's talk about the balance sheet. Now, in terms of how that's stacking up, you have around 1,000 crore odd of reserves. Mind you, the reserves of 1,000 crore, while they look very impressive, some chunk of that is also coming due to the fresh issue that they've done this year, which is in, beg your pardon, last financial year. And in August of 2024, they've raised around 200 odd crore. And otherwise, shareholder equity is at roughly 1,100 odd crore in total, including equity plus reserves. Your long-term borrowings are far and few. Short-term borrowings also not a concern. Cumulatively below the 40 crore number for a 3,000 crore market cap company, not really much of a concern. They have around 50 crore rupees in cash. Why have they done the fundraise in August? And this is slightly critical in that sense. They've done it. They've completed the QIP with regard to and trying to push with regard to medical devices and API business on the growth count. So they're trying to, it's growth capital basically that they've raised, and they are also enhancing capacity. So their capacity enhancing plans will start to impact the numbers both on the P&L, which Hiral discussed, in the next 18 to 24 months is what they're saying. December is when they actually kick-started the investment process. So maybe 18 to 24 months from there. But we will ask management on that count as well. So the first two metrics covered. Hiral, cash flow.
So cash flow, again, if you see, it's an interesting number because if you see the net cash flow, they are at around 28 crores, right? And with that, if you have to look at the cash flow from operations, they have turned positive this time around at 73 crores in terms of FY24, wherein the last 2 years, 22 and 23, have been on a negative scale, a negative 60 crore number and a negative 91 crore number. So somewhere the CFO is, the cash flow from operations is positive, but the net cash flow is something which is interesting because from a 28 crore positive number in FY21, they've gone down to a negative number of 5 crores. So overall, again, it's a very neutral number coming in there because now they are raising funds as well. So whether the money is coming in from outside, but what is the business doing in terms of generation of funds is the key aspect over here, because if that is going to be dwindling, you know, where is the money coming in from in terms of business?
Yes, absolutely. So something to be considered and taken care of. Cash flow from operations getting better, but your net cash flow still negative or muted. Need to possibly see a change there. Let's talk about return ratios though, and that'll come up. Basically, what we've seen in terms of a trend is we saw return ratios fall off a cliff in 2023. They've rebounded a bit in FY24, but mind you, FY25 has a fundraise in place as well. So you might see return ratios remain capped on that count because there is a fundraise, even though we've seen a bit of a bounce back with regard to return ratios, nowhere close to a 20% number. But when we're looking at possibly the return on equity, also very similar structure. And therefore, you might want to keep in mind that maybe for the next year or two, your return ratios may not rebound back to maybe a 20% number. Therefore, a neutral on that count, while we've seen a rebound, a decentish kind of a rebound, a mid-teens to a higher teens ROC, Hiral, not too bad, but you'd want more from a smaller company. And of course, they're investing capital straight back into the business. So maybe something to look out for where return ratios.
So I think what you're saying is that the mid-teen number that could come in the next year or two, probably in a case-by-case basis, could be a positive, but a bounce back to 20 kind of a number is not going to be possible.
Looks difficult at this point. Correct. Unless there is some significant
and if 20 happens for whatever reason that the management could be confident of, I think then it could be a re-rating candidate then. But as of now, you're still looking at something of the possibilities so far. But let's look at the shareholding pattern as well. What's interesting is no major FIs, DIIs are holding this stock. It's remained absolutely stable. I mean, from a 2.08 from an FIs, it's gone up to 1.94. I mean, gone down to 1.94. DIIs have also remained stable in the last 2 to 3 quarters. Public holding has also remained stable, right? So nothing major that has changed with regards to the shareholding pattern. And with FIs and DIIs not having skin in the game as well with regards to Morepen, I think that seems to be concerning for me when I have to look at the company, because I mean it's absolutely dependent on what the public does. Now whether this 60 to 61% of the public shareholding has the confidence in the 35-36% of the promoter shareholding is what we need to see, because the promoters are confident in terms of the growth outlook. But execution becomes key, achieving that guidance becomes key. So that correlation is going to be interesting, but again a neutral because of no FIs, DIs increasing their position.
Correct. And that too, but also Hiral, some context, because it's a 3,000 crore market cap company. You wouldn't see too much FI, DI participation in companies that small as well. So if it is a re-rating candidate, you could well see some upside coming from there as well, if it were to re-rate or become a multi-bagger of sorts. So you might want to keep that in mind as well.
Absolutely, and that's the reason why a neutral right now, because
yes.
if the opportunity is there, you know, the FIs or the DIIs are going to jump onto it.
Correct.
So whether that opportunity comes in or not is anyone's guess.
Absolutely. So, but interesting play on that count with regard to where shareholding is concerned. Let's talk about street cred very quickly. It's down 41% or rather 42% in the last 6 months. The last year or so, the performance has been decent, up 16 odd %, and the last 5 years also the performance has been decent, up around 243 odd %. So it's been a multi-bag over the last 5 years or thereabouts. What you'd really want to look for though in the near term is the kind of pain that shareholders have already seen. The last 1 month to 6 months, we've seen plenty of pain. Even year to date, the stock is down 33%. So it's lost a third of its market capitalization just in the year to date period. Something to be looked out for, especially in the short term, we've seen pain. In the long term, we've seen decent returns. So neutral on the count of street cred. Hiral, you want to take up valuations?
It's an interesting play in terms of valuations because cheapest of the lot. I think if you have to compare it to a Morpen or a Aarti Drugs, Shilpa Medicare and the Supriya Life, I mean 22 times, that's the trailing 12-month price to earnings that we're considering. So in terms of valuations and the opportunities and the guidance that the management has given, it will be a thumbs up because it's cheap in terms of valuations. But where from here on, whether we are able to see that scale up happening is going to be crucial. So as of now, the stock looks attractive from a valuation perspective, Harsh.
Right. Interesting now in terms of outlook, because such positive commentary coming through. They're targeting a 5,000 crore top line. For context, they've done sub 1,700 last year. They're targeting 5,000 crores in terms of top line by 530. The margin, which is sub 10%, is expected to be mid-teens by the end of this FY30 kind of guidance period. They're going to do new products which will drive growth. The new products span across the board: medical devices, over-the-counter medicine, nutraceuticals, all of those. They are expecting growth rate of anything between 10 to 15% in the coming years. They are aiming to maintain that 70-30 ratio in terms of exports to domestic sales, and they are looking at higher margin products to aid profitability going forward. They are focusing in on expanding the medical devices segment and enhancing the product portfolio in pharma and O2C categories, so OTC categories, I beg your pardon. So those are basically the spaces in which they are focusing in on. Let's quickly look at the final rating on this one. Let's pull up all our rating parameters and quickly have a look at it before we speak with management. That's how it's shaped up. Income statement neutral, more asked for from a growth perspective. Balance sheet, cash flow, return ratios. When you're looking at shareholding, neutral, street cred, neutral, valuation, clear thumbs up, and outlook also very, very positive. If they were to actually follow through on outlook, you'd see a largish kind of upside likely on this one. 5.5 on 8 is the KYC rating on this. A 5,000 crore top line, Hiral, 15% margin, 750 crore will be the EBITDA with near zero debt. And trading at 3,000 crore. It's virtually trading at 4 times EBITDA. So likely the opportunity is large. But let's actually go to management, ask them how likely is this.
And then how can you get probably a 6 or a 7 on 8 on a KYC in the near future is the question.
Yeah, they will do that once they start moving towards that number of 5,000 crore. But Sushil Suri, CMD at Morepen Labs, joining us for exactly that and trying to understand exactly that. So I want to first start off by understanding from you what the revenue split will be. FY30, you are guiding for a 5,000 crore top line. How certain is that, and what will the revenue split be like at that point?
Good morning to both of you. So revenue streams, I think you rightly guessed and just heard the little KYC of mine. I could see that. So I think the interesting point here is that revenue streams are going all the way, whether it is the finished dosage or the medical devices. So I am not saying the revenue mix will change per se, but the growth or the rate of growth is going to be more productive. So if we start from the first part, first thing first, which is our API business. API is our core business. So give or take few 100 crore, a few 50, 100 crore here, and that's a 1,000 crore business. So it will keep growing between, I would say 8 to 10%. At a CAGR of 8%, it had been growing. But on the other hand, medical devices, despite ups and downs because of the COVID, it has grown 15% CAGR. So we expect medical devices to continue at 15% CAGR. And of course, the overall expectation is much more, but 15% CAGR we are still maintaining. And the interesting point...
So I'm sorry for interrupting, but sir, what gives you that confidence? Because the last 2 to 3 years have been difficult. What changes in the next 5 years that gives you that confidence that you'll go 3x on top line?
I'm saying on the CAGR front, I have grown 15% in medical devices.
Sure.
Despite ups and downs.
Sure.
So sometimes it was 45%, then it was an overstocking during the COVID time. Next year it dropped. Then again, last year it was 35% growth. Now this year it may be in between, I'm not giving the number as yet because the results are not out, anywhere between 10 to 15% this year again. So but CAGR is 15%. So we always see that market inventories change. Import, export positions change, but overall, if we keep on year, we are growing, we are okay. In medical devices, the growth, if we particularly talk about, let me complete the whole thing first. And the second opportunity we have seen is in the finished dosage. Finished dosage, last 5 years, we have got a CAGR of 22%, which is, I'm happy to say, which is matching with the so-called India finished dosage market. India market, the big players have been growing between 10 to 11%. The market is now more than 230,000 crores. So I remember when we started finished dosage, it was just 20,000 crore. It is already 10x now. So now the two major drivers, what we are seeing is, one is the finished dosage, wherein we are naturally a new player and we are a small player. We are not ranking even in the top 100 companies. So that is where our one expansion is going. And we are trying to match with the speed of the market. And we have recently gave an announcement also to the stock exchange last week regarding hiring 1,000 people in the new medical representatives. The whole idea is that we should catch the finished dosage revolution. Now, where is this finished dosage and formulation coming up? That's related with the overall India story, that healthcare is expanding. So thanks to insurance, thanks to, I would say, the new hospitals, the corporate hospitals have just started in India. So the expansion, if you try to relate healthcare versus pharma, we are going hand in hand. The more hospitals are opening, more pharmaceutical companies are coming, more new products are coming. And interestingly enough, even the digital health, which was unknown few years ago, this is growing at 10x rate. From just 2.7 billion, it is projected at 37 billion by 2030. So the massive expansion which is happening in healthcare, it is all translating in the pharma. Now, within the pharma space, I'm not being very generic. I'm not saying antibiotics will grow. Now, which segments will grow, which territories will grow, that is a matter of detail. I don't think we can detail in this platform. But primarily speaking, medical devices is an absolute new score, which nobody in the country had thought. We thought of it 20, 25 years ago, and we have been able to create a story of 500 crore rupees brand without any much advertisement. And now we are at the roots of the country. We are available in almost each and every city, all over the country, distribution. We still have a lot to cover, I would say. We still have to cover a lot in the east and south. But we are seeing the growth coming up in the medical devices. Again, medical devices is more of a compliance issue, affordability issue, detectability issue. So if we look at the pharma numbers, cardiac and diabetic, both are growing 11% CAGR in pharma market, finished dosage market. If pharma market is growing, I don't think I can't grow at the same speed in medical devices. Medical devices is much better, much higher, because more and more people are getting used to the testing. Thanks to education, thanks to awareness, thanks to digital, thanks to, I would say, mobile phones, everybody is using more and more devices for the testing. And I can't...
Sorry, I'll interrupt over here. You know, you're talking about the medical device business, which is growing faster as compared to the pharma business. Then why the pivot from devices to pharmaceuticals? Because that's where your monopoly was. Because I was just talking to Harsh some time back that I remember covering Morepen years ago, and that was one of the only device companies that we would talk to. So why that pivot, number one? And two, when you're talking about your formulation business, which is currently valued at almost 325 crores, you're planning to grow it to around 1,000 crores, and for which you've deployed around 1,000 number in terms of sales force. So two-part question. One, why the pivot from a business which is high margin driven, and two, formulations which is still growing, where it could be it could probably impact your margins negatively, taking into consideration the kind of expansion that you have to do. How does it augur?
Sure. I think we debate these questions every day, but I have to be a little more detailed. What's happening is that Morpen has a core competence of API. Of course, leave aside the medical devices for a moment. As an API player, we have all the international approvals. We have got FDA approved facilities. We have got latest products. We have got the product knowledge. We have got the R&D. We have got the finished dosage development. But our front end is very, if you want to use the word, weak, because we are only an API player. So I always have to go virtually, I would say, beg to the pharma companies that, okay, you take my product, launch my product. And naturally, as a B2B player, so I am at the mercy of the finished dosage player. So now, as it's a well thought of strategy that I have to go more closer to the consumer, as close as possible. So all the pharma companies in India, if we study, I would say more than 70 to 80% of the companies are finished dosage companies. So I'm not saying that there is any pivoting. We are already doing finished dosage. So now finished dosage is around 27, 28%. Obviously, we want to take to a higher value. And the finished dosage gross margin is around 70%, while API gross margin is around 40%. I'm not giving exact numbers, but between 70 and 40. So the higher value addition gives more revenue to the company, number one, and it gives higher brand value to the company. And more important is I reach directly closer to the consumer. So what is happening for the API team, I get a direct feedback from the doctor. I get a direct feedback from the customer.
Right, Mr. Suri, we are running slightly short of time, but my key question over here is, to meet a target of 15% in terms of EBITDA margins in the next 3 years, right? How are you going to achieve that? Because you're already spending in terms of expanding your formulations business, which is around 325 crores now, out of which 1,000 crores from your 5,000 will be coming in from there. So how are you going to achieve that? That is the key question, because if Morepen has to be a candidate for investors to invest in, the investor needs to understand how are you going to achieve that?
Good. I think in case you just quickly scan most of the pharma companies who are leading in the finished dosage, I would not say the big players, whether it is Cipla or Sun Pharma or Mankind, or for that matter, even including Divi's, their EBITDA margins are 20 plus, sometime even 27. So we are not targeting 20 plus. I'm only saying 15 because we know that we still have a B2B portion and we still have to invest in the growth part. But finished dosage market margins are generally higher. It may take 1 or 2 years, I would say, the seeding time. But long term, we are going to get to the margin 20. But that 20 may be more than 5 years away. But the first 5 years, we just want to remain at high teens, I would say. It's 15, 16. But as compared to 27, 28, I think 15% is realistic. And it's a bundled margin. I'm not saying now for the last year, medical devices margin has already reached to 15. So we are okay with that.
Mr. Suri, exports will drive margins is what you're saying. Your US exposure is around 16%. Do tariffs impact loom in terms of the margin trajectory or not?
Fortunately for us, our US exposure is only 6%. So we just have 120 crores of export as against 1,800 plus crores of revenue total.
Okay.
So 2% export is not very high. And on the lighter side, I would say that whatever US is trying to do, whatever Mr. Trump is trying to do, so India, or as particularly I would say as Morepen, we are already there. We already have a fully integrated system. We are into API, we are into finished dosage, we are into R&D, we are doing our own market, we have our own capital consumption. So we are not much worried about the global scenario per se, because we are not even free from our existing things. We are expanding capacities to feed even the existing markets. So I don't think we are much dependent on particularly the latest market scenarios. But yes, everything counts because ultimately we have imports from China. So hopefully China should reduce prices, because if nobody else is buying from them, we may be the customers. But we are keeping those things open. We are exploring. But as on today, we are expanding capacities to feed whatever we have in hand. We are expanding capacities in medical devices. We are expanding capacities in finished dosage. Was increasing the marketing teams. So far, I would say we are comfortable.
Right. Thank you so much, Mr. Suri, for breaking this down for us, giving us all of that perspective, but completely out of time on this edition of KYC. From Hiral, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action right up on the other side.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome. Good afternoon. This is Markets at 12 and I'm your host Malika Mishra. Financial markets across the globe seem to have taken a breather after Trump announced a temporary 90-day pause from his reciprocal tariffs and also hinted at discounting some electronic and auto components from import duties. Indian markets opened strong with the Nifty 50 over 2%, which continue to trade with similar gains and is testing 23,300 levels as we speak. The 30-pack Sensex has been following a synonymous trajectory, trading with gains of over 2% and is now hovering around 76,700 levels. Broader markets also seem to be following the same trajectory with the Nifty mid-cap 150 and the Nifty small-cap 250 above 2% as well. If you look at the top contributors to the bullish momentum today, you're seeing in the Nifty 50 basket, heavy private bank counters like HDFC Bank, ICICI Bank, L&T, Reliance and Bharti Airtel emerge at the top of your screens, with HDFC Bank alone lifting the index by over 100 points. The marginal pressure you see is being enforced by some FMCG companies like Trent, HUL, Sectoral, Nestle, and Tata Consumers. Some of the top gainers in the Nifty 50 basket in terms of percentage are IndusInd Bank up above 6%, Adani Ports, Adani Enterprises, Tata Motors, Larsen & Toubro, M&M, Axis Bank, Shriram Finance. These are counters that are gaining high and above in trade today. The sectoral picture, if you look at the sectoral heat map of the Nifty 50 basket today, you will see that all the sectors are in the green, with just FMCG down about, drooping by 0.19%. Nifty Realty, on the other hand, is a top sectoral winner at the moment. It has in fact risen over 4.5%, the highest level since April 4th. The advanced decline ratio looks good too, with over 1,900 stocks in favor of the bulls and less than 150 in the bear territory. But viewers, as gold uncertainty continues to keep markets nervous, there is one asset that has remained relatively formidable and strong, and that is gold. Gold prices are up nearly 50% from early 2024, reflecting the resilience of the yellow metal amidst a period of high volatility across the globe. To discuss how safe is the safe haven asset, is there still more legroom to go, what's driving the confidence, and a lot more, I'm being joined by Naveed Damani, Group Senior VP, Head of Commodities Research at Motilal Financial Services. Welcome, Naveed. Thank you so much for joining us in this conversation. My first question to you would be, where are we currently positioned in this rally that we have seen in gold? Is it already done, or there's more legroom to go?
Well, thank you for having me on the show. And as you mentioned, that safe haven, is it still a safe haven, or is it a kind of a return generating asset? The question is the latter one, because over the last 4 years, we've seen gold prices run up by closer to 100%. For the last 1 year, closer to about 45% on the international front and closer to about 50% on the domestic front. So this has taken a lot of investors into surprise, and most of the participants who have been part of the rally are pretty comfortable, but a lot of FOMO is developing, and people want to participate in this rally, which could they expect to extend toward 3,500, 3,700, and probably on the domestic front prices to touch even 1 lakh rupees. But as you asked, where are we at this point? I think most of the tariff-related concerns or the development which has led to the last leg of rally is already into the price. We were bullish until $3,150, $3,200, but as of now, we are sitting on the sideline and waiting for some clarity over how this thing is going to unwind with China, with other parts of the world.
Good afternoon, Naveed. Nika joining this side. You spoke about how a lot of the tariff uncertainty is priced in, but if the past 2 months have been anything that's not uncertain, so do you feel a lot of this rally has happened because of uncertainty? Once that maybe dies down, which is what you're seeing right now, at least for the next 90 days or so, do you feel you could see a slight correction in gold, or are there other fundamental factors that could keep the rally moving?
Well, a lot of fundamental factors are already in the price, and it is largely that the exuberance that you're seeing is related to tariff, and the recent one being connected to what is happening on the bond yield front, because we've seen bond yield swinging from as high as 4.4% for the 10-year to 3.67%, and now back to about 4.5%. So what typically is happening is a lot of international central banks are selling US Treasury or dumping US Treasury. As Japanese central bank is a big holder of these bonds. Chinese central banks are big holders of these bonds. Out of the 750 billion worth of holding, they've offloaded about roughly 50 billion worth of holding. Same goes for Japan. So these kind of central banks kind of want to dump the holding. This is one of the pressure tactics they are using to fight the tariffs which are being imposed on them, because US has got a massive debt servicing problem. And if this problem has to be handled, then bond yield have to come lower. So with this kind of bond yield, it is very difficult for the US to survive in the current macro environment. And this is going to lead to higher inflation as well as a slowdown in the rate cut process which US was banking on for the year 2025. So all in all, positives are largely into the prices. What we are seeing is a little bit of exuberance. What we are seeing is a little bit of macro fundamental being changed. But this will come to a standstill 2-3 big players which are involved in the tariff come and sit on the table and discuss the way forward. It will happen 5 days from now, 50 days from now. We have no clarity. But whenever that starts to happen, you will see a reasonable to healthy correction in gold prices.
So what is your current target? Because you're saying a lot of factors are already priced in, and right now there's just a lot of uncertainty that has led to the rally. So what are your target levels? Do you feel that like you said, you might see a correction, and what would be a good buying point for an investor who wants to get into, because you don't want to get into at a peak, right?
Absolutely. So we were anticipating $3150, $3,200 by the end of 2025, but that has happened in the first quarter of 25. So now what do we do for the rest of the year? I would probably wait for a reasonable dip, and by dip I would mean at least 8 to 10% correction is where we see comfortable levels to buy gold once again, because we've seen a correction coming into silver, correction coming into base metals, into energy prices, just by mere news of there is going to be tariffs on China. But this has led to upside in gold prices. But the similar situation can happen in gold. The kind of correction can come into gold also once you have a settlement, or once you have a clarity over how these things are going to unwind. In the last year, 2018, also we saw a tariff war between China and US, which took about 1.5 years to unwind to a very large extent. If that is the kind of quantum where we are looking at, I'll not be surprised to see gold prices at $3,300, $3,500 or over 1 lakh rupees on the domestic front also. But I will be happy to miss that last leg of the rally. But if investors want to buy gold for a medium to long term perspective, wait for a correction towards say 80 to 85,000, or at least 10% from current level, for an upside target towards 1 lakh and above.
So Navneet, just for a slight correction, 8 to 10% correction is what what you want for gold to be at an attractive buying level. Any 2-3 factors that we need to watch out for that could lead to that correction?
Well, we've seen dollar index under severe pressure. It was 106, we say at the start of the last month, and it is now, as we speak, it's closer to 99. So dollar index is kind of at a level where we have not seen it for the last 7-8 years. So my sense is that another 150 basis point is where I see max fall in the dollar index, and then it will start to rebound. Second factor is that if US decides to cut rate, come what may, given the backdrop of macros, keeping that aside, and if they decide to cut rates, that can also be a trigger where you will see a pause in this run-up. And third factor, the third largest factor is a settlement calendar or table which is on place with US, with China, with US, with Russia, and the rest of the world, where massive tariffs have been imposed. So if this kind of clarity emerges, then the 8 to 10% correction could be in a very short span of time. But for investors, once prices come down crashing, they will again be confused that whether to invest or not. My sense is that you could start to invest into tranches if you have a reasonable correction in prices. At these levels, if you have a 5-year horizon, then it makes sense to be invested. If you have a very tactical or a short-term view, probably any rally from here towards 93,000, 95,000 is somewhere the levels where you should be looking to book profit in your existing investment.
So, we've covered the correction triggers, but, you've seen central buying, which is still, going strong, even as per your February report. And their Fed rates, there is some uncertainty of the rate cuts, but, even US President Donald Trump has stated that he wants lower rates. And these are generally triggers for the price uptick. So how does that come into play?
Well, central banks have been moderate buyers. They've not been very, very aggressive. China, something like China, who was in a zone of 2021 or maybe before that in the zone of buying, say anywhere between 600 to 1,000 tons worth of gold, is buying about 12 to 16 tons worth of gold. So the quantum has gone down very significantly, and at such high levels, most of the central banks will probably are in a position that if there is a bargain buying on the table, then it is worth it, but otherwise they're not very, very aggressive. So smaller quantities are definitely getting added, but the chunk that we are used to seeing as central bank buying is no more the scenario. As far as rate cuts are concerned, your question to rate cuts is definitely a factor of treasury yields coming down, as well as inflation being moderate. With these kinds of tariff, inflation cannot be moderate. They have to grow up, with these kind of tariff, growth slowdown is inevitable. So these two factors are at play. Ideally, there shouldn't be any major question of rate cuts in the near future. But as President Trump has it, if he has used some pressure tactics and probably pressurizes for a rate cut in the near future, then that could be a knee-jerk reaction to kind of decouple the current momentum in gold prices.
Now, Navneet, last question. I know you're speaking on gold, but silver is also something that saw a strong uptick, last year, and it did so in the start of this year as well, but the corrections come in. Do you think it would be better to buy into silver right now, or is gold still more attractive in terms of, your returns versus silver?
Oh, absolutely. Silver is giving par returns with gold in the year 2024. But as the start of the year 2025 also, they were pretty much in hands in glove. But ever since these tariffs have been imposed on China, silver typically is largely an industrial metal today, more than a precious metal. So everything came down crashing. Prices corrected by about 17% from peak on the international front, and on the domestic front also. 1,02,000 came down crashing towards 85,000 levels. Off late, they have seen a reasonable bounce of about 10% from low. My bet is that silver is a better bet. We will see levels of 1,10,000 and 1,25,000 in the next 12 to 18 months. But mind you, silver is a volatile asset. Silver typically is not for investors who are looking for a fixed asset kind of a return. So something like gold is typically a safe haven buying, but silver is a naughty one. It keeps you volatile. So a tactical investment between mix of gold and silver can be done, where a larger component today can be done in silver, given the price correction that we've seen in anticipation of 15% upside toward 1,10,000 rupees.
Okay, thank you so much for your time, Naveed Damani, and we definitely appreciate your perspective and clarity that you brought us on gold. And we will see you again, but thanks for that commentary. And, moving on, viewers, in a relief for auto companies, US President Donald Trump has announced that he may pause the levy of 25% tariffs on foreign autos. Nifty Auto, in fact, has been gaining over 3% on the back of this announcement. And Mika, give us more information on this front.
Yeah, we've seen several of the auto packet, it's up over 3% right now, and this is mainly because of the tariffs are paused right now, but a potential exemption of those altogether. Now, Trump had imposed a 25% tariffs on foreign autos and imposed a 10% reciprocal tariff on the UK. And this was what was causing, panic in terms of the auto stocks. But these tariffs have been paused for 90 days, effective around April 10th. Now, in terms of auto and auto ancillaries with high US exposure, you have Sona BLW at 40%, Ramkrishna Forgings at 27% when you look at their FY24 revenues. You have a Bharat Forge, 25% of their consolidated revenues. Samvardhana Motherson at 18%. You also have a Tata Motors at 23%, Balkrishna Tires and Ramkrishna Forgings all are having, a exposure of 18 to 27% in terms of their FY24 revenues, and Sansera Engineering and Apollo Tires a little down at the list, around 3 to 9%. But now Tata Motors today is specific, is seeing some relief, and it's up in trade, and it was expected to be impacted the most due to Jaguar Land Rover and its exposure to the US. Now the volume exposure stood at 26 to 33% in FY24 and 9 months of FY25, and Jaguar Land Rover does account for 23% of Tata Motors FY24 top line, and the potential earnings downside from the tariff rate that was set to be imposed was around 15 to 37% as per Kotak. So with that kind of out of the way, you are seeing Tata Motors in focus today on the upside. Then you also have Samvardhana Motherson in focus. It was expected to not be impacted directly, but by indirect impact, and the tariff was set to hurt supplies of the companies to foreign OEMs as their exposure to the US was in question. But the relaxation on imports from Mexico and Canada is a big positive as per Axis Capital's note, which came in right today. And lastly, you have Bharat Forge and Ramkrishna Forgings also in focus. They derive more than 30% of their revenues from the USA, and tariffs would have been a second serious blow for these companies after the delay in the EPA norms that we are seeing. And these norms are actually going to lead to a pre-buy in FY26.
Right, Nika, thank you so much for that update. Now, shifting our focus to the stocks which are buzzing in trade today, Anushi joins us with the list, which includes Translane Lighting, Irida and Ashoka Buildcon. Over to you, Anushi.
Hey, so thanks for that, Malika. If you're looking at Transrail Lighting, all the stocks that we've talked about are basis on the order win. So Transrail Lighting has secured new orders worth about 1,085 crore in the domestic markets. They have received orders in the transmission and distribution segment. Now, we have seen in the last couple of months more and more orders coming in through from the T&D business, which is there. Unexecuted order book of the company stands at about 15,643 crore. This is as of the December figure that we are looking at. Next stock in focus is Ashoka Buildcon, wherein the company has emerged as the lowest bidder for a 569 crore of a project from Central Railway. This includes works related to construction of major bridges, minor bridges and other civil related works. Order execution period for this stands at about 30 months, and if you look at the company's order book as of the December 24 figure, that stands at about 16,457 crore. Last one on the radar is Ircon International, and they have received a 128 crore of an order from Northwestern Railways and Indian Railways, and this pertains to design and manufacture of microprocessor based EI system. The order execution period for which is 2 years, and the order book of this company is 21,939 crore as of December 24 that we are looking at. So these three stocks are in focus on the back of the order wins.
Okay, thank you for that, Anushi. So basically, there are three stocks, viewers, that you can have your radar on. Transrail Lighting is the first one that Anushi highlighted. The second one is Ashoka Buildcon, and then the third one is Ircon International. As Anushi already mentioned, just to summarize key points of these stocks for you. Transrail Lighting could be buzzing because it secured a new order worth 1,085 crore rupees in the domestic market. Ashoka Buildcon, in fact, has emerged as the lowest bidder for a 569 crore project from Central Railways, and Ircon International also has received an order worth 128 crore rupees from Northwestern Railway and Indian Railways. So these three stocks could be on your radar. Moving on, viewers, the CPI inflation is expected to ease to 3.5% in March. Pallavi is joining us to tell us what are the key factors to watch ahead of the data release. Over to you, Pallavi.
That's right. Now, according to a Bloomberg poll of economists, retail inflation is being pegged at 3.5%. That is the median inflation estimate. That's for March. That's compared to a print of 3.61% that we had seen in February. So this will be the second straight month that inflation will be below the RBI's target of 4%. What's also going to be interesting is that if the print is actually at 3.5% or thereabout, this will be the lowest print we've seen in quite some time. This is not entirely unexpected. The outlook for food inflation especially has turned clearly positive. There's been a substantial and a broad-based seasonal correction that we are seeing in vegetable prices. A lot of the uncertainties around the Rabi crop has also been abated. There are early expectations of a normal southwest monsoon that's expected to further bow up expectations of moderation continuing in vegetable or in general in food prices. We're also getting some support from the fall in crude oil prices. There are, of course, concerns that continue to linger around global market uncertainties, and there's always a chance of adverse weather-related supply disruptions. So there are upside risks as well. But all in all, the inflation outlook going forward, at least for the next few months, does appear extremely positive, and that is expected to help the RBI MPC as well, while it is on a rate cut cycle. Now, let's quickly take a look at the projections by the RBI as well for inflation for FY26. That stands at 4% with Q1 at 3.6%. So that's especially noteworthy. Now, before I close, we'll also quickly have a look at the wholesale print that's just come in. It's come in at 2.05%. That is also the lowest in 6 months, and that's compared to a print of 2.38% in February. And this is again largely led by a decline in food inflation, despite the fact that manufactured products, which forms the largest component of the index, has actually seen a little bit of an uptick.
Right, Pallavi. So a healthy inflation rate amidst a globally volatile scenario for India definitely looks like a positive to watch out for. In fact, earlier today, we spoke to Venkatesh Balasubramaniam, MD and co-head of research at JM Financial, on their recent Nifty targets. He also spoke about whether, the fear around tariffs has reduced and receded on various different sectors, including IT and semiconductors. Let's listen into part of that conversation.
Now on tariffs, it's almost like the news cycle has reduced to maybe less than a day. What is true yesterday is not true today.
True.
So that is the speed at which things are moving.
Yeah.
I mean, we started out with reciprocal tariffs. We started out with base level tariffs of 10% on almost everything imported into the US. This started from April 5th. Then you had on April 9th, the reciprocal tariffs kicked in. You also saw a bond market sell-off in the US, which might have made the US administration jittery. So immediately what you saw was they climbed down on two particular issues. One was they deferred tariffs by almost 90 days. Secondly, they climbed down on semiconductor tariffs. But interestingly, on Sunday, that is on Sunday evening, Trump also tweeted that, I have not actually removed tariffs on semiconductors. What we have done we have moved it to a separate bucket. There was also mentioned that sector-specific tariffs would be implemented going forward. So it is not very clear at this point in time what is the end game. I think it is a little too early to start celebrating the fact that there won't be tariffs. We still believe that the dust is yet to settle down. So you need a little more time to figure out what exactly is happening, because things are changing almost like on a daily basis, things are changing.
Right. So, Venkat, I understand from a tariff perspective, things are changing. Now, if you have to talk about your report with regards to Nifty 50 Analyzer, where you've spoken about the Nifty 50 EPS movements that have happened in February. In fact, a cut of almost 5/10 or 9/10% in EPS over FY25 to 27 estimates. Anything changes on that front in terms of your estimates since the time you've written the report, taking the market conditions into consideration?
Yeah. So if you look at numbers, if you look at Nifty numbers, first 9 months, I think we saw something like 7 to 8% kind of EPS growth. And we were earlier expecting that EPS growth for the full year will grow between 4 to 5%, which implied that the asking rate for the fourth quarter was close to 3% kind of growth. Interestingly, our team has come out with the estimates for the full quarter now. We are expecting that Nifty EPS will get cut by around 2%. So first of all, we don't think the 4 to 5% growth for FY25 is going to be achieved, which basically means that numbers will be revised down for FY25. Incidentally, we have also done some amount of proprietary analysis to figure out whether our estimates of 16% growth on the Nifty for FY26 can be achieved. When we did this proprietary analysis, we realized that almost 35% of the JM Financial Coverage Universe companies, we are going to see estimates being revised down. So at this point in time, my best guess is for FY26 also, it is very hard to see EPS growth more than 8 to 10%. So on the number side, things do not look that good at this point in time.
Okay. So Venkat, when you're saying EPS cut in terms of FY26 is what you're seeing as well. Now, which are the sectors which will see the highest cut from here on, and what are the factors one should be watching out for?
So if you look at EPS cuts per se, you could potentially see cuts in IT, you could see cuts in auto ancillaries. So these would be the IT, auto ancillaries are the key sectors where we are going to see cuts. We could also see some amount of cuts in when it comes to chemicals. We are going to see some amount of cuts in industrials. So it is almost like a broad-based kind of a cut. At this point in time, we are worried about banks also, because while the liquidity has come back in the month of April, if you have rate cuts, we've had 2 rounds of rate cuts. If there are more rate cuts, aggressive rate cuts during the year, you have to remember that the loan book is linked to the repo rate. So there could be a risk, but we are not calling out the risk on banks at this point in time. At this point in time for FY26, the bigger risk emanates from IT, auto ancillaries, chemicals.
With that, viewers, it's a wrap on this show, but do stay tuned to NDTV Profit for more news and updates.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims?
Markets continue the up move. Start the week on a strong note with benchmarks trading with gains of 2%. Nifty crosses 23,300 mark, Sensex above 76,700.
All sectors except FMCG trade in green. Nifty Realty and Defence lead the way.
And auto stocks buzz as Trump signals possible pause on 25% tariffs on foreign autos. Nifty auto gains more than 3%. Samvardhana, Bharat Forge, Tata Motors top auto gainers with over 5% gains.
Power pack performance by Tata Power and Adani Green. Tata Power buzzing on the back of a power purchase agreement with NTPC, while Adani Energy reports 28% growth in its energy sales in its FY25 business update.
And oil prices inch higher, supported by new tariff exemptions and a rebound in China's crude oil imports in anticipation of tighter Iranian supply. Brent crude futures gain 0.2% to $65 per barrel. Hello and welcome to Profit Buzzers on NDTV Profit. A very good afternoon to all the viewers. I'm Hiral Datia and with me is Anushi Vakaria. Good afternoon, Anushi. An interesting day of trade. I mean, it's a truncated week. The anticipation was that probably the volumes will be low, taking into consideration only 3 working days, and that's something which would probably cap the market upside. But does not seem to be the scenario, because if you see Nifty 50, that is trading at the day's highest levels with gains of around 2.3% coming in there. We've hit a high of 23,368 so far, and we are hovering around those levels as we speak. Let's quickly pull up the sectoral heat map to understand where are the gains coming in from and what's putting pressure. Clearly, you have Nifty Real Estate, which is the top gaining sector, followed by Defence, Auto, these are a few of the names which are on the uptrend. Again, FMCG is pretty much on the borderline. You have the PSU Bank Index, which is seeing gains of 1.2%, Nifty, IT, healthcare. So it's a sea of green across in terms of the sectoral indices as well. Let's pull up the Nifty contributors and then the Nifty heat map as well, because if you see in terms of the contribution, when we started off the day, you still have the HDFCs, ICICI Bank and RIL, and L&T, which has now added on to the list, is contributing to the kind of gains, and Nestle is the one which is trading in the negative. Let's have the heat map in terms of Nifty 50 as well. Again, only Nestle is the counter which is trading in the negative out of Nifty 50, but all the other stocks which are trading in the positive as we speak. So that's with regards to where the large cap scenario goes. I mean, when we started off the day, Anushi, the broader markets were slightly underperforming the benchmark indices. They were still trading in the positive.
Right.
The key concern over here now is how are valuations panning out between large caps and broader markets, and where should someone put their bets?
In fact, a lot of discussion for the broader markets have remained on the EPS growth also that we are looking at for the fourth quarter going forward. So a lot of stock specific action is something that we can anticipate with the Q4 earnings now underway. In fact, if we are seeing what is happening today in terms of broader markets, Nifty mid-cap 150 up over 2.3%. This is of course the positive sentiment and the strong global cues that we are looking at supporting this kind of strong up moves that we are looking in the market. But it's the defense pack in the broader market which is in focus. We are seeing something like a Moscow dog data patterns, seeing gains of over 9 to 10% in trade today. So there you go, Moscow dog around 9% up. Other stocks also like 361, Uno Minda buzzing, seeing gains of around 6 to 7%, while Sona Comms, Power India, autos related stocks again on the possibility of pause on the on the tariffs that we are seeing is also leading to some strong up moves in the auto sector as well. However, let's also talk about on what's on the losing side on some of these key plays that we are looking at. We are seeing stocks like Berger Paint, Paytm, Hindo, Petro in pressure. They're seeing cuts of around 1% each. Max Health and other stocks seeing cuts of around 2%. So that's as far as where the mid cap indices is concerned. But if you are looking at the small cap indices, seeing gains of around 2.7% here as well, led by stocks like Data Patterns, again another defense stock in focus. Case International, Keynes, ACOMS adding to those strong gains, around 9 to 10% of gains here as well. However, stocks like Aster DM, Campus, Maneuver, they're seeing cuts of around 1%. But overall breadth, if you're seeing in the broader markets, largely skewed towards the green rather than the red we are looking at. And of course, strong recovery in terms of where the broader markets are concerned. Right, Hiral? That's what we are seeing.
I mean, interesting moves over there. Let's also pull up a GM Breweries on the screens right now. They've just reported numbers. A 169 crore number, 6.5% growth in terms of the top line is what you're seeing. Profits have seen a growth of around 30%, profits have dipped around 30% at 60 crores, and the margins have improved. So this is an interesting one to watch out for, because a top line growth in single digits, margins have shown an improvement, but your profitability has dipped around 30%. The stock, however, is seeing gains of around 2%. I'm assuming there is an exceptional item over here that is leading to this kind of a downtick in terms of profitability. So that's something we will get to further as well. But let's also welcome in our guest Sharmila Joshi, who joins in. Sharmila, very quickly, any views in terms of GM Breweries?
Well, after I'm not really analyzed the numbers that you were just speaking of, but really speaking, after last quarter's numbers, one got a sense that the valuations looked okay, and that there could be we've seen a big correction in mid caps in any case, and now the valuations had come down, and there was an improvement in numbers. So, in fact, there could have been a buying case. I haven't really looked at the numbers that you just mentioned, but what I do remember is that it warranted a buy given valuations after the last quarter numbers.
Okay, so that's the view for GM Breweries that we are looking at. But let's just focus back to the auto companies. The auto index, if you are seeing gains of around 3% in trade today, there you go. And this is in a relief for majority of the auto companies, as US President Donald Trump has announced that he may pause the levy on 25% tariffs on foreign autos. Nifty Auto again seeing about 3% of gains on the back of this announcement. Let's go across to Mihika for more details on the same.
on the back of a consideration on the relief from the reciprocal tariffs, you've seen auto stocks buzzing in trade today. Just to give some perspective to the viewers, Trump had imposed a 25% tariff on foreign autos as well as a 10% reciprocal tariff rate on the UK. Now, these tariffs have been temporarily paused for 90 days, and there's a hope for them not coming into effect in the end. In terms of auto and auto ancillaries with high US exposure, you have Sona BLW, 40% of their FY24 revenues came from the US. Ramkrishna Forging, Bharat Forge have a 25 to 27% US exposure as of FY24. Tata Motors at 23% due to JLR's exposure. Samvardhana Motherson is also in focus with an 18% exposure to the US in terms of revenue in FY24. You have also Balkrishna Tires at the same metric at 18%, as well as Apollo Tires and Sansera Engineering, which have a lower exposure of around 3 to 9%. Now, Tata Motors is seeing major relief today. It was expected to get most impacted by the tariffs due to Jaguar Land Rover, and JLR actually had a 26 to 33% US volume exposure in FY24 and 9 months of FY25, and it accounted for 23% of Tata Motors FY24 top line. And Kotak had expected a potential earnings downside of around 15 to 37% based on how the tariffs were imposed. You also have Samvardhana Motherson in focus today. The stock has gained quite a bit. It was expected to be impacted by the indirect effects of the tariffs around the world. The tariffs were set to hurt supplies or companies' supplies to foreign OEMs that actually export to the US. And the relaxation on imports from Mexico and Canada is a big positive as per Access Capital's note today. And then you have Bharat Forge and Ramkrishna Forging also in focus. They derive more than 30% of their revenues from the USA, and tariffs would be a second serious blow after the delay in the EPA norms. And these were norms that were expected to lead to a pre-buy in FY26 but haven't come into place yet.
Thank you, Mika, for all those key details on why the Nifty auto pack is in focus today. Sharmila, coming to you. Now, while there has been a lot of uncertainties regarding the flip-flop that we are seeing regarding the Trump tariffs, Nifty auto, we're seeing some strong positive moves because this has been one of the sectors which have been under pressure regarding these tariff announcements. So, want to understand from you, how should one look at the Nifty auto? Also, some of the key stocks that Mika was talking about, which included the likes of Tata Motors, Samvardhana or Bharat Forge, which have a higher exposure over there. What is your overall view on these three counters as well as the whole pack in general?
Honestly, a lot of it is not making sense because when you did hear of tariffs, I think the one underlying theme was that you wanted to get jobs back to the US, and one big sector which was impacted was autos, and which is why the tariffs were there in the first place. Now we've heard whatever this pause, and it is expected to continue beyond the 90 days because otherwise, that would be your next big question, that what happens on day 91, that do you really, if nothing concrete has happened within this period, do you see a further going back to what the earlier tariffs suggested were, etc. So I think, you really need to sort of play it by the year and take it purely company-wise on a valuation basis. I think Bharat Forge, to my mind, is looking good because the way things have played out for them, there have been one negative after another. And if you are willing to wait for a longer term, there could be a possible, once things quieten down, there could be a possible upside here. And so also Tata Motors. I also think that one should keep your ear to the ground as to what is happening with regards to Tesla entry into India, because that could be an end game for them. Because if you want American cars, and Tesla would be the car which is trying to get entry into various markets overseas, then how that plays out, whether they get the reliefs they want to be able to set up in India, would be the interesting bit to watch. So my eyes would be then on that, and then if Tesla were to enter, what it means in terms of duties for the other imported cars, and also the electric vehicle market in India, what price point they come in, etc. So a lot of, I think, ifs and buts out there still. But net, I think it's a positive for Tata Motors and Bharat Forge.
Right. So that's with regards to TAMO and Bharat Forge, the view coming in from Sharmila. But moving on, you have the power sector that has been in focus in today's day of trade as well. Overall, if you see, Tata Power, they've signed a power purchase agreement with NTPC. Mika joins it with the details. Mika, Tata Power, 4% up move. What are they doing with NTPC and how does it benefit them?
Tata Power is in focus because of a power purchase agreement that it has signed with NTPC. Now, this is to set up a 200 megawatt firm and dispatchable renewable energy project, which is basically a mix of solar, wind, but also has a battery energy aspect in the project. Now, the capital commitment for the contract is set at 4,500 crores, and it's proposed to be set up in the next 24 months. Now, the project is expected to generate around 1,300 million units of electricity annually. A little bit about now Tata Power's updated capacity details. As per the company, their renewable utility capacity is now at 10.9 gigawatts. Out of this, 5.5 gigawatts is currently operational, and the balance 5.4 gigawatt is under various stages of implementation. But the company does expect these projects to be completed in the next 6 to 24 months in a staggered manner.
Thank you, Mika, for getting us the details. Sharmila, your view with regards to where Tata Power goes, because that is also one segment which probably is expected to report some good growth in terms of the fourth quarter as compared to the other sectors.
Yes, and within that space, what I would just like to add is I like anything that is sort of looking at green energy, renewable energy, etc. Because you do see themes play out, and this is the theme that has been attracting investor attention. So anybody who's talking of solar, wind, renewable of any sort, that's where investor attention seems to be green energy, etc. So I think Tata Power, to my mind, fits the bill perfectly. They have been speaking, sort of talking the talk for the last couple of years, and now you're actually seeing some of it come into play, and valuations look reasonable. Results seem fine. Stock has corrected from higher levels. So to my mind, this stock looks good for the longer term investor.
There you go. That's the view for Tata Power that we are looking at. But another stock that is in focus is Adani Green, and this is on the back of its Q4 update that we are looking at, in which the company reported about a 28% in growth in the energy sales in this update. Let's go across to Mika for more details on this.
Adani Green Energy is in focus because of their operational update. Now, in terms of the operational performance, their sale of energy was up 28% year on year at 27,969 million units in FY25 as a whole. And this sale of energy growth was backed mainly by robust capacity additions, and a measure of this growth was coming in from the solar energy. And they've seen a steady growth in generation at a 45% compounded annual growth rate, or CAGR, in the last 5 years. Whereas as the capacity addition goes to, the FY25 operational capacity is up 30% at 14.2 gigawatts. Their growth in operational capacity is mainly due to greenfield additions of 3,309 megawatts of capacity. Out of this, 2,710 megawatts of solar power plants were operationalized, and 599 megawatts of wind capacity was operationalized. Lastly, the company is targeting 50 gigawatts capacity by 2030, and this indicates a 27% CAGR over FY25 to FY30.
Overall, a strong view that we are looking at in terms of the FY25 update for Adani Green. But let me go across to Sharmila for her view on the stock.
Well, I did mention, I think that this is the story that we are seeing that is getting investor attention, which is anything that is talking of renewable energy, green energy, etc. And I think Adani Green is precisely, again, that model, and we heard some positive statements from them. Their capacity utilization has gone up. Once again, over there, the valuations look decent. I would prefer between the two, Tata Power to Adani Green. But having said that, given their announcements and their valuation, this stock again looks very attractive.
Absolutely. This is with regards to where Adani Green is concerned. 28% is the kind of up move that we are seeing. In fact, NDTV is a subsidiary of AMG Media, which is owned by Adani Group as well, as a disclaimer. But moving on, let's quickly shift focus again to the auto pack. Sorry, the electronics pack, which again has been exempted from tariffs. And let's understand how Indian companies could benefit out of this. Mahima is with us with more details. Mahima, over to you.
Right. So, as you rightly mentioned, the US has now come out with an exemption for smartphones, computers, as well as electronic devices with respect to where reciprocal tariffs are concerned. So, these reciprocal tariffs were ranging between 10 to almost 145%, but these have now been exempted. Reversal of tariff is taking place, including that for China, which was at 145%. For China, the tariffs now stand at 20%, but for the rest of the world, they still stand at the base rate of 10% as of now. This will have a major impact on big tech giants like Apple, who get their products made from Asian countries like China as well as India. Now, how can this benefit India? Well, India appears to be well positioned to benefit this, because right now China is sitting on a tariff rate of 20%, but India at the rate of 10%, and higher tariffs on China could push companies to aggressively look for alternative sourcing. So, supply chain transformation from China to India might take place. Now, Nomura has come out with a report and their views with respect to what can happen. They're saying that Indian smartphone imports could see a sharp increase in the next 90 days till some different announcement comes into picture for the entire tariff rate for the smartphone as well as computer components. As per Foxconn, Apple's India production will increase from 12 to 16% in 2024 to around 21 to 25% in 2025. India stands to be a key beneficiary of this supply chain shift and is and the likely key beneficiary in the entire space right now in the listed space could be Dixon, and the other key beneficiary could also be Samvardhana Motherson, because it manufactures display to Apple, and this could benefit both of these companies as of now. So both of these companies are well positioned to benefit from this particular tariff exemption, and of course China being taxed at 20%.
Thank you, Mahima, for getting us the details. Sharmila, your view, Samil as well as Dixon, where would your bets be taking into consideration the exemptions?
Well, not neither really, because for different reasons. I think Dixon Technologies, to my mind, valuations look expensive, and there are a lot of ifs and buts again, in that statement, whether you're able to ramp up and, can we really use this as an opportunity. I think we'll have our answers in the next 90 days. And if that is the case, then this is something that we could be looking at, Dixon. Samvardhana, I think, a very mixed model there. You're also talking of auto ancillaries, you're talking of exposure to a lot of geographies, etc. So honestly, to my mind, maybe I could be wrong on this, and I've been in the market too long, but this stock has consistently disappointed me over the last 7-8 years. So I would wait for I really wouldn't be looking at this stock.
So overall, if you are looking at, that's the view that we are seeing from some of these consumer electronic stocks which are in focus. But another sector which is seeing some strong gains in trade today is the pharma pack, and we have the likes of Aurobindo Pharma along with something like Dr. Reddy's buzzing in trade today. We have Mahima with more details on this.
Right, so I'll start with Aurobindo Pharma. The company has received a US FDA nod for a generic medicine of 2.5 mg. They're eyeing a $447 million US market for this, and they're set to launch in first half of FY26. They've also secured a tentative approval for the same generic for 10 mg, 15 mg as well as 20 mg strengths. Higher dosages are a part of significantly larger opportunity as well for the company, and the total US market for all of these different segments is estimated at around 8.5 billion US dollars. Now, company now has around 540 ANDA approvals, 521 final approvals as well as 19 tentative approvals in their overall basket. The next one in focus is Zydus Life Sciences. The company has received a final nod from US FDA for Jaythari tablet for 6 mg, 18 mg, 30 mg as well as 36 mg. The group now has around 424 approvals so far, filed around 492 ANDAs. In terms of another news flow coming in for Zydus Life Sciences, the company has acquired around 85.6% equity shares for Amplitude Surgical, that is based out of France. This is the acquisition will be from the existing shareholder at the price of €6.25 per equity share, and the total consideration will be approximately 256.8 million euros. The last one in focus is Dr. Reddy's. Media reports were suggesting that the company has trimmed their overall workforce cost by 25%, but the company came out with a filing clarifying that the news item that DRL has trimmed workforce cost by 25% is factually incorrect. The company categorically denied that the reported 25% decline in workforce cost reduction is not true. So these are the three pharma names that are in focus, of course, on the back of US FDA approvals as well as clarifications coming in from the companies.
Okay, thank you, Mahima, for providing us with those key details on these three stocks. Sharmila, coming to you, any of the stocks that you are currently eyeing on? We have the likes of Dr. Reddy's as well as something like a Zydus Life buzzing on the back of the US FDA nod that we are seeing at, and something also like Aurobindo Pharma seeing some strong moves in trade today.
Yes, again, what you've really been analyzing post the tariff news came is that perhaps this could be a sector which is a little less affected, simply because you would find that the US would not really be in a position to ramp up their manufacturing in pharma, simply because the kind of manpower and the sort of qualified technical people that it requires, that's not very easy to get. So from that sense, you had already seen a bit of a relief sort of come for pharma. And then when you have news like this, especially for a stock like Aurobindo, which valuations again look reasonable, then I think it's good news.
Right, so that's with regards to Aurobindo Pharma. That stock is trading at the day's highest levels with gains of nearly 4.5% coming in there. DRL is going to be interesting as well, because though the stock is seeing some gains on the back of the clarification that has come in, any further updates on this will be crucial, and that's something that the street could be concerned about from here on. But moving on, we are shifting focus with regards to the MSCI Rejig that may begin today. Now, that's the cutoff that we are looking at. In fact, Somit is joining us with more details. Somit, what is it that we should be looking out for in terms of the expectations?
Well, yes, multiple stocks remain in focus on the back of MSCI's expected changes that could come in on May 14. Now, as per the MSCI methodology, the cutoff period typically spans in the last 10 working days of the April month. And as per Nuvama, the MSCI cutoff should ideally begin today and should last for the next 3 trading sessions. So, and the official announcement regarding the changes are expected to come in on May 14th. And the inflows and outflows regarding these changes will happen on May 30th. So, which are the stocks that we need to keep an eye out for? Now, Nuvama is expecting 4 stocks to get included in the MSCI Standard Index and 2 stocks to move out of the Standard Index. Coromandel International is a stock that could get included in the MSCI Standard Index, and the inflows could be anywhere around 200 to 210 million US dollars. Then there is Paytm, which could see an inflow of close to 209 million US dollars. Nykaa could see an inflow of close to 178 million US dollars, and Adani Energy could also be included in the MSCI Standard Index, and the inflows, if it gets included, could be around 176 million US dollars. And 2 stocks that are moving out of the MSCI Standard Index is Sona BLW and Thermax, and both these stocks could see an outflow of anywhere between 110 to 160 million US dollars, which is nearly 14 to 20 times that 20-day moving average. So keep an eye out for these 6 stocks. 4 of them are getting included, while 2 of them are moving out of the MSCI Standard Index. The cutoff date should ideally begin today and be for the next 3 working days, and the official announcement is expected on May 14th regarding the MSCI changes.
Thank you, Somit, for getting us the details. Sharmila, let's talk about and break this up into 2 parts. You're talking about stocks like Coromandel, Paytm, Nykaa and Adani Energy. We already spoke about Adani Energy, but the 3 that will get included, and Sona BLW and Thermax that will get excluded, which will see outflows in the range of almost 100 to 162 million dollars, and the inflows is in that range of 170 to 210 million dollars. Any picks or any preferences out of these names?
Honestly, when I was listening to the list, I was just thinking that what should your strategy be? And I think what I would like to ideally do is probably buy a Coromandel and a Nykaa out of the list of what is getting included, because the way the businesses are and where the stocks are at, I think that there is, and this sort of piece of good news could sort of propel them further. So that would be it. And I think even with the stocks exiting, I think if you were to see a big correction, not a very big correction, but like a correction because of the sell-off in Thermax, I think that could be a stock that could be bought, because again, a very solid mid-cap stock in a sector that I like. So if you get it at good valuations, why not? So that is really what I was thinking, how I would play this situation.
Right, so that's with regards to preferences coming in out of the MSCI Rejig. Sharmila, stay with us. We'll quickly slip into a short break. In fact, lots more lined up on the other side. Please stay tuned to NDTV Profit.
That's huge. That is a biggie. It's out of there.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations?
Hello, welcome back. You're watching Profit Buzzers. Let us shift our focus to some of the order wins which are there and the counters that are buzzing on the back of it. We have firstly the likes of Transrail Lighting, which have secured new orders worth about 1,085 crore in the domestic market, and this pertains to the transmission and distribution segment that we are seeing more of these orders coming in from. If you look at the consolidated order book of the company, that stands at about 15,643 crore. This is the December 24 figure that we are looking at. Ashoka Buildcon, another stock in focus, wherein they've emerged as the lowest bidder for a 569 crore of a project from the Central Railways. The execution period, if we see, is around 30 months, and the company's order book as of December 24 stands at 16,457 crore. And the last stock, which is also buzzing on the back of an order win, is something like an Ircon International, receiving an order worth about 128 crores from Northwestern Railway and Indian Railways. This is for the design and manufacture of microprocessor-based AI system that we are looking at. Order execution period of roughly 2 years, with an order book company already has of around 22,000 crore. This is the December 24 figure that we are looking at. So these three stocks are in focus, but let me take this across to our guest joining us, Vinay Rajani, CMT, Senior Technical and Derivative Analyst at HDFC Securities, and of course Sharmila there with us on the show. Vinay, let me take this across to you. Of the three stocks, which are any of your preferred picks in this?
Stocks we are talking about?
We are talking about something like Transrail Lighting, Ashoka Buildcon and Ircon International.
Yeah, so Ashoka Buildcon, yeah. So let me open the chart first. Yeah, so Ashoka Buildcon has been trying, and it is not outperforming, we can say. It is going with the market. So shallow recovery is there, but still breakouts cannot be seen. I cannot see any fresh breakouts on any infrastructure stock as of now. But yes, with the market, it is showing and it is trying. It is still below its 50 days exponential average, which is placed around 205. So I think once the 205 level is taken out on the upside, then we can see a momentum buying coming back to the sector, because entire sector is struggling a bit. It is underperforming. Once we see market sustaining at higher level, then definitely sectors will come. Infrastructure play will definitely participate in this rally. So yes, going good as of now, but not the fresh breakout. About 205, there will be a confirmed positional uptrend, and in that case we can expect some more buying coming to the Ashoka Buildcon. And talking about the IRCON, yeah, railway stocks also trying, and from the lower level in last 4 days it has risen a lot. But it is the same case like Ashoka Buildcon. It is also trying, but not the one of the best start we can say from the railway sector is also not participating that much as we can see that defense stocks are participating very well, but railway stocks are still finding resistance at higher level. But yes, today's move has been quite convincing. It is up by 5%. Let's see how it goes. If it closes around here, I think there is a resistance around 163. 163 needs to be taken out for getting a positional uptrend. So we are waiting for that to happen. So yes, there is a recovery, but there is no breakout. Breakout will be there above 163 in the stock like IRCON.
Okay, so that's a technical view that we are seeing. Sharmin, I want to understand from you also, overall, if you have seen in the last 2 quarters, there has been some muted kind of an ordering activity, which we've seen from December, January onwards. There has been a pickup in some of these road developer names, which includes the likes of Ashoka Buildcon. I want to understand your take on the overall infrastructure space, and in this, what about the road developers?
Yes. Ashoka Buildcon, I think, last quarter numbers were not terribly like anything to write home about. And we have seen the entire sector correct. And precisely, I think, what you alluded to, the kind of order wins they've had. And there has been an overall sort of a slowdown that we've seen in that sector. So now when you start hearing of them being lowest bidders for orders, etc., I think you will slowly start seeing hopefully some momentum return to this entire space. From a valuation perspective, they look fine, but the slowdown has come because they've not delivered either on the numbers or on the orders that were envisaged for these companies. Haven't that rate of orders has not really been there. So hopefully things will start improving now, and there could be a sort of, given the valuations, I think that this stock looks nicely poised.
Right, so that's with regards to Ashoka Buildcon, but shifting focus to a NBFC, which is Home First Finance. Let's pull up that one on the screens, because clearly the stock has been seeing a good amount of traction in the last 1 month. If you see the 1 month chart of this counter today, the stock is up around 6 to 7%. Let's pull up a 1 month chart as well of Home First to understand the kind of gains that have come in. There you go, around 14 to 15% is the kind of uptick that has come in. Now, what has happened over here is with regards to the fundraise with the QIP. I mean, interesting moves over here. Now, whether it's a good buy at current levels or not is what we need to check with the guest. But before that, let's head across to Harsh to get more details. Harsh, over to you with regards to the QIP.
Well, expected, announced in fact last week, but they've exercised the green shoe option as well. Home First Finance, 1,000 crore was the fundraise quantum. They've hiked it to 1,250 crore, 1.28 crore equity shares, or rather 1.29 crore equity shares issued at a price of 970 rupees per share, which is roughly a 9% discount to Friday's closing price. It's around a 5%, around a 4.8% discount even to the price set as per SEBI norms. So that's how it really stacks up. There's been a bunch of very interesting buyers. Now, this is where it gets interesting. One, you have an IFC, International Financial Corporation, which has bought 28% of the 1,250 crore raise that Home First has done. This translates to roughly a 3.5% stake currently post money, which is post the fundraise in Home First Finance. Then you have an HDFC Mutual Fund, a Fidelity, small cap World Fund Inc., and you have an AB Sun Life, among other names, which have invested in the company, comprising around 60 to 70% of the cumulative fundraise. These are marquee investors and therefore may stand out and may remain in focus today.
Thank you, Harsh, for getting us the details. In fact, Investec has come out with a report on the same as well. They have a buy rating. They've gone ahead and hiked the target price to 1,350. What they are saying is that the capital raise is going to go ahead and improve their competitive position in the market. Secondly, the leverage, which is the debt positions, they have dropped from a 4.9 times to a 3.6 times, which becomes a positive as well post the QIP. Potentially, this would support a credit rating upgrade. So this becomes a candidate for a credit rating upgrade from here on. They're expecting the ROE, that's the return on equity, to dip from here on to almost 14% in FY26. Now, clearly, according to Investec, it remains a high-quality, affordable housing finance company with strong scalability. So that's what Investec is betting big on. And what's interesting over here is that since the stock actually listed back then in February 2021, they've managed to stand out amongst peers in the affordable housing space. They've consistently delivered around 6 to 8% of a sequential growth in terms of top line and bottom line. So this reflects the business resiliency that the company has and the kind of external challenges that the management has been able to navigate as well. Sharmila, your view with regards to where Home First goes? The stock is up around 7% in today's session. The last 1 month has been pretty strong. You're seeing a lot of demand coming in there. What is your view? And if not a Home First, any other, housing NBFC in the affordable housing segment?
Yeah, so I think I kind of agree with the 1350 target that I have just heard in the note, because a couple of things have changed. We have seen that we have an interest rate cut, and that is obviously, I think, good news for anybody in the lending space. The sector, real estate as a sector, is also sort of is very important in the general scheme of things, and affordable housing within that has been a focus area for the government. So if they can continue to grow their AUMs, they have been, then this looks like a good bet. And I think anything in that NBFC space, as you mentioned, which is sort of looking at affordable housing, would, I think, to my mind, warrant attention. But I completely agree. I think 1350 could be a possible target for Home First.
Right. Vinay, what are charts indicating with regards to Home First? After the up move that we've seen in the last 1 month, do you see further strength, or do you think it's time to still wait and watch and wait for some lower levels to make an entry?
I think it is a nice chart. It is a nice entry level. So today it is up by 7% and with a jump in volumes. So it is a fresh breakout on the chart. Primary trend has been already positive. It has been forming higher tops, higher bottoms on the weekly, monthly charts. So the chart has been very good and it has remained resilient in the downfall. And as you said, their NBFC sector is performing well. And out of this NBFC, these housing finance companies are performing very well. Recently, we recommended other housing finance to our clients, and that has gone up and given good generated some good alpha in the short term. So yes, entire sector is looking good. Home First Finance has given fresh breakout on the chart. Right now it is quoting at around 1130. So I am expecting this stock to reach its 52-week high, which is hovering around 1300 odd level. So yes, looking quite promising. Even if trader takes position here as an investment, also this looks attractive on the charts, on the long-term charts I'm talking about. So yes, one can take an entry into it. As far as support is concerned, there is a strong support around 1020 to 1030. This is the support level. One can look at it. But overall, chart looks very attractive and headed higher levels. And I'm expecting that in couple of months, it can reach a target of 1300.
Okay, so that's the view that we are looking for Home First Finance. But another stock that has been buzzing in trade today is Indigo. This is after Motilal Oswal has upgraded the stock to a buy and even hiked the target price to 6,550. So we are looking at a 27% of an upside on this. A couple of factors that they have highlighted. Firstly is the falling crude prices that they're seeing. In fact, they have lowered, the brokerage note has lowered their Brent assumption for FY 26-27 to about $65 per barrel for crude prices. So that is something that could benefit the company's profitability going forward. Along with that, the company has also been on an upward trajectory since the COVID levels that we are seeing. This is reflected in its profitability that it has maintained over the last 2 years as well. If you are looking at overall consumption space on the company's strategic moves towards driving profitability also, the company has taken fleet expansion orders by 925 aircraft, which are set to be delivered by CY35, something that we are seeing. Its entry into international markets, another factor as to why the brokerage is betting that these strategic initiatives are expected to drive further profitability for the business going forward. So Vinay, firstly I'll come to you for something like Indigo. What is your view on this stock in terms of where the charts are concerned?
Yeah, so stock is at all-time high, so there is no doubt about the trend is clearly positive, but there is no fresh breakout. It has risen from the level of 4,000, it has come to 5,260. So the chart's existing trend is clearly positive. The investors and traders should continue to hold on to their long positions. But as far as fresh positions are concerned, if trader is looking for generating some trading gains, then that should be a trade with a strict stop loss. So whatever position you take on the long side from this level, because risk reward ratio is not that much favorable, because it has risen a lot, and after a breakout level it has gone up like anything. So I would suggest that if somebody is looking to take a new position into it, one should have a strict stop loss into it. According to me, there is a strong support around 5,100. So keeping that stop loss in mind, one can trade in this stock. But yes, for investor it is looking strong, but for the traders risk reward ratio is not favorable. But if if somebody wants to take long position in trading, 5,100 should be the stop loss.
Okay, and Sharmila, what about your view on Indigo? What are you positive on the stock as well?
I actually prefer SpiceJet within the same space. I think at this price point and valuation, SpiceJet to my mind looks more attractive.
Okay, so SpiceJet is the view that we are looking at, right, Hiral?
Yeah, I mean, SpiceJet is the preferred one coming in there, so that's interesting. But with Indigo, Sharmila, I mean, what's the reason for a SpiceJet versus a Indigo? Because right now the bets are on an Indigo, taking into consideration even the IPL aspect of it, and you know the boost that could come in, the tie-up that they have with Accor. So why a SpiceJet versus a Indigo?
You know, see, according to me, both have their the kind of possibility that you see for them to grow market share is tremendous at this point in time, given how many people are traveling and using airline as a means to travel. So there is no taking away from the fact that both are positive. I just feel that Indigo is sort of a more discovered stock in that sense, and it has seen a lot of interest and buying, etc. Valuations are also high. Both have actually gone through their share of concerns. There have been certain recent developments in SpiceJet, which, to my mind, and given the valuations that the stock is at, I think it is at a point where you will possibly get more returns if things play out the way I see them over the next 8-12 months. So that is the only reason. Otherwise, both are, I think, both the businesses could really grow from current levels.
That's an interesting take, Sharmila. So that's with regards to where the aviation counters go. But let's also pull up Ajanta Pharma on the screens and see what that stock is doing in trade, because clearly Jefferies has initiated a buy rating on Ajanta Pharma, and the investment firm has set a target price of 2,850. What they are saying is that the growth potential is absolutely strong from here on, and the fundamentals are looking pretty much robust. The launching of unique products ahead of the peers, that is the key to the success with regards to where Ajanta Pharma goes. And Asia and Africa growth is mainly driven by ground presence as well as a custom portfolio. Vinay, let me come to you first with regards to Ajanta Pharma. What are charts indicating? And along with Ajanta, any other topics where you see interesting charts?
Yeah, so Ajanta Pharma has risen in last 4 days from the level of 2,327. It has gone up to 2,650. So strong bounce back can be seen. But overall, if we go by the chart, it is still below the long-term moving averages. And if I were to consider Nifty Pharma Index also, that is not leading right now. Financial stocks, NBFC, banking stocks, and like public sector enterprise, CPSE, these are the sectors which are actually taking lead in this rally of the market. So this is the sector anytime soon, anytime it might happen that because of some news from the global markets, again the selling pressure will come, and charts are also suggesting that kind of setup only. So I'm still taking a wait and watch approach in this particular sector. And Ajanta Pharma, there is a strong resistance around 2,700. So 2,600, 2,700 is we can say a supply zone for the stock. And once that is taken out, then we will take a fresh call. But as of now, I would like to avoid the long position in the Ajanta Pharma. And as far as other stock is concerned, recently we have come out with a trading call on Patanjali. So Patanjali Foods has given a fresh breakout on the charts. It is near its all-time high, 52-week high that we like on the charts. So Patanjali Food, which is quoting around 1900, one can go long in that. And we are expecting that it can give 10 to 15% alpha in short period of time. So we have just recommended to our clients, and that call is open. And yes, so we like Patanjali Food technically from here.
Okay, so avoid for Ajanta Pharma is something that we are looking at in terms of where the technicals are concerned, but a preferred pick remains Patanjali Foods, seeing an upside of around 10 to 15%. But Sharmila, I want to get your view as well on this stock. What's your view? Are you positive on this or negative over the stock?
Ajanta Pharma, yes, I think perhaps not very positive because valuations are sort of pricing in the positives. But given where the stock is and where their earnings have been, etc., from a longer term perspective, this looks like a good stock.
Right, so that's with regards to the overall pharma pack goes. But moving on, we've been picking up the Q4 earnings expectations so far. Now, clearly, there is a slowdown that is expected in terms of the fourth quarter. Profit and revenue growth is expected to be muted as well. That is what the street consensus is looking like. If you see in terms of the PAT growth trajectory, from a 3.5% in the first quarter, it has gone up to 9.5% in the third quarter of FY25. But this quarter is expected to see some bit of a downtick yet again, which will be lower than the previous quarter. And similarly, if you see in terms of, the revenue growth trajectory as well, from a 9.6%, it's come down to around 4.5%. So that's what it's looking like. Margins are overall expected to remain flat. There are global headwinds which are on the rise, so which will keep export-oriented companies on the downside, whereas domestic-oriented companies are the ones that could be shining. So there are select pockets that will drive growth. Let's quickly look at sectors that could probably see, could lead this time around. Metals and mining, where margins are expected to improve for steel companies. Aluminium companies are expected to see a good growth on the back of LME and aluminium prices and alumina prices. And the safeguard duty is expected to aid volumes as well. Healthcare and pharma are expected to report a healthy quarter. You are expecting to see volume expansion, and the price increases that have happened in the domestic market is what is going to drive growth. Now, your API segment is what could see some bit of pressure. CDMO is seeing some good visibility. Hospitals is seeing some good visibility as well on the back of higher occupancies and additional capacities. Cement is also another one which is going to see a good growth this time around, is what the street is anticipating. Oil and gas, again, marketing and refining margins are expected to be weak. There could not be, no expectation of any inventory-related gains or losses, but the margin for city gas distribution companies is going to recover, and analysts are foreseeing a weak production volume for upstream companies. In terms of financials as well, the loan growth and the margin squeeze is what is going to be concerning. There is going to be moderation in terms of the loan growth and the net interest margins. Asset quality, however, is expected to remain stable, and the slippages could be higher for companies and banks where the unsecured segment is going to be hit. Autos, again, a mixed expectation coming in there. And in terms of FMCG as well, it's a pretty mixed quarter outlook ahead. Sharmila, overall, how are you looking at the earnings expectations overall?
I think pretty much in line with what you've been highlighting. And I think I'll just add to that. If you were to get an EPS for Nifty in this range of between 1220, 1230, then you can make a case for markets going up from this level. Because historically, the PE multiples that Nifty has traded at would then indicate that there is an upside in this market. Of course, I think there's no taking away from the fact that we need to keep an eye on the situation globally, because those shocks are sort of coming more frequently and more in a more violent manner than what we have seen. But that said, just looking at where our growth is and where our valuations are and how market has performed over this last year or so, you can now make a case for markets to go up, if you were to get a EPS growth of around in the range of 1220 to 1230.
Okay, so that's the fundamental view that we are seeing in terms of where the expectations are concerned. But when I'm coming to you also, I want to understand your preferred picks in this space. Now we are just on the brink of the fourth quarter earnings. Which are some of your picks in this space based on the result expectations and also some of the sectors that Hiral talked about, which some might see lag in growth while some may exceed growth expectations?
So basically, I'm a chart follower, so I'm not the right person to comment on the result analysis and the expectation of the quarterly results. But yes, as we can see, there are many financial stocks looking very strong on the chart. As I said, that Aadhar Housing Finance was recommended by us, and then many NBFCs are looking strong. So we would be concentrating more on that sector, which can give a good returns in the short to medium term. So we are actually concentrating more on NBFCs and financials and banking stocks.
Vinay, basically what, Anushi was trying to ask you was that just ahead of the earnings season, any of the stocks which are looking strong in terms of charts, which could be buying, opportunities, or any short sell opportunities that you're seeing?
Short sell, I don't see any opportunity, but yes, overall I see strength in the power stocks. So NTPC is one of the stock which we like. Some of the FMCG stock like Asian Paint, Kansai Narrow, like which we have recommended. Some FMCG stocks, paint related stocks which can bounce back because of the lower crude oil prices. So power stock like NTPC, Power Grid is another stock which we like technically. Asian Paint and Kansai Narrow like we like. And as I said, housing finance companies like Aadhar Housing Finance is looking good. A stock like Patanjali from the FMCG space one can concentrate on. These are the sectors and stocks which are looking stronger and has been resilient in the downfall of the market, and we expect them to outperform in the short to medium term. So these are the sectors and stocks one can look for the shorter term opportunities.
So interesting names coming in there. In fact, thank you, Vinay. Thank you, Sharmila, so much for joining us on the show and sharing those views and your recommendations so far. But completely out of time. With this, it's a wrap on this edition of Profit Buzzers from Anushi and myself. And as we slip into a short break, let's also listen in to Gurmeet Chadda on his view with regards to how Q4 FY25 is expected to pan out. Let's listen in.
I think that's the most important trigger, bigger than the tariff noise and a lot of things around us, because unless we fix our house in order, which is earnings, all this debate is meaningless. So see, if you are trading at 17, 18 times now forward, and if your earning growth again comes up mid-single digit, I think then the market will either correct or will more time correct. There is no way it can go up. It may move here and there due to euphoria on some news and other. So while I think Q3 had some signs that probably the bottoming out has happened, we saw almost an 8% growth in earnings after a very bad Q2. If we can deliver around 9 to 11% in this quarter with better commentary, and I think commentary is more important to me, I think markets will probably take heart. And that's why I said that unless the earning growth comes back to 15-16%, there is no point giving higher Nifty targets. So this is a year which is of consolidation. You have to really go level 2, level 3 to make that return, and be a little more defensive in nature. Do not just buy stocks because they have corrected 40-50%, but they are still trading at, let's say, 50-60 times. And then that's the trap you need to be very careful of. So to me, that's the most important factor. And I would eagerly look forward to, I'm expecting around 9-10% growth in earnings. Let's see how it plans out. Non-financials maybe 7-8%, with financials probably early double digit. If that plays out well with better commentary, I think then you'll probably have a second half, which is a lot more decent. So I think financials clearly will report good double digit, and that's probably 1/3 of the index. And I hope IT doesn't see too much drawdown. So you also have to see what dragged the index. It's not just about incremental earnings. And I think, as I said, domestic consumption should do well. I think power and energy sector should report better earnings. We've seen peak power demand in February, almost 238 gigawatts. Almost 135 billion units. And I think the transmission capex is well on track. Government picked up expenditure in the last quarter. So hopefully your last GDP data would be also 7-ish plus. And if nominal growth is 10-ish, 10-11% this quarter, there's a good chance that earnings could be around that.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims?
Profit, you're watching Profit Top Trades. I'm Mahima Vachrajani. Let's take a quick look at how the markets are panning out to be right now. Well, the markets have certainly upheld the cheer throughout the day. The Nifty 50 trading 2% higher. The Sensex also doing very well. The Nifty is in fact sustained the 23,300 levels. The Sensex has crossed the 76,700 levels. Let's also pull up the broader markets. The broader markets are also in tandem with the benchmark indices. The mid cap 150 is trading 2% higher. The small cap 250 is also trading higher as compared to mid cap 150. It's doing a tad bit better, trading about 2.7% higher. Let's also pull up the advanced decline ratio and see how the breadth of the market looks like. There you go. In terms of advances and declines on the Nifty 50, there are hardly 3 declines. That was mildly in the declines, and that must be some consumer names like Nestle. And in the entire universe of NSE, there are 158 odd declines versus that of 2,150 odd advances. Let's pull up the Nifty 50 heat map and see what are those 3 declines on the entire Nifty 50. There you go. There's ITC and there's HUL, 2 counters from the FMCG space not doing very well, and Nestle slightly in the red. So these are the 3 FMCG counters that are not doing well in trade today, but otherwise the Nifty is definitely upholding the cheer in the trade today. Let's also pull up the NSE 500 and see what are the counters that are actually doing well in trade today from the broader end of spectrum. The counters that are really pulling up in trade today is something like a data patterns from the defense space. Lot of counters in the defense space in fact are buzzing today. There's data patterns, there's Mazagon Dock, there's something like a lot of those defense names in fact buzzing in trade today. But some counters not doing well. Well, Questcorp, of course, on the back of its demerger date, it's seeing that correction in trade today. Something like Max Health, Anupam Rasayan, Sumitomo Chemicals, Godrej Consumers down by about 1.5 odd %. The rally in Godrej Consumer, in fact, it's an interesting chart. If we can pull up that Godrej Consumer in the past 1 week and 1 month, if we compare those two charts, there you go. The stock has seen a significant downtick despite of brokerages upgrading their faith in the counter, but the stock is seeing a significant downtick. 1 month, the stock is up about 17%, but in the past 10 odd days, the stock has seen a significant pressure. In fact, there are some counters which have continued to see pressure. There's Kesoram Industries, there's Max Health, there's Puravankara, which is down by about 1 odd %, but Kesoram continues to be under pressure, down by about 6 odd %. Talking about some good names, like I mentioned in the start, there are defense names that are doing well. There are mobile manufacturing companies that are doing well, and this is because the US has exempted the reciprocal tariffs on manufacturing of smartphones as well as computers and electronic devices, and the overall rate of tariff right now on the base countries is around 10 odd %, but China stands at 20%. So this means that there will be a shift of supply chain to India, which is why stocks like Samvardhana is up in trade today by 7 odd %. Dixon Tech is up 3 odd %. Let's also pull up something like a Keynes Technology buzzing in trade today. Some defense names doing well include Data Patterns, as I mentioned earlier. Something like is also doing well. So Titagarh, some railway names also doing well. There is also Garden Shipyard, which is doing well. So all of these counters doing well in trade today. Let's also pull up the sectoral heat map. All sectors trading in the green. Let's pull up the sectoral heat map and see what is the top. There you go. Realty leading the pack entirely. We've seen that Realty has seen a significant pressure in trade post October, and that was the selling pressure that was coming in the counter. Now that Realty stocks have significantly corrected, the stock is seeing the entire pack is seeing a significant upward. Let's also pull up some of the names on the Nifty Realty. There's Macrotech, which is doing well. All counters in green: Macrotech, Anantraj, DLF, Prestige, Sobha, Suntech Realty, Phoenix Mills, as well as Oberoi Realty, all trading in green within that range of 7 to 4 odd %. Let's also pull up the Nifty Defense and let's see what counters are doing well there as well. Leading the pack, of course, is Data Patterns, up by about 11 odd %, but some other counters also doing well. There you go. Data Patterns up by about 12 odd %. All right, shifting focus and of course welcoming our guest for the day, Mahesh M. Ojha, AVP Research and Business Development from Hensex Securities, is joining us. Mahesh, a very good morning to you. Before I come to you, Home First Finance has been in focus today. It has, raised over 1,200 odd crore rupees through QIP. Let's go across to Harsh for more details on that. Harsh, take it away.
Well, expected, announced in fact last week, but they've exercised the green shoe option as well. Home First Finance, 1,000 crore was the fundraise quantum. They've hiked it to 1,250 crore, 1.28 crore equity shares, or rather 1.29 crore equity shares issued at a price of 970 rupees per share, which is roughly a 9% discount to Friday's closing price. It's around a 5%, around a 4.8% discount even to the price set as per SEBI norms. So that's how it really stacks up. There's been a bunch of very interesting buyers. Now this is where it gets interesting. One, you have an IFC, International Financial Corporation, which has bought 28% of the 1,250 crore raise that Home First has done. This translates to roughly a 3.5% stake currently post money, which is post the fundraise in Home First Finance. Then you have an HDFC Mutual Fund, a Fidelity, small cap World Fund Inc., and you have an AB Sun Life, among other names, which have invested in the company, comprising around 60 to 70% of the cumulative fundraise. These are marquee investors and therefore may stand out and may remain in focus today.
All right, the stock is doing pretty well in trade today. Mahesh, what's your view with regards to the entire QIP scenario for Home First Finance, and overall, what's the outlook like for the counter?
I think these are very good names in QIP, hence the stocks is reacting on the positive side. I think the stock has some more upside potential up to 1,350 to 1,400 level. Particularly sector, if you are seeing, then sector also we are seeing some positiveness in this fiscal year. So I think investors should can hold. If anyone have, then can hold, and if anyone want to buy, then any dip can be used for buying. Some upside potential could be there.
All right, so that's the view with regards to where Home First Finance is concerned. The next stock in focus is from the internet space, and Swiggy has once again done something different and has launched professional services marketplace app called Ping. In fact, they had already announced this app earlier as well. Now they've brought in more update. Let's bring in my colleague Agnidev for more details as to what the details are now with regards to this app, because we have more developments with respect to the particular app. Agni, take it away.
That's right. So Swiggy has launched the Ping app for consumers. So this is a development that has come in today. Like you rightly said, Ping for the seller side, for the business side, was already launched earlier in January. Now what the company has been doing since January up to April is onboarding service providers, taking in inputs and getting in updates as to how they can improve the UI and the marketplace. So finally, when the pilot of onboarding processes is done, the company has now gone ahead and launch the consumer app, and this is only for Bangalore. So Ping will offer services including financial advisors, astrologers and health experts, among other things like event planners and all. So like Urban Company, a direct competitor for Ping, is lining up a 528 crore fresh issue in its IPO soon, and these two companies will be going head to head. So Ping is the second step by Swiggy, the other is Snack. So these two are the independent apps that Swiggy is going for, moving away from its unified app solutions that the company is offering.
Thank you so much for breaking that down for us, Agni. Mahesh, I'll come to you. Like Agni mentioned that, Swiggy always had this unique selling point that Swiggy wanted to have one app and that includes everything, their quick commerce, their food delivery, their Swiggy Genie, everything. But now they're shifting focus and also building different applications for different services that they're providing. So I have a two-part question for you. One, how successful do you think this Ping will be? Because I don't think that Ping will be able to compete head-to-head with Urban Company, because they've been in this business since quite some time now, and it's difficult to establish that kind of marketplace and disrupt and give competition to something like an Urban Company. And second, do you think that Swiggy shifting its focus to building different apps is going to bring in growth for the company?
I think they are trying to catching some other space revenue, but I think it could take time. It's a testing type scenario, so I think it could it should be wait and watch. Could strategy for Swiggy. So something they are doing something innovating that could be watchable. If any product, any app could be success, then there is an advantage for Swiggy. So this is good for innovation type of act. But as you told, we are not much optimistic for successful for this particular app. But yes, they are doing innovation, and time will tell the particularly success or not successful.
Okay, shifting focus, my colleague Aishwarya got a chance to speak to Sunita Reddy, MD at Apollo Hospitals, where they talk about the implications of the current tariff scenario on the pharma sector. Listen in to a slice of that conversation.
At this time, I really do not have concerns, because one is that this trade situation seems to be very dynamic. It seems to be evolving every different day. But if you look at, if you look at pharmaceuticals, the US has a huge advantage by importing from India. 47% of all generic drugs used in the USA are from India. And this is like a $270 billion saving opportunity for India. So it is, though it might be a trade deficit, it is a surplus in terms of, decreasing costs for the US. So I think that, in a way it will be protected. When it comes to medical equipment, we are already paying very high import duties, 36%. I think the import duty part of it is where I'm hopeful that with the trade negotiation, we should be able to level it at a level which is much lower, because it is, after all, life-saving equipment. So on the whole, even though some medical consumables are hit, I don't think the impact is of relevance today. And moving forward, it should become an advantage for healthcare in India.
Ma'am, if we were to strike a deal, going up in the future between India and the US, from a pharma perspective, from the medical side perspective or hospitals perspective, what do you think you would want to be really jotted down or put forward within the deal as well, from your sector's perspective?
I think from our sector's perspective, it is very clear that there is an imbalance, that while, not from pharmaceutical, but if you look at medical equipment and consumables, that there is a duty that we are paying for the export of consumables, but it is far outweighed by the import duties that we face. So I do hope this is a negotiating platform that creates a win-win for us, so that we are in a comfortable position to export the work that we do, the medical consumables, continue with the pharmaceuticals, but also have an advantage for the US to send their medical equipment, because in terms of medical equipment imported in India from the US, it is actually a very insignificant amount, but there is potential to grow.
All right. Aishwarya also had the chance to speak to CII President Sanjeev Puri, who spoke about the impact of global trade war and what it means for the Indian economy. Listen in.
Various economists have quantified the impact between 20 to 50 basis points. Leaving that aside, what I want to say is that the Indian economy has its own momentum. And despite this uncertainty and this in the tariff situation, I think Indian economy will continue to progress, will be resilient. There are several factors that are continue to improve from the Indian side. So I think these are all positives, including the fact that a lot of policy decisions and good reforms are continuously being taken forward. What we need, of course, to be cognizant of is the fact that places that have excess capacity or face tariffs will be dumping stocks into India. We need to monitor that and take agile action. And the good news is the government has already announced a group to monitor it closely. But I do also believe that ultimately the bilateral trade agreements with US, EU, UK, and all of these countries, the EU president with the cabinet, the the UK delegation and delegation from other EU countries has been in India, and one gets a sense that sooner or later we would have those agreements also. I think with these bilateral trade agreements coming into play, I think it will be very good for the Indian economy.
So what are you hearing from your CII peers? You speak and converse with people from various sectors and industries as well. From their perspective, and when the trade deal or the negotiations do happen from the government side, what is it that they might be asking for? Certain sectors have seen a relief after, say mobile phones or laptops, durables on that front have seen a relief, but automotive is a concern. So from specific sectors, what are you hearing, and for the government, what is their message, and what do they expect from the trade deal if that happens in the future?
I think, as I said, a trade deal that is mutually beneficial is what is required. And of course, it's I don't want to get into sector by sector. That's be a long thing. But broadly, yes, obviously, it's a process of negotiation. And in the end, I think what I'm really saying is that bilateral trade agreements will be good. This is something that the industry has also been asking.
Any recommendations so far?
70% of the global trade is in global value chains, and these bilateral trade agreements are also important from getting into global value chains.
All right. Right, that was the president of CI, Mr. Sanjeev Puri, and the interesting takeaway from that conversation was that the Indian economy is resilient. No matter what tariffs are being imposed, the economy has remained resilient, and this is on the back of multiple initiatives by the government as well as the policy makers. Now, shifting focus to the power sector has been making waves in the trade today, and Tata Power signs power purchase agreement with NTPC. Mika joins us with more details on that. Mika.
Tata Power is in focus because of a power purchase agreement that it has signed with NTPC. Now, this is to set up a 200 megawatt firm and dispatchable renewable energy project, which is basically a mix of solar, wind, but also has a battery energy aspect in the project. Now, the capital commitment for the contract is set at 4,500 crores, and it's proposed to be set up in the next 24 months. Now, the project is expected to generate around 1,300 million units of electricity annually. A little bit about now Tata Power's updated capacity details. As per the company, their renewable utility capacity is now at 10.9 gigawatts. Out of this, 5.5 gigawatts is currently operational, and the balance 5.4 gigawatt is under various stages of implementation. But the company does expect these projects to be completed in the next 6 to 24 months in a staggered manner.
Right. Thank you so much for that, Mika. Mahesh, the stock is up 4% as we speak, Tata Power, and this is on the back of the power purchase agreement that it has signed with NTPC. What's your view with regards to where outlook for Tata Power is concerned?
I think this agreement is positive for Tata Power, and we are already bullish on power sector as well as Tata Power. From 1 year perspective, if we are looking on Tata Power, that 525 level could be target for a Tata Power, and this agreement is also positive for Tata Power.
So this news is definitely positive for Tata Power. We're seeing that in the stock reaction itself today. The stock is up 4%. All right, shifting focus to auto companies. Now, in a relief for auto companies, US President Donald Trump has announced that he may pause the levy of 25% tariffs on foreign autos. What can you tell us about this one, Megha?
On the back of a consideration on the relief from the reciprocal tariffs, you've seen auto stocks buzzing in trade today. Just to give some perspective to the viewers, Trump had imposed a 25% tariff on foreign autos as well as a 10% reciprocal tariff rate on the UK. Now, these tariffs have been temporarily paused for 90 days, and there's a hope for them not coming into effect in the end. In terms of auto and auto ancillaries with high US exposure, you have Sona BLW, 40% of their FY24 revenues came from the US. Ramkrishna Forging, Bharat Forge have a 25 to 27% US exposure as of FY24. Tata Motors at 23% due to JLR's exposure. Samvardhana Motherson is also in focus with an 18% exposure to the US in terms of revenue in FY24. You have also Balkrishna Tires at the same metric at 18%, as well as Apollo Tires and Sansera Engineering, which have a lower exposure of around 3 to 9%. Now, Tata Motors is seeing major relief today. It was expected to get most impacted by the tariffs due to Jaguar Land Rover, and JLR actually had a 26 to 33% US volume exposure in FY24 and 9 months of FY25, and it accounted for 23% of Tata Motors FY24 top line. And Kotak had expected a potential earnings downside of around 15 to 37% based on how the tariffs were imposed. You also have Samvardhana Motherson in focus today. The stock has gained quite a bit. It was expected to be impacted by the indirect effects of the tariffs around the world. The tariffs were set to hurt companies' supplies to foreign OEMs that actually export to the US. And the relaxation on imports from Mexico and Canada is a big positive as per Axis Capital's note today. And then you have Bharat Forge and Ramkrishna Forging also in focus. They derive more than 30% of their revenues from the USA, and tariffs would be a second serious blow after the delay in the EPA norms. And these were norms that were expected to lead to a pre-buy in FY26 but haven't come into place yet.
All right, Mika, thank you so much for giving us that information. Let's in fact pull up Tata Motors and see what it's doing in trade today. In fact, even Samvardhana Motherson posts that Tata Motors is up 4% on the back of the relief coming in for tariffs from the auto sector. Samvardhana Motherson has two positive news. One being, of course, the relief on tariffs from the auto space, and second, the relief, that is the exemption of reciprocal tariffs on smartphones, computers as well as electronic devices. Samvardhana Motherson makes display screens for computers as well as phones, and that is why it's seeing a significant uptick in trade today. Mahesh, I'll come to you on this one. Two big reliefs in two big sectors coming in where, tariffs are concerned. Your view with regards to, of course, autos as well as the entire EMS space.
I think we are seeing some pressure due to tariff on Tata Motors, on Sona BLW, Bharat Forge, as well as Summit. So I think these companies' revenue are more exposure to US. So these companies are getting relief for the 90 days. From other specific counter, I think there's that are available at attractive level, as well as if you see Tata Motors, this is also on available on attractive level. But yes, tariff concern are there, and we have seen some downside. But this is a relief for auto sector as well as auto component sector. Sona BLW and Bharat Forge specific revenue from US, that is the more concern for them. So these companies are getting some benefit on this news.
All right. And in fact, I heard Dinshaw Irani speaking with NDTV Profit today, and he mentioned that for this particular quarter, it's not going to be the earnings that is going to, see this stock movement. I mean, we'll see stock movement on the back of commentary that is coming out from US, and we're seeing that day in and day out in the past few days. Now, let's also, understand what's happening next. The cutoff for MSCI Rejig may begin today. Somit joins us with more details on what to expect. Somit?
Well, yes, multiple stocks remain in focus on the back of MSCI's expected changes that could come in on May 14. Now, as per the MSCI methodology, the cutoff period typically spans in the last 10 working days of the April month. And as per Nuvama, the MSCI cutoff has should ideally begin today and should last for the next 3 trading sessions. So, and the official announcement regarding the changes are expected to come in on May 14th. And the inflows and outflows regarding these changes will happen on May 30th. So, which are the stocks that we need to keep an eye out for? Now, Nuvama is expecting 4 stocks to get included in the MSCI Standard Index and 2 stocks to move out of the Standard Index. Coromandel International is a stock that could get included in the MSCI Standard Index, and the inflows could be anywhere around 200 to 210 million US dollars. Then there is Paytm, which could see an inflow of close to 209 million US dollars. Nykaa could see an inflow of close to 178 million US dollars, and Adani Energy could also be included in the MSCI Standard Index, and the inflows, if it gets included, could be around 176 million US dollars. And 2 stocks that are moving out of the MSCI Standard Index is Sona BLW and Thermax, and both these stocks could see an outflow of anywhere between 110 to 160 million US dollars, which is nearly 14 to 20 times that 20-day moving average. So keep an eye out for these 6 stocks. 4 of them are getting included, while 2 of them are moving out of the MSCI Standard Index. The cutoff date should ideally begin today and be for the next 3 working days, and the official announcement is expected on May 14th regarding the MSCI changes.
Amit, thank you so much for breaking that down for us. And Mahesh, thank you so much for taking out time and giving us all those insights at NDTV Profit. Well, with that, we're completely out of time on this edition of Profit Top Trades. Stay tuned. I am India Market Close next.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know.
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Somit Sarkar. And quickly on to where we are, where markets are concerned. We're around 2% higher, 2.2% higher on the Nifty. So a good day of trade. We're above 23,300 at this point. So we've not just breached 23K, we're now comfortably above it. Let's look at the intraday and we'll see that it's been a largely steady day of trade. And of course, barring that initial reaction, it's been very, very, very tight in terms of the trade itself. It's been a very range-bound day on the Nifty. Let's pull up the Bank Nifty as well, because some part of the action is happening in the Bank Nifty. 2.6% higher on the Bank Nifty as well. We'll also quickly look at the constituents on the Bank Nifty before I toss it to Somit for broader markets. And after this, we'll probably look at advanced decline. IndusInd doing very well in trade, 6.5% higher, but Axis doing well, contributing well on the index as well. Nearly 30 points contributed by Axis on the index today. Not too many times that we see that. HDFC 3.5%, 100 points contributed by HDFC on the Nifty 50 index. And then there are some others which are also doing fairly well, including an SBI and a ICICI Bank, which are doing very well and contributing well to the index. So the Bank Nifty doing well. That's the one clear sign that the index, the Nifty 50 index, is also likely doing very well. So that's one. The second one is, let's pull up the advanced decline as well. And the breadth of the market looking very, very solid today, and it's been that way pretty much through the day, signifying that even broader markets are seeing a very decent, strong pullback in terms of the way they've performed versus last week. So we're seeing a good recovery which is playing out over the last at least couple of trading sessions, Somi.
Right, the Nifty Small Cap and the Nifty Mid Cap 100, both the indices are trading near day's highest point. In fact, Nifty Bank and Nifty 50 has also seen very low correction, but it's the two indices which have seen the most correction. In fact, down over 1% from day's highest point, that's Nifty IT and the Nifty FMCG index. Apart from that, stocks that have been gaining on the FNO side is HFCL, Macrotech, Samvardhana Motherson, Sona BLW, IndusInd Bank. Inox went up more than 6%. In fact, DLF is also up more than 6% in trade. On the cash side, it's the Inox Green, which is up 17%, Sai Life up 14%, JMR Power 13% higher, Goldev International up for the second consecutive session, up 15% in trade, Data Patterns 12%, Mazgao Dock was up 11%, in fact now it's up 10%. A lot of defense stocks have been buzzing in trade on the cash side. Harsh, but what are the factors that have been leading to such moves in the market?
Yeah, trying to kind of sum this up, what's playing out in markets currently. Nifty has risen 2%, and there's a second straight day where we are up 2% odd. So very healthy in that sense. HDFC, ICICI, both carrying the index up 160 points. If I were to add maybe 2 to 3 more stocks, if I were to add an Axis, if I were to add an L&T, you'd be very close to 250 positive points added by just these 4 or 5 counters. So very strong in that sense in terms of the way in which some stocks are pulling the index. The breadth is positive, markets largely range bound, and this is across the Nifty 50, mid cap and small cap. We've seen very steady kind of a day for all of them. All sectors trading in the green, a key positive, but auto really standing out in that sense. Metal, auto, banks, metals and auto are up 3% nearly. So auto is up 3% plus, but metals also up nearly 3%. So those are some indices also sectorally which are doing very, very well. Last off, I just want to pull up the contributors on the Nifty because fascinating on that count. And in terms of the way it's playing out, HDFC, of course, the top one there. But you're seeing ICICI doing very well, L&T doing very well. And the heat map on the Nifty also, if I can, and quickly flagging out a couple of names which are really standing out in trade. There you go, Shriram Finance on the back of the repo rate cut and L&T up 4.5%. Not too many times that we see such zing in some of these counters. And Adani Ports, Adani Enterprises also up nearly 4% each. So those stocks also really doing well. Auto stocks, Maruti is doing very well, nearly a 3% higher, and Nifty Auto is up 3% as I did mention. So some pockets which are doing very, very well in trade. Samit.
Well, let's also welcome in Kush Bora, founder of kushbora.com. Kush, after the sharp up move that we have seen for Nifty, it is comfortably now above the 50 DMA, but do you see the 100 DMA acting as a resistance for the Nifty currently?
Hi, Sumit. First of all, very good afternoon to you and to all the viewers. Well, yes, I mean, there is a bit of a resistance near the 23,500 mark, which is supported by, the call option in the build-up that we are seeing. Also, the falling trend line resistance of the fall that started from September. There's a fresh trend line resistance near the 23,600 mark. While both these levels are still some distance away, they provide enough cushion for anyone who wants to create fresh longs, albeit the risk-reward ratio from here on will be 1:1, where 23,000 will start acting as a good support. I think what's happening is that some sting is being taken out of the Trump tariff announcement, or maybe just we're waiting for the next big one, which might just shake up the markets a bit. But no news is good news, and as long as there are no such indications, markets will take these as a positive, and hence the kind of recovery that we've seen over the last 4 to 5 sessions. And looks like this momentum, at least for now, it looks like it's here to stay. This is also supported by not only the 23,000 foot base, but also the 23,300 foot base where the markets are trading at currently. So I think investors, traders are getting some confidence back in the market, where the support levels are rising quite high, quite sharply, as the markets also move up sharply. So if you've got long positions, continue to hold. If you don't, as I said, with the risk reward ratio of 1:1, if that comforts you, stop loss around the 23,000 mark could still create fresh longs.
Right, couple of indices that I would want to highlight, the Nifty IT and the Nifty FMCG index. Now, though the major indices are trading around the day's highest point, these two indices have fallen more than 1% from day's high. How are you looking at both of these indices currently?
So with both of these are very differently placed in the sense that IT we know has been under pressure, and I still maintain that could remain under pressure going forward. All the meaningful moves that we've seen, and the big names are more of short covering rallies from oversold territories, so that might just continue for some time along with the market. But other than that, I don't really see a meaningful recovery coming into the IT spaces, IT space for some time. Be it your mid caps, be it your large cap. For long-term investors, this might be a different story, but at least from a trading and a momentum perspective, not too gung-ho about the IT moves. In fact, these moves could well be considered as a shorting opportunity on the likes of TCS, Infosys, even in HCL Tech, at least from a trend perspective. Now, on the other end of the spectrum is the Nifty FMCG, where there has been a meaningful recovery. And if I go just by the index, the resistance is around where the technical levels lie, which is 56,700 thereabouts. That's been the high for the day. It's cooling off a bit, but that is after a very smart recovery from 50,400 odd levels over the last month and a half. So this is more of profit booking in FMCG and switching to other sectors. But I think the FMCG rally might just continue for some time. And IT, as I said, on the opposite end of the spectrum, is seeing a short covering bounce and could well resume the downside.
Right. And when it comes to the Nifty Bank Index, comfortably above the 200 DMA now, comfortably above the 50,000 level as well. What is the next resistance that you're seeing? 54,000 level?
Also comfortably above the rising trendline resistance. That level comes to 50 to 250, 50 to 300. And I'm talking about this major trend that started from COVID low. So it's once again testing those low highs. And rather the resistance mark and trading above that. For now, at least it's trading comfortably above that. Now, as far as the levels go, I think 50 to 300, that's where it's trading currently. That is where you've got some resistance going. But beyond this, I think the intermediate level of resistance will be 53 200. Once that is taken out, yes, 5400 is very much on the card. And you'll recall we've been that much more bullish on the financial space, especially the bank Nifty compared to the Nifty. And that looks like going forward that trend might continue, at least from a near to a medium term perspective.
And therefore, Kush, your picks for this afternoon.
Hi Harsh. Both of them on the long side. We've been bullish on the within the healthcare space on the hospital names. Apollo Hospitals, Narayana Hrudayalaya. A lot of these names. Today it's Rainbow Children's. So now, if you see, the movement has been rather sharp today. 1580 was our first target, followed that up by 1625 as the second target. The stock came very close to 1580, the first target, but has seen some profit booking. But the call very much is intact. So for levels of 1580, 1625, around 1500, that's your stop loss. You could consider a long. The second one is on Mangalore Chemicals. Again, one more stock that we discussed in the past. Very sharp rally, but in market volatility, the stop loss was triggered. But the direction has been at least pointing north. Today also, if you see on the back of good volumes, the stock is trading with good gains. So for levels of 200, 205 with a stop loss around the 190 mark, Mangalore Chemicals can also be considered as a long trade.
Okay, Kush, thank you for those views. Stay with us because special guest today, Ashish Somaiya, CEO at White Oak Capital AMC, joining us this afternoon to give us perspective on how he's viewing markets. Hi Ashish, Harsh here, good chatting with you. Ashish, first off, how are you viewing the Indian market at this point? We've now started to see a bit more calm start to come through. What's your sense at this point, and how are you viewing it, the whole global context along with how India is placed?
Yeah, I think I don't think we should draw too much comfort from a couple of days of up move really. I think there is still a lot of uncertainty is what I would say. First of all, obviously because if you see the way US and China, there has been some sparring, and then intermittently European Union and other things. So while we have been more of a, for lack of any other word, more of a sideshow, but clearly the risks are still not fully mitigated. And in the last few days itself, we have seen statements flying back and forth. Of course, there is some talk about people coming to a negotiating table, and but I think the disruption for some time is here to stay. So today, I mean, we are drawing comfort from some developments over the long weekend that we had. and then maybe tomorrow or day after we again run the risk of some statements coming by. So while local conditions in India have been improving, and at the same time, we seem to be at least a medium to long term beneficiary of what is happening. But I think in the short term, stock markets globally do tend to get correlated. So right now we are dancing to American tunes or tunes of stock markets globally, and from that perspective is what I said, that from time to time you will see 2 steps forward, 1 step backward. Those kind of movements and high volatility.
Ashish, so want to get this absolutely clear. Do you believe that there's going to be more volatility, or do you believe that we run larger risks? Because both would be mutually exclusive technically. Volatility will likely lead to opportunity, but risks, do you believe India runs a large risk per se? Is that how you're viewing it?
So I would clarify that I don't see India directly as a market or directly as a participant. I don't think we are directly running big risks. What I meant to say is that till the time the global scenario is uncertain, you will find very high volatility, and high volatility is basically a marker of the fact that all market participants put together cannot wrap their arms around what the possibilities and what the fallouts are going to be. So when I meant high volatility, I meant more to do with the global scenario, more statements flying back and forth from the major economies in the world. And that could also result in downside, is what I meant, because while we are not directly impacted, or while one is bullish about India's prospects, the reality is that in the short term, all markets get correlated. We have seen this, over 20 years, we've seen it at least 3-4 times, that globally, when the economy is slowing down, or if there is some risk emerging out of, say, US economy or US markets, then, US being the biggest market, everything gets correlated. And even if our corporate performance or even if our earnings are not impacted, at least in the short term, because of correlation with markets, even we have witnessed downsides.
Right. Now, if you talk stock specific or sector specific here, IT sector. Now, we have seen a sharp correction when it comes to the IT sector, obviously because of the recession risk that is pertinent. Obviously, that will lead to lower spends in the global market, which could indirectly impact them. But do you see after this correction that the valuations have now priced in the lower spends that could impact their top line, or still there could be some more downside to the IT space?
So see, our belief is that it's a good contrarian bet, if you really ask me. And over the last few years, there have been many times where obituaries have written and very negative kind of indications have been given out about IT as a sector. So I think, if you really see, our sense is that valuations are attractive. It has been there have been ups and downs, but right from October 2021, it has been a rank underperformer. So I think that is something to keep in mind. And, markets obviously will react to relative pricing and relative valuations. So from here on, our sense is that it's a good bet. The second important thing is that, I must be mindful that whenever we say IT, see the way we manage our funds versus how IT in conversations is perceived. I just wish to clarify that when we run IT funds or digital funds, 30-40% of our portfolios are, big tech or what we see as IT traditionally. Another 30-40% of our portfolios could be digital or digital businesses. And then there could be telecom and ancillaries and others. So when we run funds, we run reasonably broad-based funds. But I can imagine your question is on a big IT. And from that perspective, I think the worst is behind us.
It was on the large cap IT like TCS, Infosys as well. Now, from global market to domestic market, if we shift focus, cement is one sector where capital expenditure has been increasing, cement demand has been increasing, pricing is one factor which is on the negative side or has been pretty much stable, because of which there has not been much of a re-rating when it comes to cement space. But now going forward, do you see that given the capex increase that will come in and given the lower raw material cost, there could be some kind of a re-rating that could happen in the cement space, because that sector has been in a lull for quite a long time now?
Yeah, I think, clearly one driver is real estate cycle, because in the last 3 to 4 years, there has been significant inventory absorption, and now, across the board, you can see project announcements and stuff. So real estate cycle is one, consolidation in the sector is other. And the third is obviously as far as the government is concerned or as far as the capex push is concerned, and then followed by hopefully some private sector capex. So, I agree with what you pointed out. I think it is likely to be on a uptrend or likely to be in an improvement phase going forward, and one would be constructive.
Ashish, wonder what your take with regard to banks is. Of course, it's the largest allocation in your portfolio as I see it, at least in the FlexiCap fund. And a large chunk of it is skewed towards the two largest banks, the way I see it at this point, ICICI and Kotak in the private sector space. ICICI and HDFC, I beg your pardon. Those are your two largest bets within private banks. What's the rationale behind this? Because you've got one which is a very solid outperformer, has been a rank outperformer in the last 3 to 4 quarters, and then you have the other who's been the rank underperformer. So what's the rationale? Give us the thought process.
See, there are, I think, 3-4 things to be kept in mind. I mean, when you see, you mentioned, say, Kotak Bank, HDFC Bank, see, a couple of them obviously have had management changes. That tied with huge amount of FIS selling consistently. I mean, if you see the year 2022, and then again, if you see fag end of 2024, early 2025. So the reason for underperformance is 3 or 4 things. One is management changes and what the market perceives of the fallout of management changes. Second is obviously some amount of headwinds, because in the last 3 years, what has worked in the markets is everything which is cyclical, macro-driven, policy-driven, right? And on the other hand, typically if you see fund houses, there are a lot of large fund houses which are so-called, say, value-leaning, right, or cyclical, correct? And on the other hand, if you see the other side is, troubled with FIS selling and outflows. I mean, 21-22, we had 30-35 billion outflow, and the last 6-7 months itself is about 25 billion outflow. So there are fundamental reasons, and then obviously there are these technical reasons related to fund flows. But net-net, as a result of this, what has happened is that now for 3-4 years, there has been significant underperformance, and performance going forward, fundamental performance, actually the incremental markers are in favor. So if you see RBI's policies, if you see our economic conditions, so the delta change is clearly in favor when you speak about these banks. And I think even the fund flow scenario, given what is happening in global markets, given what is happening in the US, at some point in time, even the fund flow scenario might rotate. So my sense is that, that kind of gives you a broad picture of why we have some of these banks as the top holdings, because that's where the relative value is, that's where the underperformance has been, and that is where the incremental news is likely to get positive.
You're right, Ashish, when you seem to suggest that there is no margin pressure in a significant fashion anticipated, or that you anticipate on these banks.
No, see, I think that if you see, there is likely to be significant amount of growth going forward, right? And as the big banks clearly are able to choose their business. Plus, you see, like over the weekend, one of these big guys also, reduced saving bank rates. So I can understand where you're coming from. But I think typically when the market is expanding, when the credit is set to grow, the larger banks are able to pick business and grow in a selective or a cautious manner as well. So I think that those concerns would be taken care of.
And Ashish, your portfolio also skewed more towards large cap than mid and small. Is that how you're looking at it? And any cash that you're sitting on in terms of your portfolio allocation?
No, not really. See, in the FlexiCap, let's take that as an example, because that is what I saw flashing here. So you would see about 63-64% in large cap. In fact, you will see about 24 or 25% in small cap, right? And nearly, say, 10% mid cap. Now, what you need to look at is that in a FlexiCap fund, large cap obviously stock 100 stocks. Mid cap is the next 150 stocks. But if you see, because it is FlexiCap, what you would see as small cap is actually, not just the 250 stocks by definition, but also some of the long tail. And I think the long tail is where a lot of ideation is happening. So, I wouldn't say this should not be seen as defensive. In fact, it would be seen as, in a FlexiCap context, it would be seen as a portfolio which is really seeking out opportunities in the micro cap, small cap kind of space. And the stance also shows that specifically what we call mid cap, the 150 stocks, is not where our team seems to be finding much value. So in terms of pecking order, you would usually find large cap, then mid cap, then small cap. But here, I'm sure you've noticed, deliberately the portfolio construct is large cap, then small cap, and then mid cap. And that is because small cap is the bigger universe right down to the tail, and that is where a lot of ideation is happening. As far as cash is concerned, it would be only something which is procedural in nature, but definitely, there are schools of thought on whether one should take cash or not. We belong to the school of thought which says that the outperformance should come from stock selection and not from asset calls. I mean, there's no right and wrong in this. Our belief is that we should outperform by remaining in equity. We should not try to beat the equity index by buying some other asset class, which may be cash or whatever it is.
Right, sir. And sir, just before we let you go, it's a two-part question firstly. The first part is, where are you deploying the incremental funds that you're getting? And the second part is, which are those sectors where you're sitting on the sidelines, and if there is a bit more correction, then those sectors might look attractive. So could you just take us through that?
See, I think if you see our portfolio, we spoke about financial services. I think the play, and we did have a couple of discussions on the banks. But if you see beyond the banks, what is interesting is there is 30-32% exposure to BFSI, but it's very widespread. It's not just banks. I think there is value in NBFCs, and beyond that in all the capital market businesses. So if you see in the last month or two correction, even the capital market businesses are down about 40-50%. Now, I always feel that they are not as cyclical as the market makes you believe. And I'm not talking just broking companies. If you see asset management, wealth management, the wider space of capital markets is not as volatile as the market makes it out to be. So clearly that has become attractive. The second is, if you ask me, what is it that one would want to look at, say the consumer space. Consumer discretionary, we do have exposure which is higher than the benchmark. But my sense is that if there is more correction, then consumer discretionary allocation would actually go up. So capital markets and consumer discretionary is a space to watch according to us. For more corrections, it would make it more and more attractive. But otherwise, if you really say, for example, even pharmaceuticals, our belief is that the back and forth of commentary emerging out of the US has played havoc. But otherwise, it's a sector where we are significantly overweight and we continue to be constructive. So financials, IT I mentioned to you is more a contra bet. And then there is consumer discretionary, and then there is healthcare, cement, industry, domestic capex. So out of whatever has done well in the last 3 to 4 years, I think manufacturing and capex is what we think is sustainable.
What within consumer discretionary, Ashish, are you betting on?
So it is all not necessarily. So it's a wide-ranging thing, right, from auto ancillaries, etc. But if you ask us specifically in our portfolios, it is more to do with the upper end of retail consumption. The stuff which you talk about, rising per capita incomes. So whether it is retailing, whether it is apparels, whether it is beauty products, eating out, the whole thing about spending, urban spending, luxury, hotels, travel, all of those.
Taken. Thank you so much, Ashish, for coming in, giving us those views. Critical at this point to get that perspective. So thanks for coming in and speaking with us. Great having you.
Thank you.
Anyway, we're out of time with regard to this segment of the show. Let's quickly slip into a very short break. On the other side, we'll get you dealing room chatter, which Somit gets us daily on Heard on the Street. And we'll take our stock of the day as well. So stay tuned.
That's huge. That is a biggie. It's out of there.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve.
Welcome back. You're watching India Market Close here on NDTV Profit. There's the March trade data which is flashing at the bottom of your screen. For perspective, we've seen good growth overall. Non-petroleum merchandise exports clocked a record high. They've grown 6% YOY. And we, of course, had some statements coming in from Commerce Secretary Sunil Bhartwal as well, who spoke about how despite WTO's pessimistic predictions on global trade, India has done relatively better. So some data coming your way with regard, some positive data coming your way with regard to merchandise exports. But let's go quickly across. Somit here with all that's happening or all the gossip from dealing rooms. Somit, is that positive as well or on a day like this?
Well, the trade data?
No, the whatever you're hearing from
well, yeah, most of them are the positive side. Firstly, it's Sanghi Movers. Now, what dealers are indicating is that this company is also into the wind EPC project, and when installation projects are seeing a sharp jump, that's also one of the reasons why the share prices were up for Sanghi Movers in the last couple of trading sessions. Apart from that, it is also expecting some large wind project order wins to come in for Sanghi Movers going forward. So keep an eye out for that counter. Second on the list is two South-based cement companies, KCP Limited and NCL Industries. We don't often talk about them, these companies, but what I'm picking up from the street is that large South-based influential HNIs are seeing buying both these counters, KCP Limited and NCL Industries. Third is Ajmera Realty. Now, dealers are indicating that there could be some potential positive announcement that could come in from the company's side in very soon. Hence, Ajmera Realty is also buzzing in trade. Then there is Havells. Dealers are indicating that there are buy flows on both foreign and domestic institutional desk. In fact, if you look at the chart of Havells, it was down at one point of time, it was down 2% in trade. But from there, we have seen a swift recovery. It's up 4% from the day's lowest point. Stock is up now 2%, and it's on the back of the buy flows that we are seeing on the institutional desk. When it comes to Infosys, dealers are indicating that there are positional sell flows on higher levels ahead of the Q4 numbers for Infosys that we are seeing. And lastly, when it comes to IndusInd Bank, that stock is up more than 6.5% in trade. And the buzz on the street is that the bank has initiated the process for searching its new MD. And dealers are also indicating that a potential ex-HDFC Bank employee is one of the candidates, and hence IndusInd Bank has also been buzzing in this in a day like this.
flying away in trade. Thank you so much for that, Somit. Interesting that some of those stocks really doing well in trade, especially Havells down, up really 4% from the day's lows, really standing out. We have Dharmesh Kant joining us, Head of Equity Research at Chola Securities, to talk to us about that and more. Dharmesh, quickly on to consumer discretionary first. Couple of big moves which have kick-started starting April. You will have more money in your wallet and in your pocket, hopefully, for most of us due to the tax incentives which have been laid out from FY26. Your sense and how would you play it? How best and in what sectors and what stocks in particular would you play this?
Yeah, good afternoon, Harsh. Good afternoon. Good afternoon to all our viewers and Kush as well. See, as far as extra money in the hands of consumers are concerned, this was done more with the insight that there is an economic slowdown which is about to happen this year. So government was aware of the fact. They have seen the GDP data for FY25 coming, and FY26, as you see, the predictions are further lower GDP data. The reasons may be, as of now, they will be saying it is like the tariff and things may slow down the economy. But the fact remains that there was a general slowdown after 3 good bull years of consumer spending. I don't see it's going to create much of a tailwind as far as the consumer discretionary spend is concerned, because it's a cyclical industry and you need a cyclical churn to happen. So this is more of a consolidation gestation period. Though you have also a boost from the RBI policy, 50 basis point of a rate cut is already being there. That will also add some benefit. To my mind, if a sector from consumption point of view which is going to benefit the most would be the real estate sector. Because we have seen the affordable housing segment where the inventory pileup was getting heavier and heavier. Suddenly in the month of March, there was a big drawdown out there, around 17-18% kind of inventory got lowered because of sales happening. And with this interest rate cut boost coming, now most are on the variable rate, so there was some anticipation of it as well. The real estate should do fairly well. So that's the only sector from a broader economy which I think if the market stabilizes here or is a bit optimist here, can see a good bounce back of 10-15% because that's headroom is there for most of the large cap names like Macrotech developers or a DLF or Overall Realty to have that kind of a stock price traction. Last 6-7 months they have done nothing, but now I think the last leg of this rally is due for them, which is likely to happen. Apart from that, I'm not very keen or interested in the consumer discretionary spend kind of sectors.
And when it comes to the IT sector, we have seen a sharp correction on a month-to-date basis. The IT index is down 10%. In fact, the top sectoral loser on a month-to-date basis. Today, we are seeing some kind of an up move. But do you think that all the negatives are priced in for the IT space or IT sector right now?
Definitely not. It's not even started. So if you look at the IT space for the last 2 years, every quarter there's a standard management commentary that 6 months hence things are likely to improve. It did stabilize for the last 2 quarters where degrowth was not seen, downgrading of their earlier guidance was not seen. A stability in the guidance and tighter guidance on the upside bias was the trajectory. But they have not beaten their numbers which they have given earlier. So first is the beat should come. I don't see this happening because there may be some relief on the tariff front in the form of the rates being levied, but you have a tariff being there. You have to pay some extra taxes out there. And that is still undecided how much the taxes has to be paid, what would be the discretionary spending. And unfortunately, even IT companies management can't give you a guidance now confidently because they themselves are not very sure how the things is about to happen. TCS numbers were a lackluster kind of a number for Q4 where the impact was not there to that extent. And to my mind, the body language and my takeaway was that they are also very unsure about how the things are going to unfold. And there are multiple vectors. It's not only about tariff. It is the AI, it's the new products which are there on the platform. In AI itself, there is a disruption between US and China. So many unfolding and unsettling theories will take place, which will have a practical business impact. So IT one was currency tailwind, again it has gone back. So these kind of trades will be there given the type of correction we have seen. But this year again, FY26 in INR terms, it will be a bit single digit kind of a growth. So if you are growing your profitability by 5-6%, why would you be paying 18-19% kind of a PE multiple on the large cap space? So one has to be staying away from mainline software related IT companies, engineering research and development kind of IT companies. Still there is a scope. And there, I think automobile-focused IT companies like Tata Technologies, Tata Elxsi, KPIT Technology stands a fair bit of a chance out there, given the type of valuation they are trading on. And there are two things. One is the automobile sales, and other is the manufacturing side. So sales has, downturn has already taken place, be it ICE or EV in the international market. And now things are seen picking up in a lower interest rate scenario. So they let go the first quarter of FY26, but Q2 onwards, things will start picking up there and the valuations are quite attractive. So those are three companies which I am keenly watching and recommending our clients to have a basket kind of a portfolio to buy there.
Right. Kush, coming to you, how's the charts looking like for Maruti Suzuki? The stock is up 2.5% in trade. On fundamental side, it's completely domestic focused. And given the fact that Harsh was also mentioning that there could be some extra money that could come in for Indians on the back of the tax cut that was announced. So how are you looking at Maruti Suzuki on charts currently?
Not too bad, Somit. However, what's happened is that, this is trading in, a bit of a range at the moment, if you see, and the range has actually shifted lower over the last couple of months. So on the upside, you've got 12,000 as one key number, and on the downside, 11,500 thereabouts has acted as a good support zone. So I would be keen to see the stock cross not only 12,000, but a little further higher, so about 12,100 or so. Once that is taken out, you might see fresh momentum. Also for whatever time has passed today, only about an hour or so remaining, the volumes are up, but not significantly, in the sense they have not even crossed the last 20-30 days of average volume. So if this move was backed by significantly higher volumes, then it would have made more sense. Otherwise, there could well be a chance that this rally might fizzle out, or at least, at the very least, the stock could consolidate near the 12,000, 12,100 mark. So I will wait. If I have a position, not an issue. Momentum picking up, volume starting to pick up. So I will hold on to this one with a stop loss around the 11,500 mark. But fresh positions, I would suggest only after the 12,100 threshold is taken out.
Right. Another stock that has been in focus is Home First Finance. Recently, the company raised over 1,200 crore rupees via QIP. Why the stock is buzzing? What's in news? Let's get in Harsh with more details.
Well, yes, stock of the day, and rightly so, 7% higher on Home First Finance, 1,250 crore rupee fundraise through a QIP. Before I go to the entire suite of the interested institutions, let me first talk about the fundraise itself. 1.29 crore shares issued at 970 rupees a piece. Its market cap is roughly 9,500 odd crore. Of course, prior to this 7.5% jump that we've seen today, and it was at a 9% discount to Friday's close. So something to keep in mind, 970 being that price. Let's also look at the buyers. One is you have an IFC, 28% of the 1,250 crore bought in by International Financial Corporation. You have an HDFC mutual fund. A bunch of them, 3-4 funds have bought in a cumulative around 11%. Then you have Fidelity, which has bought in 11%. So some good suitors coming their way. Small Cap World Fund Inc., White Oak, and ABSL Mutual Fund. Those are the other ones which have really bought in. The largest being IFC, which currently now holds around 3% odd of Home First. This is how the 1-year forward valuation for pretty much all housing financiers stack up. And Aadhar Housing looking at 2.7 times price to book, an Aptus value 3, a Home First nearly 4 now, given the kind of rally that we've seen. Of course, some of the other ones like a Canfin Homes and a PNB Housing and a LIC Housing Finance trade at a lower multiple, but of course offer lower growth as well. But it's an interesting space, and it's a space where valuations have come off. Either it's been a bit of a time correction or it's also been time plus price. Dharmesh, do you like housing financiers pure play? and are you positive with regard to them? Because that's one pocket of lenders which have been largely unaffected by this entire asset quality issue which has crept up over the last 2 to 3 quarters.
Yeah, definitely. I mean, keeping in line with the real estate play, this augurs well, and I definitely think that with benign interest rate scenario and the inflation correcting sharply, which will again give a further leg room of 50 basis point kind of a rate cut, that is to our judgment, and that's the elbow room also available if you look at the risk-free rate of return for India and US with the currency depreciation into play. So there's a chance of 50 basis point more. A pass on would be around 60 basis point put all together. So definitely valuations have corrected quite a bit, and they have not been doing anything out there, just languishing at the lower levels. So to my mind, again, the best way to approach this market in such kind of volatility is have a basket kind of a scenario. But the topic out there remains two stocks. One is I will take from the public sector space, that is LIC Housing Finance, and the other one is the Home First. So with other housing finance. So these are the three companies which looks pretty good to me from valuation perspective. Just be a bit patient. Don't be in a hurry to make money. If you are willing to wait for 3 to 6 months, then this could be a good value buy at current levels.
Coming to you on Home First, how does Home First look like on charts? The stock is up 7.5% today, but it has been range bound for quite a while, right?
Absolutely, and being range bound for such a long time and then giving a breakout, I think that's a very healthy sign, which suggests that yes, indeed, accumulation was on, in this stock for the last about 2.5, maybe a little more than that, in about 3 months or so. You have had days where the delivery marking on this stock was fairly high. It's just that with the kind of setup the markets were in, and the global news flow wasn't able to give a clean breakout, but today it has. Not only has it broken above the 1075 first resistance, but the recent swing high of 1120 has also been taken out today. So I think this is up for a good, clear run from here on as well. Even after the kind of moves that not just today, for the past 5 sessions, the stock is up from 900 odd levels. Despite this kind of a move, the stock is not close to overheated territory. Still some room to go. So if you have an existing position, please continue to hold for levels of 1200 as the first target, and then 1265. If you want to place a stop loss, that should come close to the about 1080 mark. Also, if you have an existing position, you should keep a trailing stop loss and ride this momentum. I think after this breakout, the stock is headed for much higher levels.
Right. Dharmesh, I missed taking your view when it comes to the auto space. If one wants to avoid this global geopolitical issues that we are seeing, then do you think Maruti is one of the right bets at this moment, or any other domestic facing auto stock that you feel right at the current valuations?
I will go with them, but not Maruti. It's Mahindra and Mahindra. I think that's the outlier in the entire auto space. And the reason being, all its verticals are doing well, be it SUV segment or a three-wheeler segment, tractor or farm equipment segment has done pretty well. For the month of March, they reported, sales in excess of 20. And for the quarter itself, it was 18.9% of the total vehicles sold by them. Going forward, the type of, bookings their EV vehicles are enticing. I do think that this 20% run rate is likely to be maintained. If at 3 o'clock there is a monsoon forecast, if monsoon shapes well, then the farm equipment segment will also do well. At the same time, the best part is because of not so much spurt in the commodity prices, because of all this volatility in the international market, their operating margins are also likely to be stable at 18.5 to 19%. So that augurs well. Valuation wise, it's a tad cheaper than what Maruti valuations are. And I think if I have to pick up one stock, it would be Mahindra and Mahindra from this space. But if you are willing to wait longer, I mean, if your investment horizon is more than a year, then Tata Motors is available at a very cheap valuation. These worries about, US market, the shipments not going there, and finally, I think they will again roll back it. And the trouble in China will all settle down in next 3 to 4 months. That is my assessment. So if one is willing to bet long term, Tata Motors valuation-wise appears quite attractive, but given the current situation, Mahindra remains the top pick out there.
Stocks that we need to keep an eye out for on the back of the MSCI Rejig. Now, this Rejig announcement will happen on May 14th, but as per the MSCI methodology, the cutoff period typically spans in the last 10 working days of April. And Nuvama Alternative believes that the cutoff may have begun today and could conclude in the next 3 working days. So, keep an eye out for these stocks, which Nuvama is saying they are expecting 4 inclusions to happen and 2 exclusions from the MSCI Standard Index. When it comes to inclusion, we are seeing Coromandel International, Paytm, Nykaa and Adani Energy. Now, the inflows in these 4 stocks could be anywhere between 175 to 210 million US dollars. And on the exclusion side, we have Sona, BLW and Thermax. And on the back of this MSCI exclusion, there could be an outflow in these couple of stocks anywhere between 110 to 162 million US dollars, which is nearly 14 to 20 times that trading 20-day trading average. Now, the MSCI announcement will happen on May 14th, and the inflows and outflows regarding the same is expected to happen on May 30th.
Some very strong volumes, Somit, on the back of this. You're seeing strong volumes in an Adani Energy at this point. You're seeing Nykaa also seeing strong volumes, and some good buzzers also within these within the bunch of these stocks. Kush, wonder what your view is with regard to something like a Coromandel and an Adani Energy. If you can quickly give us your view.
Harsh, Coromandel has been, our call for some time. Again, it was just the market volatility, that sort of triggered the stop loss, once in a while. But other than that, the trajectory has been pretty steadily upwards. Today also, we are seeing the stock do rather well. I don't see a reason why, you should not create further long positions in Coromandel. So on the upside, you're looking at a round figure target of 2200 once that is taken on 2240 as well. The previous resistance comes, becomes a support now. So close to the 2080-85 mark is where you place that support, stop loss. So all in all, very positive on Coromandel have been for some time. The other stock that you mentioned was Adani Energy, right?
Yes, please, Kush.
Good moves on this one. Now it's coming up to a resistance around the psychologically important 900 mark, but 896 also happens to be the 200-day moving average. So for a fresh position, you might just want to wait and see the 900 level taken out convincingly. A close above that would create fresh momentum for levels of about 980 and then 1040. And then on the downside, you've got the 20-day moving average support near the 825 mark, which will act as a stop loss. So if you've got an existing position, continue to hold. But for a fresh position, I would suggest let it close above 900, let the selling around those levels get over, and then you could go in and create fresh long positions.
Okay, Kush, just coming in here as we get into the last 40 minutes of trade as well, and let's take a look at index levels once again as we're heading to a very strong kind of an afternoon, 23,321. Now, my question to you is, since this is a truncated week, are you feeling confident enough for long positions to build up?
Hi, Tamanna. As far as the build-up goes, I think, what's happening is that the resistances are coming at the 23,600 mark and the support is at the 23,000 mark. So your risk-reward ratio is really 1:1. I'm not too concerned about the truncated week, honestly, if you ask me, because the data is shaping up rather strongly. What I mean by that is the 23,300 put has added significant base and is now much higher, practically about 140% of 150% of the 23,000 put base, which is usually a round figure and should have a much higher base. So my point is that the confidence that the traders have reflecting in the data is suggesting that the support levels are shifting higher. So if you have a long position, by all means continue to hold with a stop loss around the 23,000 mark. If you're comfortable with the 1:1 risk reward ratio, yes, you could still create a long position with a target of 23,600 and higher, and 23,000 being your stop loss. I would be more constructive on Bank Nifty, where 53,200, 54,000 levels are in play, and the stop loss comes in at 51,000.
Bank Nifty, no doubt, is a complete champion in today's trade. Just Dharmesh, I want to get your sense of what you're feeling on some of the public sector enterprises. I'm looking at a Masgao Docs doing very well today, but a BDL, a BEL, only because if you're going to look at a rotational up move in the market right now, these would be prime, wouldn't it?
Well, I don't think this is to do with rotational up move. because of lack of liquidity. When the market is correcting, you see a sharp selling out there. But next 6 months, the sectors of the revenue provider is Government of India, the sectors in which they are the sectors which will thrive in this volatility, and those are very clear sectors. I mean, defense is when the entire revenue comes from the spending by the government. Railway infra is then the sector. Infrastructure itself is the third sector out there, and you need funding for all these sectors which comes through the banking and financial space. So these four quadrant is likely to be more, margin of safety remains high, and in a stable to upside kind of a market environment, you will see more traction out there. And just to name you of topics out there from defense, we like HAL the best because of the valuation comfort it enjoys when compared to BEL, though BEL is also a good candidate. And in railway space, Ircon International, to my mind, is a better bet compared to RVNL, just again for the valuation comfort. Order book inflows has been great for them. And defense, I mean, the shipbuilding space, Majgaon Dock, though it has rallied quite a bit today, but still it's cheaper compared to others like Cochin Shipyard and the like. So these companies will continue to do well. You have to just be stock specific. These are the sectors which would be the flag bearer of the next bull market.
Your top favorite there, is it Mazgaon, Dharmesh?
From shipbuilding space, yes, because it enjoys a ROE of 30 to 33%, and still available at 31 kind of a P multiple, where others are 45, 60 kind of a P multiple with lower ROE on the respective P&L.
In fact, it's a perfect time to bring in Anushi into our conversation for our bull versus bear segment, where we give you both sides of the story and both aspects. In focus today is the entire defense sector, which is on fire. Now, Anushi, one swallow does not make a summer, and one good day does not mean that there is going to be an extended bull case for it. But having said that, tell us about how the sector has performed so far in FY25 and what FY26 looks like for it.
Absolutely, Tamanna. So if you see overall the defense space in the last 1 month or so, we have seen the sector gaining about 10% in the 1 month period, and this is sharply against what the picture has been in the last 6 months, where we've seen about 5 to 6% of correction overall in the defense space, and this was amid concerns on the order book, on the ordering activity and all. But from fourth quarter onwards, we have seen a strong pickup over here. So if you see Nifty index in general, we've seen about 11% of a move in this 1 month itself. This includes the likes of stocks like HAL seeing about more than a 20% of an upside. Even Zentech or Data Patterns are some of the strong movers in the stock today, which have, since the September lows, we have seen some strong up moves over here. So this is the bull case scenario that we are building for the sector. It is important to highlight that the kind of moves that we are seeing is also a lot of focus on the domestic plays back in the market amidst the volatility that we are seeing in the markets related to the export side of the business. So huge focus on that part as well. However, if we are seeing the overall FY25 picture, we did notice a bit of slowdown, which led to a guidance miss for some of the key players that is there. Like if you talk about BL, Bharat Electronics, they had clocked in about 18,000 crore of orders or so, missing their guidance by about roughly 25 to 26% on account of delays in ordering from the Defense Ministry for some of the three key orders which we had seen, which led to that. Another example would be something like a Zentech also. We did see in the third quarter when the company reported its results, we had seen lower number of orders for the company, after which the stock had remained under pressure also because of this lack of orders which had been there. So lack of orders or delays in is something that had been a factor which did result in overall correction that we had seen for the defense space in general. However, if you are talking about what the expectation forward is, FY26 expected to be a pivotal year for defense ordering. There are huge high ticket programs that we are seeing in focus, which includes the likes of QR, SAM and shipbuilding. We are seeing the government is setting about 25,000 crore of a initial maritime fund as well to support these kind of huge ordering activities that are expected to swell the order book of some of the major players in the industry. So focus remains on the picture forward. HAL also, if you see, in FY25, the order book had almost doubled to the 1.8 lakh crore from the 90,000 crore mark that we are seeing it, and is expected to further improve as well. Even if you look at the acceptance of necessities so far this year, the mark stood at about 2.2 lakh crore, with 56,000 crore of being the latest figure for defense acquisition proposals. So ordering from this aspect over here is something that would remain in focus for FY26. So expectations on revenue visibility for the future years is expected to improve from here on. However, the key concern again remains on delays in approval and execution of some of these high value contracts. Now, if you take BEL for example, if you see 25,000 crore was the guidance that was given for last year, and this year the expectation is that they would exceed the 50,000 crore mark as well with some of these next generation corvette orders, as well as something like a QRSAM, that's a quick reaction air surface missile orders. But any kind of delays related to the orders which are placed from the Defence Ministry or delays in regarding with the companies, even if you look at HAL, now HAL had been one of the cases. We had seen the supply side concerns easing off, but any sort of which is expected to improve the delivery of the company going forward. But again, any sort of miss from the company's end would result in EPS cuts for some of these companies which are there. So that is one point that we should be focusing on. However, if we talk about the export side of the business, now, government has highlighted count in other times that they remain steadfast on the target of a 50,000 crore of exports by FY29, and in fact, in this case scenario, FY25, we saw about 12% of growth in terms of where the exports were concerned to 23,622 crore. This was a mix of some of the orders that they had received from ammunitions as well as other artillery-related orders, which led to these higher export building into the picture. So while this is a key positive for the company, for the sector in general, we have to also account for the overall imports which continue to remain on a higher mix. In fact, if we see this expensive imports may have some impact on the domestic defense spending as well going forward for some of the players. We saw these India-France negotiations in terms of the Rafale so just concluding, and this would lead to higher imports for the sector as well. So this is something that we should be focusing on. On the last point though, now localization, indigenization is something that we have spoken about count in various times. So domestic procurement is expected to improve further to 75% of a mark versus what we had seen 54% in FY19. So that remains as a focal point for the defense sector in general, as the push would be towards these domestic DSPUs that we are seeing over there, so higher ordering expectations from here onward. However, despite the correction that we've seen in the last 6 months, if you talk about the overall EPS growth versus valuation, that continues to remain a key monitorable for the companies that are there, because any sort of a miss in terms of where the guidance is or in terms of where the revenue growth is would lead to cuts in some of the EPS cuts over here, and valuations continue to remain expensive for majority of the players which are there in the space. So this is the overall take that we are seeing for the defense sector in terms of where the bull case scenario is and where the bear case scenario is.
Interesting and very detailed analysis on both sides. Dharmesh, we got your fundamental view on it. Kush, I'm wondering if you are liking a Mazgaon, a BDL, a BEL. These are some of the names that our experts are telling us about since this morning.
Not as much a Mazgaon or a Cochin, not the shipbuilders just yet, but I think I'd like to stick with strength, and the strength clearly is in something like a BEL. I mean, if you would have invested it in a BEL or had a trading position, you really wouldn't have lost as much value. The stock has been trading in a narrow range, and every time it comes close to the 265 to 75 support zone, you see a good rebound from there on. In a market like this, buying strength makes a lot of sense. So that's the first one that I will pick from the defense space, Bharat Electronics. Other than that, the stock that is now starting to pick up steam is BDL. As you rightly said, it's up quite a bit today as well. This is on the back of a strong move over the last 3 to 4 sessions, and that was on the back of consolidation. So all in all, it's got a few technical factors going for it. Volumes also rising, as the stock is moving higher. So BEL and BDL, these are some of the stocks that I'll have on my radar. The GRSCs, Cochin Shipyards, Mazgaons of the world have seen some up moves, but they are now very close to resistance levels and not very comfortable buying close to resistance levels in a market like this.
Kush, what about something like a data patterns?
So I think the related stocks will also start to do well now, and data patterns falls in that category. There's been very strong consolidation over about a month and a half around that 1650 to 1800 zone. Today the stock is up on practically 4 to 5 times of the last 10-20 days of volumes. I think this is a good clean breakout. I think this move perhaps could continue for levels of 2000 and perhaps 2100 as well. Major resistance comes in at 2140. So just rounding it off to about 2100 odd levels. So if you have a position, continue to hold. If not, the risk reward ratio is still favorable. The stock is off its highs by still some margin. Stop loss comes in at 1750 around levels where the previous resistance lies now becomes a support. So yes, good move on this one. A clean breakout, volume back after a brief period of consolidation. So for levels of 2100, you could hold or add.
Okay, data patterns on focus, real estate on fire today. All of your interest or rate sensitives also showing, that kind of an up move coming in. So your auto anchs. I just want to pull up Swiggy as well. Swiggy also with an interesting story with their new foray into what urban company does, essentially Ping. The stock actually come off its highs after this has come in. Dharmesh, I wonder if you have a take. A low margin business spreading thin. Any reason why you think that the street is not taken too positively to this this deployment from Swiggy?
A lot of competition creeping in, and the path to profitability, unless it is being established, it's in this kind of a market environment, there will be few takers. I mean, in a very good market environment where your economy is growing, everything is looking rosier, then people are willing to take a bet out there. But with the entry of so many entrants and the competition hitting up, I think unless they show a consistent profitability on the at least on the operating part, then only meaningful investments will come. As of now, the people who are invested, even what we have recommended to our client is, if you are already invested, stay invested. No need to be out, because it's a long-term, play, 3 to 5 years. A lot of penetration is still to happen out there in this last mile delivery. So stay invested, but fresh position, wait for 6 months or 1 year and see how these entire competition is shaping up, which includes Amazon, which is pouring fast into India.
Okay, I just want your take. Maybe Swiggy, you don't have enough data. I don't know if you have a view on Swiggy, Kush, but Eternal saw large block deals today as well. The now name of Zomato is Eternal. Stock about 2% up. Are you seeing more strength there at 221?
Just a quick word on Swiggy. For whatever data I have, 325 is a good, strong support zone, but the stock is in a descending triangle formation, which is not a healthy sign. If 325 is broken, you could see the stock actually head lower. This is suggesting that there is selling pressure at every rise. So I would watch out for the level of 325. If I had a position, I would keep my stop loss there and exit if 325 is triggered. Now, as far as Zomato goes, this has gone into consolidation and much on expected lines. There are some positive flows and some negative flows in terms of news around this. That's translating into a price action of a range, which is 200 on the downside, and on the upside, again, rounding it off to 240, 238 actually. But for me right now, this is a consolidation phase. If you have Zomato, it's not a bad idea to continue holding on to this. But because this being a range play and momentum missing, I wouldn't really initiate a fresh position in Zomato. Maybe above the levels of 240 we could consider, but for now, consolidation is on in Zomato, or Eternal as it's now called.
Okay, Eternal and Swiggy both in focus. We'll get a very quick report on this after this very short break. But stay tuned. On the other side, BTST ideas and a lot more coming in. Thank you so much, Kush and Dharmesh, for speaking with us. But we're joined for more picks in the next leg of the show. Stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back. You're watching India Market Close and it's looking like a fantastic Tuesday, terrific Tuesday for the street. What's interesting is that volumes have also held up even though this is a truncated week and you haven't seen a bout of profit booking come in. Another development that we should put the spotlight on, though the stock has not really reacted, in fact the stock has come off, is Swiggy's decision to launch a professional marketplace app called Ping. My colleague Agni Dev joining in for more details. Agni, what exactly is Ping going to be doing?
That's right. So Swiggy has launched Ping for consumers now. It's important to remember that the Ping for seller businesses was already launched in January. Now between January and April, Swiggy has been onboarding professionals and going through with them across comments and seeing what professions can be added. So now the consumer side has been launched. Users across India can access professional services like investment advisors, astrologers, health experts and more across this Ping Now app. So the app for physical services like DJs and all is live only in Bangalore, but online services can be accessed all across India. So it's important to remember that this is part of Swiggy's move away from the super app strategy, wherein all the services were housed within the Swiggy app, services like Dine Out and Instamart. So along with Snack, Ping is now another app which is away from the main Swiggy app. Also, it is important to note that this should not be considered as a competitor to Urban Company, more of a competitor to Just Dial, where professional services are brought over to consumers. As of now, that's all from my end.
Thank you for that, Agni. All right, let's welcome in Aditya Shah, founder of Hercules Advisors, and Akshay P. Bhagwat, Senior VP, GM of Financial this afternoon. Welcome to both of you. You know, I'm seeing Aditya smiling after a long time, Aditya, and I think you're looking at the Bank Nifty and all the banking stocks and feeling like saying, see, I told you so, this is why you need to have the faith as far as banking is concerned. Is that right?
No. So the market is corrected. The market is coming back. So that's part and parcel of life. But I'm very happy that the irrational valuations in the market have been checked for a while. So happy about that. And of course, as I had always been saying, stick to larger banks, and they are doing pretty well. So I'm pretty happy about it.
Valuations, in terms of valuations, how are you looking at HDFC right now after the kind of boost we've seen? I want you to look at HDFC, ICICI and Axis. Let's look at all three. Results are due as well. Interest rates are coming down. All of that happens to be there. HDFC, in fact, dropped their savings rate pretty low. Do you think that there is more value here as far as these top three are concerned?
Absolutely. Now, Axis has also dropped their savings interest rate. So all these banks are moving in line with what the market is really doing. As RBI continues to keep cutting the interest rate, these banks will move first and cut the deposit rates as well, which will have a positive effect on their NIMs in the shorter term. However, on a longer term, for companies like HDFC Bank, the problems of the merger will start to wane off starting this quarter. And over the next 2 to 3 quarters, the NIM erosion that HDFC Bank had seen will continue to keep corrected. So within these top three banks, ICICI Bank will continue to remain the top pick. HDFC Bank to some extent would be a little bit of a value buy as it trades at about 10-year low valuations, provided somebody has a patience of about 1.5, 2 years. Both these banks would continue to do excellent.
Akshay, let me quickly have your take with regard to some of these banking counters doing very, very well in trade today. And Axis is up 4%, and IndusInd up 6.5%, and HDFC up 3.5%. How are some of these looking individually from a chart perspective?
So first of all, good afternoon.
Good afternoon.
Well, it's being completely a banking and financial services day, as I see on an intraday front. And if I were to time these stocks from here on, HDFC currently is trading at its resistance zone. If you recollect, the area of roughly around 1870, 1880 was tested way back somewhere in December, January time. And from there, you had a correction all the way till 1600. So somewhere or the other, these levels hold importance if you are trading it for as a BTST or for tomorrow, because we are trading at crucial resistance zones. So this is only for short-term traders. Otherwise, from a broader perspective, this stock is still strong. If I were to buy from a momentum perspective, I would look at ICICI Bank, where the broader chart structure is strong and the momentum has room for it to go all the way till 1375 on the upside. And Axis Bank is the second name from the private banking space, where also you can see a strong momentum uptake, or as a BTST candidate, where possible targets of 1335 odd levels can be in the making. So from a short-term momentum chasing perspective, Axis Bank and ICICI Bank fit the bill. HDFC Bank is trading at its resistance.
It's as if all the stars are aligning as far as Indian equity traders are concerned after a very, very bad bout. News on your screen right now about how we're expecting an above normal monsoon. That's a prediction, that's a forecast from the Met Department coming in, that India's 2025 monsoon rainfall will be seen above normal. So that's another bit of good news, I suppose, that you would look at. Let me come to you, Akshay, on what would be your top picks this afternoon.
Yeah, so from the private banking space, I'm closely tracking Federal Bank on an intraday perspective. It's been trading flat, but the broader short-term chart setup is clearly hinting that a support zone of 187, 189 is already cemented, and the stock is all setting up for a momentum leg up, which can see an upside possibly till 198 to 203. That's the short-term targets you can look forward to. Have a stop loss of 187 on this trading pick. The second one is PFC, Power Financial Corporation. Clearly a momentum or a BTST counter where it has staged strong, it has seen long additions on an intraday front, and the momentum has returned after almost 8 to 10 days of consolidation. So buy PFC from a short-term trading perspective, and here you can look for targets of 439 to 447 and trade this with a stop loss of 412.
Okay, PFC also on the radar. Akshay, I wonder if you've been tracking Macrotech. I'm going to ask you, as well as IHCL. Both buzzing today, some fundamental reasons there, but then of course, Macrotech following what real estate has been following, or the trend all through the day. The dispute resolution between the two brothers also helps. But view on Macrotech?
Yeah, no, so absolutely today reality sector is also in limelight, and one of the best price charts here is Macrotech. Intraday, yes, it is significantly up, but if you were to kind of buy and hold this from a slightly medium-term perspective at a time horizon of 3 months or time, clearly this price structure has seen a strong support developing at the levels of 1100, and now the stock is setting up for a strong momentum uptick. So I'm looking at targets of 1400 plus with a medium-term investment horizon. So buy and hold is what the advice is in Macrotech developers.
Okay, so those stocks in focus as well. Some of them really flying in trade, right? Macrotech, IHCL, both of them, and with good reason. Let's quickly move on though. You've got another stock that's been buzzing in trade since the morning. And one from the Nifty pack, in fact, L&T. It's marking consecutive gains over the last 2 trading sessions. HSBC has maintained a hold rating on the stock. 3600 being the target price. It's still a decentish upside from here, at least a 10%. But the 4.5% move is what's keeping the stock in focus. And hence, let's take a view as to what HSBC feels on something like an L&T. Anushi.
Right, so now HSBC, as you've mentioned, Harsh, that you've maintained a hold call on the stock, and this is with the target price of 3,600 that looking at. Essentially, what they're talking about is the expectations for what lies ahead for Q4 as well as the outlook forward for the company. Now they expect strong fourth quarter performance across parameters that we are looking at. Now this includes strength in their projects and manufacturing business also, which is expected to offset some of the weakness that is expected over the IT services business. Now do note that in terms of what is happening in overall IT space, there have been concerns regarding the demand environment. This is against the Trump tariffs and about how the weakening consumer sentiment is playing down on the discretionary spending of the companies, which would indirectly have an impact on the IT space as well. So strength in projects and manufacturing business is expected to offset some of those losses that might be seen going forward as well. If we are looking at the FY26 guidance, and now the note has highlighted that they expect a 7 to 10% of an order inflow growth for the year. Do note that this time we have seen about a 10% of a guidance for the company. And they see about a 15% of a growth in terms of where the revenue is concerned. In terms of where the EBITDA margin is there, they're seeing about a 30 to 40 basis points of an improvement for the for the projects in manufacturing business. So that is something that we could be focusing on. Along with that, what we have seen in the last couple of quarters, also in the last quarter as well, the company has been able to beat its guidance given in terms of where the ordering is concerned. In fact, in this quarter also, if we see, they had received a substantial as above 15,000 crore of an order from the Middle East segment of the business. So that is something in terms of how the overall order book shapes up for the company. We are looking at a 5 lakh crore plus of an order book size of the company. So ordering activity and what the company is giving as an order size is something that we should be focusing on, along with how the commentary is for the Middle East business going forward. So L&T in focus on the back of the HSBC note, wherein they're maintaining a hold call.
Okay, L&T in focus. Aditya, any views on L&T and in the realty space as well? Since we were talking about rate sensitives, are you feeling that there is going to be a turnaround in real estate and we should look at some of those counters there, notwithstanding whatever we see in Q4?
From L&T perspective, I'm positive on L&T. We've seen strong order flow will coming into Q4 and the next quarter, that is Q1. And L&T is at the top of the capital goods market. It is a market leader across all segments that it operates in. From a stock valuation perspective, it is a little bit expensive. However, long-term investors can continue to hold on to the stock. Over a period of next 3 to 5 years, the stock should do really well. That's one. On the real estate side of it, I see a little bit of growth coming back as the interest rates get cut across the board, and companies like Godrej Properties or companies like Sobha or Suntech Realty should start to do really well. So I'm positive on the real estate cycle as well. Topic there will continue to remain Godrej Properties.
Top pick is Godrej Properties, and then of course Sobha is something that Aditya also likes. I want to ask you, Akshay, about any of the auto angs today. And we've got views through the day, but the way Samil has been responding today, even an amber end, some of it because of tariff pressures easing off, but also we've seen that with the Tata Motors as well. Are you liking any of these counters on the charts?
I think Amber Enterprises, if you're okay with giving this trade some time, probably around 2 to 3 months of holding will do more justice, because the stock is in kind of range. 6,900 roughly is the broader range, but the longer term charts are really very strong, and it's just the short term fluctuations which can take you off the trade. So suggest that if you're holding this, I think the targets of 8,000 plus should be in the making with a 3 month plus horizon. So buy and hold is the advice, and this is one of the best chart structure which I see in the auto ancillary pack.
Okay, let's get your BTST calls, Akshay, before we move forward.
So financial services is one space I'm keen on if you are chasing the momentum. So clearly PFC was one of the pick which I shared on your show. REC is the other name which you can look forward to. It is currently trading around 423, 424. So clearly a momentum counter. Sector is in the limelight, and the way the prices are setting up, 445, 450 should be in the making in the short-term space. An ideal BTST candidate, buy with a stop loss of 412 for targets of around 440.
Wonder what's happening with something like a Coromandel International. And Aditya, curious to know your view. Not sure if you track it or whether you do have a view, but seeing some spike on that counter from a fundamental perspective first. Aditya, any views?
Well, I don't track the stock, so not be able to comment.
Okay, Akshay.
Yeah, so fertilizers pack are gaining traction today. If you look at Chambal, Coromandel, most of these names which have exposure in the futures and option segments are trading almost at its life highs. So clearly, these sectors have been undaunted by what is happening. The rough patch the markets have been one of the strongest resilient price structure as I see. And I think although overbought on the short-term price structure, the broader price structure is still strong. So buy and hold. The fertilizer pack still has more room on the upside from the current levels.
Aditya, I want to ask you about IndusInd Bank. Now, Somit reported a short while ago on our Heard on the Street segment that there's a lot of buzz that the auditor's report will be out any time, and that there is a shortlist for the new boss that takes over IndusInd Bank. Now, beleaguered. The stock has been beleaguered. In fact, if you can pull up the 1 month and the 3 month chart, you'll see how it's beaten down, 7% up now. Would you take a position, Aditya, poised for the news when it comes, which is an eventuality actually?
So, Tamanna, for IndusInd Bank, I believe that the loss will be around somewhere around 1,500 to 2,000 crores, and this quarter they will take the entire hit. But the more important point is not the auditor's report. The more important point is what about succession at IndusInd? Who does take over at IndusInd, and what does he do to clean up the entire mess that has been created by the former management per se? So I think that the market would now look forward to the new management and how IndusInd Bank move forward from here. High risk investors can start to look at it. It is not as if IndusInd Bank's book is entirely bad. It is just that this one fiasco has played out. And mind you, also the micro lending cycle is really very bad. All banks are facing NPAs, including in the IndusInd Bank. So only high risk investors should start to invest here, and your investments should be really very staggered and expect some negative news over a period of next 3 to 6 months on IndusInd Bank.
What can you expect, Aditya, in terms of negative news? Do you expect asset quality to continue to remain under pressure? And so that's point number one. Point number two, it's a Nifty 50 counter, one of the key constituents in the Nifty Bank as well, and trades at sub 1 times price to book, and well below 1 time price to book, in fact, 10-20% lower than that. So what's the risk in your view?
Negative asset quality has to be precise. Micro lending cycle will mean that the NPAs start to pummel even in this quarter. As well as the kitchen sink that the new management will take as they take over. We've seen in companies like Poonawalla FinCorp, where when the new management took over, the kitchen sunk an entire quarter and the stock has not recovered. So in my opinion, that is the biggest risk as to how many cockroaches will come out even after this 2,000 crore hit that the bank is going to really take. However, as you said, the stock is really very cheap. It now trades at about below 1 time price to book. And as I said, high risk investors could start to invest here in a staggered.
Point taken. Akshay, let me ask you a quick one with regard to an Intellect Design. That's the other one which is perked up in trade, 14% up. No fundamental or technical reason per se, but do you have a view on this one?
Well, for Intellect Design, it's major upsides for intraday trader, but if you were to kind of take this as a BTST trade or micro time it is currently trading at its resistance of 750 to 755. So that's a zone where it might be vulnerable to temporary profit booking. So I would suggest that let it cool off a bit. Ideally, levels of 745 would make it again lucrative buy from a short-term trading perspective. Overall, the prices are setting up for levels of 800 to 810, but suggest to wait for dips of 7 47-40-45 for re-entry on the buy side from a risk-reward perspective.
Just want to pull up the IREDA stock very quickly. Their numbers are due today. In fact, it was look at that spike coming in last few minutes. Numbers were due actually middle of the day, but seems it will now come post market. Akshay, IREDA a good place to build a position. Last few minutes of trade left, and IREDA numbers. IREDA will report post market in all likelihood.
Well, yes, in all likelihood, probably 178 is where the stock should be heading for from a short-term trading perspective. 149 is the support base, so it's more of a bottom fishing candidate. But if you're ready to take on the risks of the results, then 175 to 180 is where you can possibly look from a result perspective.
Aditya Shah, the one space which you're most positive on at this point?
The one space is, I think the auto ancillary space. I'm positive on that now. As the tariffs are getting paused, it is positive. Although this pause on tariffs is not permanent, but a lot of these stocks have taken a lot of correction, and auto ancillaries is something that you need to watch. Companies like Sona BLW or Motherson, or companies like RSC or Garetech is something that you should really concentrate on. They may correct further if Trump puts tariff, and that's a buying opportunity that you really want.
Okay, JBM Auto is the other one that we're looking at very, very closely. Aditya, as we're rounding off, the one stock that you would take a bet on for a short-term trade, if at all, going into trade tomorrow, would you stay away from IT because we don't know what's going to happen overnight, or from Auto Anch, or would you double down on some of these ideas that have worked today?
I will go with the banks, an HDFC or an ICICI. I think over a shorter period of time, they are looking really very good.
Wipro. What about Wipro before the numbers tomorrow?
I tend to stay away from IT pack and not take any position in the IT sector. The cost of doing business in the US will definitely go up, and that is causing a lot of uncertainty. So I'll stay away from the IT.
All right, a minute from close. Thank you so much, both of you gentlemen, for coming in, giving us all of those views and perspectives. We'll let you go. On that note, we'll quickly look at how the Nifty has shaped up for the day. It's been a very, very range-bound day, Tamanna, in terms of where the Nifty is, but we're closing.
Yeah, but what a lovely range. No one is complaining about this range.
No one's complaining, of course. And it's a second straight day, 2% up. So yeah, that's really standing out. It was very, very close to the day's high. In fact, apart from that initial bit of volatility, very, very close to the day's high in that sense. So positive across the board. We breached 23K.
Yeah.
We're now very close to 23,350. So we're looking at new levels already, 500 points up on the Nifty.
Yeah, and it stayed up 150 points off that range, if at all, but it has stayed up decisively. 23,350 becomes important. Is 23,600 what we're looking at next is the question. I want to just pull up the heat map very, very quickly to show you what has been stellar today. And in this end, we talked about it, and you heard it from Samit Sarkar in our segment Heard on the Street. You could the hunt for the new MD is on. The PwC auditors report could come anytime soon. Shriram Finance also shining. It's about banks, it's about NBFCs today, and that's why you're seeing a huge push up from the banks. Dr. Reddy's has recovered very smartly. Adani Port, Adani Ent, both also doing very well. And then, of course, there's Tata Motors. What a star. HDFC Bank, Tata Motors. Between the two of them, they've pulled along, and all other stocks have carried through as well.
Yeah, so auto stocks is one set of stocks which have rallied today, Tamanna. Banking stocks are the other. And within the mid and the small cap, you've seen Realty do very, very well today. 5% move. Let's pull up the sectors, in fact, and let's zoom in on a couple of them. So Realty up nearly 6% in trade. Well, defense has done so well as well. 4% higher. That was our bull versus bear case today. But autos, metals surely dominating. 3.5% and 3%. Not seen that move in a while, and a welcome move given the fact that they've been one or a couple of sectors where you've seen a lot of pressure. I remember last Friday, last Monday, we were down 13.5% combined only in those two trading sessions on the Nifty Metal. So some pressure which has now eased off over the last week or so. What's done okay is a Nifty FMCG underperformed, a Nifty Pharma also underperformed to a certain extent, energy, IT those were some pockets which have underperformed the index today. The advanced decline, if you can quickly pull that up before we talk about the small cap and the mid cap index. So the advanced decline, very solid. It's been that way pretty much through the day, and hopefully another couple of days of this. And no one will complain, I'm sure. So
depending on what happens overnight, if there is anything to mar the mood, if at all, and what Wipro looks like tomorrow. So that's one of the important things to watch out for. What Wipro looks like tomorrow for one, any overnight clarity on tariffs and any pullback, if at all. Those are some of the things that will come in.
Correct.
Plus CPI.
Yes,
CPI
the
will come
India
in today.
CPI data is yet to come. So on that note, let's look at what all to watch out for. The India inflation data, US export import, China GDP data, China unemployment rate. Okay, so some of those less relevant to us. Earnings tomorrow, there's going to be Angel One, Wari and Wipro. Those are the three big ones. Angel One will be the other one in focus. There's interim dividend, Mazgon Doc, nothing significant there. But this one is significant. Shares to exit lock-in.
Yeah.
We'll have a Lakshmi Dental, 7% of the total equity market capitalization to exit lock-in. So that one will be in focus. There'll be Garuda and Diffusion as well. Diffusion is 9%, Garuda is 50%. So may want to keep your eye out on some of these as well.
I just want to pull up one chart before we wrap up for the day, which is India VIX, and I want to see where VIX has ended, because that is telling you about how this is a beautiful chart and gives you a sense of what's been happening today. 20% down right now, started up all the way here and close to the lows. This is important because this is telling you that fears have receded in the market, which is why expect a decent start at least tomorrow, unless there's some big unpredictable event. Barring that, you're in for a situation where the bulls are firmly in charge.
Yeah, absolutely. This was at 22 last week, so this is welcome, very welcome.
Right.
But with that, completely out of time on this edition of India Market Close. From Tamanna, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market mover.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show. Benchmark indices kickstart the truncated trading week with stellar gains. The Nifty jumps over 2% to reclaim 23,300 mark, whereas Sensex zooms over 1,000 points above 76,700 levels. All sectors end in green. Realty, defense and auto top sectoral gainers. The NSE volatility index slumped 20.43%. Morgan Stanley lowers the FY26 GDP growth estimates by 40 basis points to 6.1% and expects slower recovery in FY27. Says the slower growth and lower inflation should allow RBI to respond with a deeper easing cycle. Morgan Stanley says that the given global situation, FY26 earnings estimates are going to be lower. Citi, on the other hand, downgrade the US to neutral amid still high valuations and mounting downgrade pressures within the emerging market space. Now they are overweight on India, Taiwan, Chile and South Africa. Speaking of stocks, UBS maintains a sell on one of the largest pharma companies with a target of 1,140 rupees, says the company's personnel cost increased from 18% of sales to 20% in Q3 of FY25. UBS highlights worries around media reports mentioning downsizing in R&D, digital therapeutics and pharmaceuticals. Symphony's board is exploring a stake sale in units Climate Tech and IMCO. The company will be exiting from Australia, Mexico and invest in the US. This is a part of company's expansion plan as the focus remains on high profitable segments in India and exports, and US market provides great opportunities. Motilal Oswal upgrades Indigo to buy. Hikes target on the stock to 6,550 rupees. Now says Interglobe Aviation is best domestic consumption play and will be benefiting from an upswing in Indian aviation. Motilal Oswal thinks that multiple factors will continue to drive performance in the coming years. Nomura thinks US exemption of reciprocal tariffs on key electronics are going to have a positive impact on the consumer durables and the EMS sector. Now, prolonged tariff uncertainty could push companies to look for alternative sourcing out of China. Nomura sees a limited scope of smartphone assembly shifting to the US and expects India's smartphones exports to the US to increase sharply, whereas Apple's iPhone India production share is likely to rise. Gold prices trade just shy of record high in Tuesday's session as traders assess mixed messages from the US regarding tariffs. Late Friday, US announced exemption now for consumer electronics, and Monday it launched probe in the pharmaceutical and semiconductor imports. Now the gold spot was trading at 0.29% higher at $3,220.13 and per ounce. Now the yellow metals value has risen over 50% from the levels of early 2024. Oil prices extend gains to third session as traders hope for looser tariff restrictions from the US after exemptions. Now, this also hope for a light restriction on the Iranian oil supply given the US and Iran concluded first round of discussion on the nuclear power constructive. The Brent crude was trading 0.5% higher at $65.19 per barrel as of 1:30 p.m. Nifty auto stocks rose on Tuesday after US President Donald Trump hinted at removing levies on imported vehicles and auto parts. The gains were led by Samvardhana Motherson International, Tata Motors and Bharat Forge. President Trump on Monday said that he's looking to help car companies that need more time to move their production to the US. India is set to increase its ethanol blending target from 20% to 30% by 2030. According to a report by INCRED, this rise in target comes after reaching the earlier milestone 5 years ahead of schedule. Now, the country achieved 20% blending in March 2025. Deepak Balani, director of Indian Sugar and Bioenergy Manufacturers Association, INCRED, said, and I quote, "This year, we've already done around 19 to 20%. This is 5 years earlier than the target for 2030, end of quote. Shares of Dr. Reddy's Laboratories rose over 3% in early trade on Tuesday after the company denied reports claiming it was undertaking a 25% reduction in workforce costs through large-scale layoffs. Dr. Reddy's stock rose as much as over 3% during the day to 1,147.80 rupees on NSE. GM Breweries in its quarter 4 earnings announced revenue growth of 6.4% at 169 crore. EBITDA too recorded double-digit growth of 13.8% at 28.7 crore rupees. Now, EBITDA margin came in at higher at 17% versus 15.8% on an annual basis. However, the net profit fell by a hefty 30% at 60.5 crore rupees as opposed to 86.6 crore rupees. Now, the company's board has recommended a dividend payout of 7.5 rupees per share. Ratan India Enterprises portfolio company Revolt Motors has started its operations in Nepal with the launch of its first dealership in Kathmandu. Revolt Motors established a partnership with MV Dugar Group to benefit from their deep market understanding and establish distribution channels in Nepal's automobile industry. This expansion marks the company's entry into the Nepalese market, aiming to cater to the growing demand for electric vehicles. Biocon Biologics, a subsidiary of Biocon, signs a settlement and license agreement with a regeneration arm. The agreement allows for the commercialization of Yesafili, a biosimilar used to treat ophthalmology conditions in the US market. Now, this partnership is expected to benefit patients by increasing access to affordable treatment options. Poonawalla FinCorp launches a gold loan business plan to expand its presence in Tier 2 and Tier 3 cities. The company plans to open 400 new branches in a phased manner over the next 4 quarters, aiming to strengthen its footprint and increase its market share in the gold loan segment. IDFC First Bank's board of directors will consider a preferential issue on April 17. The decision is expected to be taken during the board meeting, subject to regulatory approvals and other necessary clearances. The bank offers products and services across all segments, including retail, MSME, rural, and startups. Shares of HCL Tech rise as much as 2.25% after the company announces 2 key developments which aim to accelerate AI adoption. Company says that it had integrated NVIDIA's AI enterprise with its Gen AI-led AI Force platform and NVIDIA Omniverse with its physical AI solution, SmartWin. Now, these integrations are aimed at streamlining software, enhancing engineering efficiency and reducing time to market for enterprise clients. Federal Bank faces challenges. Investors expect leadership changes and a repo cut. As the bank plans a strategy shift, margin pressure continues and growth raises concerns. Now, return on the asset seems tough to improve. The strategy change brings near-term strain while valuations match 5-year averages. AstraZeneca Pharma surrenders marketing authorization for olaparib. Now, olaparib is a medication used to treat certain types of prostate cancer. Now, this decision may impact treatment options for patients with specific cancer indications. Dr. Lal Path Labs introduces an advanced diagnostic test for amyloidosis, a condition characterized by abnormal protein buildup in the body. This new test is expected to aid in early detection and accurate diagnosis of the condition, enabling timely treatment and better patient outcomes. RateGain Travel Technologies has partnered with AirGain, a leading airline retailing platform, to implement a competitive pricing strategy for airlines. Now, this collaboration aims to optimize pricing and revenue management for airlines, leveraging RateGain's technology and AirGain's expertise. PowerMeds Energy, an arm of Mercury EV Tech, has commissioned a 3.2 gigawatt lithium-ion battery manufacturing facility in Vadodara. Now, the facility is set to begin pilot production in mid-May 2025, marking a significant step in the company's efforts to enhance its battery production capabilities. Now, after this announcement, the shares of Mercury EV Tech traded in a 4% upper circuit limit at 60 rupees on the BSE. Havells is in the focus. The company will soon be investing 600 crore rupees in Goldi Solar. The project is expected to be completed in next 75 days. This will help the company acquire 8.9 to 9.24% stake in Goldi Solar. WPI inflation drops to 2.05% in March. This rate is the lowest in 6 months, while primary articles inflation falls to 0.76% from 2.81%. Fuel and power inflation rises to 0.2% from a negative of 0.71%. Inflation of manufactured products surges to 3.07% from 2.86%. Core inflation edges up to 1.5% from 1.3%. Food inflation decreases to 4.66% from 5.94%. Satin Credit Care Network has implemented a cap of 3 on the number of microfinance lenders its customers can borrow from. Now, this move aims to promote responsible borrowing and reduce debt burden on customers, aligning with regulatory guidelines for microfinance institutions. Laurus Labs gets establishment inspection report from US FDA for Andhra Pradesh API manufacturing facility. The US FDA inspected the pharma giant's Andhra Pradesh facility from January 27th to 31st. Passenger vehicle sales in India rose to a record 43 lakh units in the financial year ending March 2025. According to data released by the Society of Indian Automobile Manufacturers, this is up 2% from the previous year. Utility vehicles accounted for 65% of total passenger vehicle sales in the financial year ending March 2025, compared to around 60% in the preceding financial year. China retaliates against US President Donald Trump's tariffs by promoting direct sales of luxury goods from Chinese manufacturers to consumers at significantly lower prices. Now, on X, many American TikTok users shared videos from Chinese suppliers showcasing high-quality products made for luxury brands like Birkin and Louis Vuitton. Now, these suppliers offer direct sales to consumers at a fraction of the retail price, often without the brand logos. In these videos, Chinese suppliers emphasize high-quality materials and skilled labor to manufacture the products. Tariff imposition gets more tangy now, with US imposing 21% tariffs on Mexican tomatoes from July 14. According to the US Commerce Department, this action will allow the US tomato growers to compete fairly in the marketplace. As per Vedanta Group's chairman Anil Agarwal, India has the potential to surpass Brazil and China to become the world's second largest iron ore producer. In a post on X, he says that given our huge reserves, we can produce 700 million tons per year and become the second largest after Australia. He further added that today India is the fourth largest producer of iron ore in the world. Iron ore production for the period from April to January 2024 to 25 increased by 3.5%, reaching 236 million metric tons. India plans to bring hundreds of millions of new users onto UPI while pitching the platform for wider adoption overseas. National Payments Corporation of India aims to draw an additional 200 million to 300 million Indians to UPI to break their cash memory. As per a PwC report, India today accounts for nearly 46% of the world's digital transactions after a 90-fold increase in retail digital payments in the past 12 years. According to a Niti Aayog report, the cost of semiconductor chips used in vehicles is expected to double from the current average of $600 to $1,200 per vehicle by 2030. Now, this increase is attributed to the growing use of advanced technologies in automobiles, including electric powertrains and smart driving features. Swiggy launches Ping app to provide professional services to its consumers. The app is live only in Bengaluru as of now, and it can offer services just like financial advisors, astrologers, health experts, and more. The highest court of India has come down hard on guidelines pertaining to child trafficking. Justice J.B. Pardiwala and R. Mahadevan blasted over the Uttar Pradesh government over their approach of handling child trafficking. The bench also ordered lower courts to complete the judgment in such cases in 6 months, while also directing the authorities to suspend licenses of hospitals if a newborn is trafficked. Trouble rises for Delhi residents as the city's Terminal 2 airport shuts for maintenance. Flights have been shifted to Terminal 1. Indigo and Akasa Air will shift their domestic flights to Delhi Airport's Terminal 1 from Terminal 2 starting Tuesday, as T2 will be temporarily shut for maintenance work. Now, the new Terminal 1 will be fully operational from Tuesday, April 15. At present, Indigo and Akasa Air have flights from T2, which handles around 270 to 280 air traffic movements and serves over 46,000 passengers per day. The Mumbai Water Tankers Association have finally called off their strike after 4 days. Angry residents, anxious bosses, and concerned restaurants were the vibe of India's financial capital for the past few days. The strike began on Friday after the BMC issued notices to Drink Well and Borewell operators, directing them to stop supplying water to tankers and obtain fresh licenses. As per the wealthier office's predictions, India will witness above normal monsoon this year. The prediction is good news for agriculture and the economy, as the sector accounts for 18% of India's gross domestic product. The livelihoods of over 42% of the population also depends on agriculture. Just days after fugitive businessman Mehul Choksi was arrested in Belgium, a multi-agency team comprising officials from the Central Bureau of Investigation, Enforcement Directorate, Ministry of External Affairs and international law experts are being prepared to visit the country. Now, Choksi is the key accused in the 13,000 crore rupees Punjab National Bank fraud case. Now, he had been residing in Antigua since 2018 but travelled to Belgium last year for medical treatment. The ED questioned Robert Vadra in a Haryana land deal linked money laundering case. Now, terming the agency's move to summon him as political vendetta, Vadra said that he had spent hours with ED earlier during questioning, shared thousands of pages, but still the agency has been raking up cases against him. Meta chief and co-founder Mark Zuckerberg took the stand in a landmark US antitrust trial in which his social media juggernaut stands accused of abusing its market power to acquire Instagram and WhatsApp before they could become competitors. The start of the trial in a Washington federal court dashed the hopes of Zuckerberg that the return of Donald Trump to the White House would see the government let up on the enforcement of antitrust law against big tech. The Trump administration freezes more than $2 billion in federal funds for Howard University hours after the elite college rejected a list of demands from the White House. The White House sent a list of demands to Howard last week, which it said were designed to fight anti-Semitism on campus. Now, they included changes to its governance, hiring practices, and admissions procedures. Just the day after a Russian attack kills 35 people in Ukraine, Donald Trump blames Volodymyr Zelensky for starting the war with Russia. The US president said that Ukrainian leaders shared the blame with Russian President Vladimir Putin for millions of people dead in the Ukraine war. Now, Trump's comments came after widespread outrage over Russia's attack on the Ukrainian city on Sumy on Sunday, which was the deadliest Russian attack on civilians this year. Over 1,000 people have been left with respiratory problems after a sandstorm swept across Iraq's central and southern parts of the country. As per a health official, at least 700 cases of these cases were just suffocation. Visuals shared online showed areas clogged in a thick orange haze, with local media reporting power cuts and the suspension of flights in a number of regions. After the Taliban banned girls in Afghanistan from attending school, low-paid carpet weaving becomes their lifeline. The lack of opportunities, coupled with the dire economic situation in the country, faces have pushed many into long, laborious days of carpet weaving, one of the few trades the Taliban government allows women to work in. As per same reports, now in 2020, only 19% of the women were part of the workforce, 4 times less than men. That number has dropped even further under Taliban rule. As Mahendra Singh Dhoni returned as captain to Chennai Super Kings, Chennai registered a win by 5 wickets. Batting first, Lucknow posted a score of 166 runs, which Chennai chased down in 19.3 overs. Shivam Dube was the highest scorer as he scored 43 runs in 37 balls, helping the Yellow Army register a win. Well, with that, viewers, it's a wrap on Market Express. Stay tuned to NDTV Profit as there's more lined up ahead for you all.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Benchmark indices begin the shortened trading week with impressive gains. The Nifty reclaims the 23,300 mark, while the Sensex surges over 1,000 points. All sectoral indices close higher, led by realty, followed by auto, pharma and metals, as Donald Trump pauses the tariff rollout, boosting investor sentiment. And in some good news, India's wholesale price index, the WPI inflation in March eases to 5-month low as lower food and fuel prices support the decline. Meanwhile, all eyes on the consumer price index inflation, which is likely to soften, raising hopes of further RBI rate cuts. Asian markets edge slightly higher as some stability returns to markets as US President Donald Trump floats a potential pause in auto-related tariffs, giving a boost to the sector after last week's rollercoaster ride. But the US-China standoff intensifies as China tells its airlines to stop taking deliveries of jets from American aviation giant Boeing. China also tells its carriers to suspend purchases of aircraft-related equipment and parts from US companies. Just Dial may have a direct competitor after all, as Swiggy launches the consumer app for its services marketplace Ping, which connects customers to health and wellness experts, financial advisors, astrologers, event planners, travel and lifestyle experts, and much more. Good evening, you're watching Profit 360 on NDTV Profit, and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's dive right into it, shall we? Benchmark indices Nifty and Sensex surge with substantial gains as the bulls took charge today. Now, this bull run has been driven by buying in realty, banking and auto stocks. Market volatility has eased after US President Donald Trump announced tariff exemptions for smartphones and computers. My colleague Harsh joining us with the detailed market roundup. Harsh, over to you.
So when you talk of markets, 23K breach today, so very, very positive day of trade in that sense, 2% plus on the Nifty 50 benchmark. Second straight day where we've gained 2% plus. So certainly some cheer and bulls really in control over the last couple of trading sessions on the Nifty. You're looking at a good breadth as well within the Nifty. And you saw certain pockets do better. Banking financial services was one such pocket. You had something like a Shriram Finance do very, very well. Nifty contributors largely an HDFC and ICICI within the banking pack. Also leading the charge was an Axis. What also did well on the index was something like an L&T, like a Bharti, big contributors on the index in trade today. So those were some of the heavier weighted stocks which did well. So that's one. Second, with regard to sectors, we saw very, very good traction within the Nifty Realty Index, up 5% plus. We saw good traction even within the Nifty Defense. We saw within the Nifty 50 sectors, we saw auto do very well, 3% plus. Metals was shining today, and of course the Nifty Bank was up 2.5% in trade. So those were the pocket spaces sectors which did well. In terms of a softer day for something like an FMCG, something like a pharma, something like an IT, those were sectors where it was a softer day for them. The breadth of the market was extremely strong. We saw both the Nifty mid cap and small cap do very, very well. It was a range bound day of trade for all three indices across large cap, mid cap and small cap. The Nifty 50 mid cap and small cap had a very, very range bound day of trade in that sense. So that was the other positive. There was stability. The VIX plunged as well, which was the other positive. We saw the VIX peak around 20 to 23 last week, and thereafter we've seen it cool off quite sharply, which is the other positive that played out. Of course, all of this welcome after the kind of volatility and the kind of moves we've seen in the market over the last maybe 6 to 7 trading sessions. All of this welcome. So yes, a bit of a rebound that we're seeing, and positive traction in certain spaces. IT was that one big underperformer, and we had views coming in from a couple of experts like a Dinshaw Irani, like a Venkatesh Subramanian, listening to some of those views that came through.
I don't think we're gonna be in the high single digits kind of an area in terms of growth in the Nifty 50, I believe. I think will be very low single digits. I mean, look at the sectors there, right? Apart from probably banks and financial services, all other sectors will more or less, I mean, obviously healthcare, which is a very small portion, hospitality again is a very small portion. But apart from that, all other sectors will disappoint. I mean, be it consumer durables, be it staples, be it IT. I think IT will be a big disappointment.
You could see cuts in auto ancillaries. So these would be the IT, auto ancillaries are the key sectors where we are going to see cuts. We could also see some amount of cuts in when it comes to chemicals. We are going to see some amount of cuts in industrials. So it is almost like a broad-based kind of a cut. At this point in time, we are worried about banks also, because while the liquidity has come back in the month of April, if you have rate cuts, we've had 2 rounds of rate cuts. If there are more rate cuts, aggressive rate cuts during the year, you have to remember that the loan book is linked to the repo rate. So there could be a risk, but we are not calling out the risk on banks at this point in time. At this point in time, for FY26, the bigger risk emanates from IT, auto ancillaries, chemicals.
Hopeful of the IT sector, even as our experts said otherwise. But a quick update coming in. The latest consumer data is out, revealing it has fallen below the 4% mark, marking the lowest level since August 2019. My colleague Pallavi now joining us from the newsroom. Pallavi, what factors could be driving this sharp decline? What does it mean for market sentiment going forward? I'll hand it over to you for all of that.
Right, Sanjana, we were expecting the downward trend that we were seeing in retail inflation to continue, but this figure's actually even better than was being estimated. The Bloomberg estimate for retail inflation was at about 3.5%. The figure has actually come in at 3.34%, and like you said, this is the lowest figure we're seeing since August 2019. This does bring immense respite to the RBI and to the Monetary Policy Committee. Let's also take a quick look at some of the key internals. Consumer Food Price Index inflation has come in at 2.69%. So again, as expected, the deacceleration in inflation continues to be led by food inflation. Cereal inflation at about 5.9%. We've seen eggs in contraction at 3.16%. Fruits at 16.3%. Vegetables, importantly, contracting by 7%, and pulses contracting by 2.7%. So that's some of the key internals in case of food. In case of clothing and footwear, inflation has come in at 2.6%, and in case of housing at 3.03%, while fuel and light are at 1.5%. Now, without further delay, let's quickly cut across to Madhavi Arora, lead economist at MK. Madhavi, thank you so much for taking time out to speak to us.
Hi Pallavi, how are you?
Very good. So, to begin with, quick thoughts on the headline. While we were expecting a positive number, this is even better than was expected.
Yeah.
Is that correct?
Yes. Yes. So yeah, I was just seeing the numbers. I think we were also around 3.55
Right.
as far our focus is concerned, and I think market was also around those levels. I think the surprise has come on account of a much lower vegetable inflation, and even for other protein goods as well. So pulses also, we were expecting it to be a less contractionary print than what has actually come out to be. Same is the case of vegetables. We're looking at around 5.5% YOY degrowth, which I think has sort of outdone our estimate. Same is the case with pulses, and I think to some extent egg as well. So my sense is that food inflation is the reason why your print has come out much lower than most people anticipated, including the Reserve Bank of India. So clearly, it's a good print. I think core inflation would also see some, I think, mild easing or probably a sideways move. The only reason why core inflation has been trending up in the last few months is because of gold. Ex-gold, even core inflation was a sideways story, and I think this month's print should be close to around 4.1 or 4.2 for core inflation as well. On net, the headline print is quite encouraging for the central bank.
I do want to ask you the outlook going forward. Now, we've recently seen the RBI MPC as well as the governor share his commentary on inflation, and the expectation is that inflation is expected to continue to remain benign in Q1. What is the expectation for the next few months? Can we expect the next print as well to be closer to what we've seen today, or do you think from here on we're likely to see an uptick going forward?
So our estimate is that we'll be somewhere close to 3.5 to 3.7 range for the next quarter, which is very positive again. And if monsoons do not turn out to be nasty, and if they are as encouraging as IMD believes, then I think the food price volatility will also be much lesser this year, which again would augur well for estimation of consumer price index. So I think for the year as a whole, we are close to around 4%. I think in line with the Reserve Bank's revised forecast. And I think there could only be a downside risk to the same because you might see disinflationary forces coming out of this whole US-China trade mess, which essentially could be lowering the cost of commodities, and the producer prices would be the first one to get the hit, and eventually the CPI will also enjoy the benefit of that. Of course, it will come at the cost of something else for India, but the trade war mess could probably lead to a disinflationary impulse for us. Apart from that, food inflation, if taken care of with a decent monsoons and a better price volatility management, should mean that we should be averaging the year close to 4% or even lower.
Okay, all right. So, we've seen a whole host of macro data come in the last few days. Inflation's, of course, surprised on the positive. We've seen wholesale inflation figures also come in earlier today, and that too was at a 6-month low. However, there have been some ongoing concerns regarding the revival in growth. What are you making of that right now, and what are high-frequency indicators pointing at?
Yeah, the domestic demand dynamics are not very encouraging. They're largely mixed to relatively weaker from what they were 6 months ago. We have been of the view that the private economic agents in India have been, actually getting only absent. And this financial year also would largely see absence of private economic agents domestically. And of course, if at all the global trade war continues at this pace, you would see a deceleration in global growth, which could even lead to a recession. But even assuming that growth goes down by 100 bips, the RBI's own estimates suggest that India would be hit by around 30 bips on GDP. So I think the near-term indicators as far as the domestic demand is concerned are mixed to weak.
Okay, all right. One last question before we can let you go. In spite of the whole host of domestic developments, we cannot not talk about global developments at this stage. And the last week was an interesting one, more so for the US bond markets. I'm curious to understand, given that we're talking about higher borrowing costs for American corporates, possibly for the retail side as well, are there any implications for India? And what is the expectation going forward?
See, American bonds are generally seen as the safest haven, in the asset class community. They have been sold off owing to various factors, one of them being, possible, move away from US bonds. So as far as the foreigners are concerned, the demand in general is sort of weak for these participants. Plus, even Fed is doing a QT. Plus, there were, a lot of technical aspects which had led to sell-off in bonds. One of those being the hedge fund arbitrage that didn't play around, and the basis trade-led crisis also had hit the US bonds. So, to some extent, some of it is technical, some of it is structural in nature for the US, and it has already percolated down to, higher cost in that part of the world. Immediately doesn't impact us, but definitely how it plays around as far as Indian bond market is concerned is to see the spread between the US Treasury and Indian bonds, which is also, actually on a historic low state at this point in time. But again, as I said, to a large extent, the wedge between US Treasury tenure and Indian tenure, the spread that you're seeing, which is close to around 200 bips now, is not necessarily because of, anything that India is doing per se, but largely because American bonds are actually being sold off owing to various factors. And to some extent, emerging markets have also worked well to sort of improve their own domestic dynamics and have also curtailed their fiscal to some extent, for which they are also getting rewarded to some extent. So I don't think that to assume the fact that just because we are left with around 200 bps spread between UST and Indian bonds, one should actually think of a higher yield premium or term premium or risk premium that Indian bonds have to provide to foreign investors. I don't think that is the conventional way that people have been seeing it should work in this time around, because the reasons why the spread has narrowed is very different from what we've seen in the past. So to some extent, I think it may not have the same impact on Indian bonds as it used to have earlier. Even though US bonds have sold off, Indian bonds have actually rallied in the last 1 week or so. And I think there's still a merit to believe that you are going to be seeing a bull steepening bias in domestic bonds and not necessarily following Americans' move, because that's a very America-specific problem that we are seeing at this point in time.
All right, Madhavi, thank you so much for those insights. Always a pleasure speaking to you. Thank you so much for taking time out. Well, these are indeed positive developments when it comes to inflation after months of elevated highs. This is the second straight month that we are seeing retail inflation coming in lower than the RBI's target of 4%. For the month of March, we're currently looking at a figure of 3.34%, and going forward as well, outlook is expected to remain benign. Added to that, the IMD just a short while back has stated that it expects the southwest monsoons to be above normal, and that's another positive for the Indian inflation outlook. So Sanjana, all in all, at least on the inflation front, for the near term, we do seem to be fairly sorted.
Absolutely, Pallavi. Reassuring information coming in there. And thanks so much for putting that in perspective. Meanwhile, let's shift focus now and take a look at what's happening on the international platforms when it comes to tariffs. It appears that the US-China standoff has only intensified, with reports now saying that China has instructed its airlines to halt deliveries of the Boeing aircraft, escalating tensions in the ongoing trade war. Now, this follows Donald Trump's tariffs of up to 145% on Chinese goods. Additionally, Chinese carriers have been directed to stop purchasing aircraft parts from US companies, dealing a significant blow to Boeing, which relies heavily on the Chinese market. The question now is whether the US will extend similar relief to Boeing as it did for Apple. And let's take a look at how Trump's comments and easing on certain sectoral tariffs have also impacted the markets in India, with the auto index emerging as the top performer, buoyed by news of Trump's potential exemption for the automobile sector from reciprocal tariffs. Now, the US president highlighted the need for car companies to restructure supply chains to reduce tariff exposure. In India, we saw Nifty Auto today gaining over 3%, reflecting optimism following this announcement.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
On the back of a consideration on the relief from the reciprocal tariffs, you've seen auto stocks buzzing in trade today. Just to give some perspective to the viewers, Trump had imposed a 25% tariff on foreign autos as well as a 10% reciprocal tariff rate on the UK. Now, these tariffs have been temporarily paused for 90 days, and there's a hope for them not coming into effect in the end. In terms of auto and auto ancillaries with high US exposure, you have Sona BLW, 40% of their FY24 revenues came from the US. Ramkrishna Forging, Bharat Forge have a 25 to 27% US exposure as of FY24. Tata Motors at 23% due to JLR's exposure. Samvardhana Motherson is also in focus with an 18% exposure to the US in terms of revenue in FY24. You have also Balkrishna Tires at the same metric at 18%, as well as Apollo Tires and Sansera Engineering, which have a lower exposure of around 3 to 9%. Now, Tata Motors is seeing major relief today. It was expected to get most impacted by the tariffs due to Jaguar Land Rover, and JLR actually had a 26 to 33% US volume exposure in FY24 and 9 months of FY25, and it accounted for 23% of Tata Motors FY24 top line. And Kotak had expected a potential earnings downside of around 15 to 37% based on how the tariffs were imposed. You also have Samvardhana Motherson in focus today. The stock has gained quite a bit. It was expected to be impacted by the indirect effects of the tariffs around the world. The tariffs were set to hurt supplies, companies' supplies to foreign OEMs that actually export to the US. And the relaxation on imports from Mexico and Canada is a big positive as per Axis Capital's note today. And then you have Bharat Forge and Ramkrishna Forging also in focus. They derive more than 30% of their revenues from the USA, and tariffs would be a second serious blow after the delay in the EPA norms. And these were norms that were expected to lead to a pre-buy in FY26 but haven't come into place yet.
And with trade tariffs reshaping global markets, the export landscape is facing mounting pressure. Sunil Kant Munjal of Hero Enterprises shared his insights on how these tariffs could create short-term roadblocks for Indian exporters, requiring industries to recalibrate and adapt to the evolving trade environment. Let's listen into that.
For India now, I think there is short-term pain, partially from uncertainty, partially from some actual tariffs being imposed. But I think there's also long-term gain, because India is quite smart in how it approaches geopolitics nowadays. We have ensured that India's interest is kept in mind when any trade negotiation takes place. While politics is a key ingredient in any negotiation, but so is trade. So is our interest. So is the interest of Indian industry. And I've heard both the Prime Minister and our Commerce Minister make their comments. So I'm quite comfortable that where this will finally come to rest, India will be a little bit better off than many other of the countries that we compete with, either from our export basket or from our geographical standpoint or from the economic standard of Indian citizens and those countries.
And we have been reporting to you pretty relentlessly, in fact, that India's strategy is not to make any big moves, but continue their talks with the United States of America. And we're bringing you more updates on what India's strategy is going to be in the next coming weeks and months, in fact. So India and the US continue to make progress in their trade talks, with both of the countries working towards finalizing the terms of the bilateral trade agreement by September or October. This is what we're hearing right now. The Commerce Ministry is currently reviewing the impact of reciprocal tariffs on the recent trade performance and preparing for FY26, which we know may present both growth opportunities and challenges for India's exports and imports. Now, these discussions are part of India's broader effort to strengthen economic ties and navigate the complexities of global trade environment. My colleague Rishabh, who's been tracking the story very closely, now joining us live for more. Rishabh, tell us the key takeaways from the ministry briefing, and how are we seeing the Commerce Ministry allay the fears of the export sector and also take it forward when it comes to talks with the United States of America?
Right. The Commerce Ministry stance continues to be that there are concerns as well as opportunities arising from the current trade war situation that's happening between the US and China, as well as in general, the uncertainties with regards to tariffs that have sort of shook the world. What the Commerce Secretary very interestingly said was the fact that India has taken a very clear path of trade liberalization, and that is via the BTA talks that are happening with the US. They are currently ongoing in virtual mode, and physical negotiations will start from the second half of May, where we can expect the US side to visit India, as well as an Indian team of negotiators to fly to the US and negotiate there. Interestingly, the Commerce Secretary also mentioned that there is no current sort of numbers or data that point to the fact that there was some sort of an impact of the reciprocal tariffs on the March trade figure. We know that the FY25 figure for India is now at 820 billion in terms of exports. And he said that there's a very good chance of that growing if the BTA talks are fully successful with the US. Also, interestingly, the Commerce Secretary also revealed that there are certain dumping concerns that have come to their notice with regards to this trade war that's happening. Given the fact that there's very high tariffs on China, there might be dumping of cheap imports into India. And that is something that the Commerce Ministry is very keenly tracking. There is an interministerial group that has been put in place to check the imports to check any potential surge in imports. There are certain countries that have been identified. There are certain commodities that have been identified, which we'll try and get more information on. Very interestingly, the Commerce Secretary, moving ahead from the India-US BTA, he also talked about the India-EU FTA that is currently in negotiations. He added that there might be an early harvest deal or a first tranche of a deal, very similar to what we're expecting from the US deal. There might be something similar that might happen with the EU as well, given the fact that there are certain non-core trade issues that might take more negotiations and hence more time. So we'll focus on the core issues first, which are mainly tariff measures. So that is what the India-EU FTA might hold might come up in the next few months.
Absolutely, Rishabh. Thank you so much for that. The Indian government, specifically the Commerce Ministry, working extra hard to prepare and strategize when it comes to tariff-related measures, non-tariff related measures, and also anti-dumping. Thanks so much for that update. And moving on, even as efforts to transform Dharavi take shape, the massive rehabilitation process is gaining momentum in Mumbai. A detailed door-to-door survey is currently underway to identify who qualifies for the redevelopment initiative. The project promises housing for all, covering homeowners, tenants, and even informal settlers. NDTV speaks exclusively to SVR Srinivas, CEO of the Dharavi redevelopment project, to know more.
As rehabilitation plans are in motion for the Dharavi redevelopment project, an extensive door-to-door survey is also underway to determine resident eligibility for the project. The redevelopment project follows a housing for all approach, ensuring that not only homeowners but also tenants and informal dwellers are accommodated. SVR Srinivas, CEO of Dharavi redevelopment project, sheds more light.
So take us through who is eligible, who is not, and if they're not eligible, what is the alternative that's provided to them?
Typically, in all the slum schemes, there is a huge distinction. Those eligible will get a house and those not, they don't get a house. Okay. But in Dharavi, the main motto, as I said, is housing for all, albeit in different formats, right? So those eligible who have come before 2000 and 2011 respectively, without or with small payment, they'll get a house inside Dharavi, right? Secondly, those who are not eligible, for instance, those on mezzanine floor, first floor, second floor, that is almost 50% of the population, which otherwise the normal coach would have been thrown out on the roads. Here we are ensuring that, government is ensuring that they too will be given a house in the form of rental housing, but with a higher purchase right. So those eligible will get a house, free house here in Dharavi, and those who are not eligible will get a house on a rental basis with a right to purchase. They can also become owners, right? So that is a very important step. So housing for all.
So far, over 70,000 dwellings have been surveyed. The survey is expected to conclude in the next few months, after which eligible residents will be shifted to temporary transit housing before permanent homes are built. Survey teams are digitally mapping structures, verifying documents, and numbering houses to create a transparent system for relocation.
The survey is right now almost 70-80% complete. Okay. About 90,000 units have been numbered, right? And about 70,000, 65 to 70,000 have been surveyed, right? Actually, detailed documentation has been done in a digital format with on a tablets, this survey has been carried out. So digital survey and household survey, and it has consists of several layers, First you have base map, then the numbering, then the household survey, then digitization, then collection of data and analysis.
And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by Hello and welcome to KYC, Know Your Company. Today we're going to focus in on Morpen Laboratories. Interesting play. It's an interplay between pharma as well as medical devices, has good revenue distribution across the world. But let's quickly zoom in as to what the company does. Morepen Labs, it manufactures, produces, develops and markets a whole host of products. Let's talk about them. One is APIs, which is active pharmaceutical ingredients. We'll talk a little bit about what APIs are. Branded and generic formulations is the other piece that they do, and home health products is the third piece they do. So if we were to categorize into two baskets, one is pharma, one is medical devices, but otherwise these are the three different streams that they deal in. Let's talk about active pharmaceutical ingredients first. What's an API? It's a substance within a drug formulation that produces the desired physiological effect. So for crocin, it helps you alleviate fever. Basically, the drug which allows you to do that is an API. It allows for pain relief, for reducing inflammation, or targets a specific pathogen in order to repair whatever is the concern in your body. In terms of quality and potency, that really determines how good the medication therefore is. So API is critical in the drug to ensure that the cure that you are looking for is actually being found. That is what an API is. So Morepen manufactures API. It's a leader, especially in anti-asthmatic, anti-allergy and cholesterol related APIs. These three APIs it's a leader in terms of supplying. Now let's talk about the branded generic formulation. This is where better margins start to come into play. This is actually developed after the patent for the original drug expires. So once the original drug's patent expires, you will have all sorts of generics which will enter the market. Within that, branded generics will always command a slight bit of premium. So you might have, for fever, you might have a Dolo, you might have a Crocin. Both of them are branded generic drugs. That's what Morepen has also ventured into. And they brand it to ensure recall, of course, and therefore customer preference. The last piece is home healthcare products. So, okay, branded generics, Bernol is one of them. The other one is Lemolate, which takes care of cough and cold. So these are a couple of products within the branded generic space that Morepen does. Now, last one is with regard to home health products. These are medical devices which the company sells. It manufactures and sells several devices, and some of them on your screen. It includes thermometers, pulse oximeters, blood pressure monitors and the like. So a whole host of products is what they do, including glucometers. These are just some indicative of the various other products that the company does. Now in terms of business split, it does 70% pharma currently, 30% medical devices. That's how the business is split up. Where do they sell? Let's pull out the geographies as well. And that's how they are split up. 30% India, 70% rest of the world. Asia plus India is roughly 56%. Europe contributes 21%. USA is just about 16%. That might be